I want you to imagine for a second completely removing financial anxiety from your life. Not just barely surviving, but actually stepping out of the traditional American rat race entirely. Because today, we're exploring a definitive, step-by-step roadmap to true generational wealth. It's actually fascinating how this framework takes the massive complexities of Wall Street, real estate, and modern entrepreneurship and distills them into a crystal-clear path that we can follow together.
But before we get into the mechanics, we really have to start by confronting a fairly uncomfortable question. Why do so many incredibly ambitious, hardworking Americans fail to build lasting wealth? I mean, think about it. You go to school, you get a solid job, you're working 40, 50, maybe even 60 hours a week. You are absolutely putting in the effort. And yet, despite grinding for all those hours, a massive percentage of us are quietly suffocating under financial stress. We're working tirelessly for a paycheck without ever actually understanding the underlying mechanics of the money we earn. You see, we're taught exactly how to work for money, but we are rarely taught how to make that money work for us.
And you know, it's wild how quickly the whole illusion of wealth shatters when you look closely. Society conditions us to think a high salary or a flashy luxury car equals being rich. But here's the reality. Income is not wealth. You could literally earn $250,000 a year, but if your lifestyle just scales right up with it, if you're funding luxury cars and massive mortgages with bad debt, your true net worth might actually be zero. True wealth isn't the cash flowing into your checking account, it's the assets you accumulate and actually keep. It's that vital shift from merely generating income to diligently building your net worth over time.
So here is the exact agenda we're uncovering today. First up, we'll build the financial foundation. Second, we'll construct the ultimate wealth engine. Third, we cover advanced wealth creation. Fourth is mastering financial intelligence. And finally, we'll tie it all together with the Freedom Blueprint.
All right, let's kick things off with Section 1, the financial foundation.
Look, you simply cannot build a skyscraper on a swamp. The absolute dividing line between the middle class and the wealthy really comes down to how they handle debt and where they focus their capital. Wealth destroyers use bad debt. We're talking those brutal 25% interest credit cards and depreciating auto loans to buy liabilities. But the wealthy? They leverage the bank's money, using good debt to acquire assets that actively put money back into their pockets. They are literally paying interest for the privilege of owning things that grow their wealth every single day. It's a total game changer.
So the crucial takeaway here is that you've got to lock in these non-negotiable tools before you even think about playing on Wall Street. You need a personal system that consistently generates positive cash flow. You need to park your liquid capital in high-yield savings accounts so inflation isn't just eating away your purchasing power. You absolutely need a fully funded emergency fund, which is actually kind of shocking when you realize how many American households couldn't even cover a $400 unexpected expense today. And you need to maintain a pristine high credit score. That way, when you do use debt, you're getting the absolute best terms. This is your foundational armor.
Moving right along to Section 2, the ultimate wealth engine.
Now this right here is the literal heartbeat of financial freedom. The time value of money and compound growth are the true quiet forces behind those massive multi-million-dollar retirement portfolios. In the early years, the growth honestly feels painfully flat. It feels like absolutely nothing is happening. But as the decades roll on from year 10 to 20 to 30, that exponential curve takes over like an unstoppable snowball of wealth. Your money starts making money, and then that new money makes even more money.
But how do you actually capture that growth safely? Well, it comes down to proper asset allocation. You don't just throw all your hard-earned money into a single volatile stock, hoping for a lottery win. By spreading your capital out across broad market index funds, ETFs, stocks, and bonds, intelligent investors perfectly balance their risk versus reward. Diversifying like this allows you to capture the overall long-term growth of the American and global economy while totally protecting your capital against the failure of any single company.
Furthermore, how you hold those investments is absolutely vital. Uncovering the power of tax-advantaged accounts, like a 401k with an employer match, which, by the way, is quite literally free money, along with Roth and traditional IRAs, shows you exactly how to insulate your wealth from unnecessary taxation over your lifetime. Listen, tax efficiency planning isn't just a strategy for billionaires. It is a critical lever for anyone who is serious about keeping the wealth they generate.
All right, Section 3, Advanced Wealth Creation.
When you look at the wealthiest individuals on the planet, they all make this exact same transition. They stop trading their hours for active wages, and they start building systems for passive income. Active wages require your physical presence, right? If you stop working, you stop earning. But passive income, that works for you while you sleep. Whether it's scaling a modern startup, expanding a profitable side hustle, or investing heavily in real estate and REITs, the ultimate secret here is entirely decoupling your time from your earning potential. And when analyzing these massive income engines, there's one concept that just keeps popping up: the economic moat. This is famously championed by legends like Warren Buffett, and it's all about finding companies with deep, impenetrable advantages. Whether it's a powerful brand identity, a serious technological edge, or high switching costs for consumers, a moat protects a business's long-term profits from competitors. It basically ensures your investment continues to compound safely for decades.
Next up is Section 4, Mastering Financial Intelligence.
You know, markets don't just go up in a straight, predictable line. They breathe. They expand, they hit a peak, they contract, and eventually they hit a trough. Understanding these inevitable cycles is what prevents panic. Think back to 2008 or even 2020. The amateurs, they sold in a total panic. But financially literate investors, they saw those troughs as historic, once-in-a-decade opportunities to buy incredible assets at massive discounts.
Which brings us to a wildly fascinating area, behavioral finance. Because it turns out managing your own mind is often way harder than managing the math. We're all hardwired with cognitive biases, things like loss aversion or the classic fear of missing out. Seeing how successful investors actually recognize these emotional triggers and then build automated, disciplined systems to bypass them is incredibly eye-opening. It ensures they never, ever make a long-term financial decision based on short-term emotional panic.
And finally, Section 5, the Freedom Blueprint.
When you map it all out like this, the sequence is just brilliant. You really can't skip ahead to step 5. First, you've got to secure that money foundation and emergency cash flow. Second, optimize your banking and leverage credit smartly. Third, automate those investing fundamentals so compound interest is just quietly working in the background for you. Fourth, maximize those tax advantages to protect all your hard-earned gains. And only then, in step 5, do you aggressively scale with those advanced wealth strategies. This exact progression is what transforms a total beginner into a master architect of generational wealth.
What we've uncovered today outlines exactly 50 core financial concepts, from fully understanding inflation all the way up to mastering portfolio management. Mastering these specific pillars acts as a definitive cheat code. It's an education that is going to pay you massive dividends for the rest of your life.
It is so easy to get lost in the numbers, but always remember that money is just a tool. True luxury isn't a flashy sports car financed with a high-interest auto loan. It's not a massive mansion that requires an 80-hour work week just to keep the lights on. True luxury is the absolute freedom of your time, powered by reliable passive income. It's waking up every single day and doing exactly what you want, when you want, with the people you love.
Today, we are diving into something absolutely crucial. We're looking at the complete American financial mastery roadmap. Now, I want you to think of this as the ultimate architectural blueprint for your life. We are literally going to build a financial house together, starting from the dirt it sits on all the way up to the roof, using exactly 50 essential building blocks. If you've ever felt like the world of finance is just this scattered, overwhelming puzzle, well, this roadmap is exactly how we fit every single piece together.
Okay, so here is the game plan. To build our house, we're going to sweep through 6 distinct phases of construction: foundations, banking and credit, investing fundamentals, retirement and tax, advanced wealth, and finally, financial intelligence and the blueprint.
All right, let's jump right into Section 1, Money Foundations. You guys know this, every solid house needs an absolutely unbreakable base. This is where we pour the concrete. We start right at the bedrock with our first 10 building blocks. We're talking income versus wealth, and assets versus liabilities. From there, we move into the actual mechanics of cash flow and net worth. But we also have to mix in our defenses, right? So understanding inflation, protecting our purchasing power, and setting up bulletproof emergency funds and budgeting systems. Finally, we cap our foundation with the ultimate goals of financial independence and the time value of money. This is where we start from zero to battle the monster of inflation and really master the flow of every single dollar we touch. Now, what's really interesting here is the critical contrast between making money and actually keeping it. You see this confused all the time. Income is just the money coming in. It's your shovel. But wealth? Wealth is the dirt you actually manage to pile up. It's the assets you retain and grow over time. A massive income doesn't automatically mean you have a strong foundation, especially if your liabilities are just eating it all up. Real wealth building only starts when you truly internalize this fundamental difference. Moving right along to Section 2, Banking and Credit. Once that concrete is cured, it's time to put up the framing. Topics 11 through 20 act as the literal 2x4s and nails of our financial structure. We've got our everyday tools: checking accounts, savings accounts, and high-yield savings. Then we have our credit levers, credit scores, credit reports, and credit cards. And of course, the major structural beams we all deal with, student loans, auto loans, and mortgages. Master these 10 elements, and you've effectively erected the walls of your financial house. And hey, a massive part of framing our house correctly is knowing exactly which materials to use, which brings us to number 17 on our list. Debt gets a bad rap, but it isn't always a trap. Good debt is borrowing to build or acquire assets, like taking out a mortgage for a house that's going to appreciate in value. Bad debt, on the other hand, is borrowing merely to consume. Think maxing out a high-interest credit card on a weekend vacation. Good debt expands your house. Bad debt just drains your resources and causes the walls to sag. Which brings us to Section 3, Investing Fundamentals. The walls are up, so now our house needs power. Topics 21 through 30 give us the investment vehicles to put our money to work completely automatically, literally while we sleep. We have the core components: stocks, bonds, mutual funds, index funds, and ETFs. Then we have the mechanics of how they actually generate energy, like dividends and compound growth. Finally, we manage this power grid using strategies like dollar cost averaging, balancing risk versus reward, and optimizing our overall asset allocation. Let's actually zoom in on asset allocation for a second. Just like a house needs that perfect balance of electrical wiring and plumbing, your portfolio needs the right balance of assets. Spreading your investments across stocks, bonds, and index or mutual funds is how you manage your overall risk. Balancing that risk against the potential reward is exactly what ensures our financial engine runs smoothly over the decades, without totally overheating. All right, Section 4, Retirement and Tax Advantages. So we've got power generating right. Now we need to make sure absolutely none of it leaks out. Topics 31 through 36 are all about shielding the wealth we're building from unnecessary taxes while locking in our distant future. We leverage specific, highly insulated accounts like the 401k, the Roth IRA, and the traditional IRA. We optimize our retirement planning, and we absolutely maximize tax efficiency. Because honestly, it's not just about what you make, it is entirely about what you keep from Uncle Sam. The absolute kicker here is the employer match. When you look at the difference between a base contribution and a contribution plus an employer match, it's staggering. This is literally free money being handed to you just for participating. Understanding and utilizing this match acts like a massive turbo boost to your retirement planning. It dramatically accelerates your entire timeline. Next up, Section 5, Advanced Wealth Building. At this point, our core house is fully functional. But what if we want to expand? What if we want the guest house and the pool? In topics 37 through 45, we move way beyond the basics to add those luxurious additions to our property. We're looking at real estate investing and REITs. We're exploring business ownership, entrepreneurship, and side hustles. All of these work together to create brand new streams of passive income. We also level up our investing skills by understanding economic moats, value investing, and growth investing. These are the advanced tools that take you from simply being comfortable to being truly generationally wealthy. To really crush it in this advanced phase, you have to understand this concept, the economic moat. Just like a medieval castle is protected by a massive moat of water, successful value investors look for companies that have a distinct competitive advantage, a moat that protects their long-term profits and market share from competitors. When you add to your financial house, you want to be absolutely sure those new assets are heavily protected. Finally, Section 6, Advanced Financial Intelligence. Now, we need a solid roof to cover everything we just built and a heavy-duty security system to ensure it stands the test of time. Our final 5 blocks, 46 through 50, deal with the vital, intangible elements of wealth. You absolutely must understand market cycles so you don't panic when the financial weather gets rough. You need to grasp behavioral, finance, and wealth psychology. You have to master ongoing portfolio management. And ultimately, you look toward building generational wealth so you can pass the keys of this incredible house to the next generation. Let's actually hover on behavioral finance for a second to see how it ties the whole room together. Behavioral finance is the study of how our own psychological influences and biases impact our financial behaviors. Think about it. You can have the absolute best foundation, the perfect asset allocation, incredibly dialed-in tax efficiency, but if your own psychology leads you to panic sell during a market dip, the whole house catches fire. Mastering your mindset is the ultimate security system. And that leads us to our final chapter, the Financial Freedom Blueprint. This is the grand reveal. Let's look at the macro journey we just mapped out. Step 1, we built our cash flow foundation. Step 2, we frame the house using good credit. Step 3, we powered it and insulated it with smart investing and tax strategies. Step 4, we expanded our property with advanced wealth techniques. And Step 5, we secured the entire perimeter with wealth psychology. Every single block relies on the others to form one cohesive, unbreakable strategy. Throughout this series, we are going to dig deep into every single one of these sections to ensure your construction is absolutely flawless. Look, society has sold us a massive lie. We are constantly told that the ultimate American dream is a giant paycheck, a corner office, and this ultra-luxury lifestyle. But behind closed doors, the absolute top tier of investors and entrepreneurs are playing a completely different game. Today, we're opening the vault on the American Financial Mastery Roadmap in this explainer. We are breaking down the ultimate financial showdown, income versus wealth. So think about this for a second. Is $1 million salary actually enough to make you rich? We totally idolize high-earning professionals, right? The Wall Street executives, the Silicon Valley tech founders. But earning $1 million a year does not automatically guarantee financial security. In fact, depending on how that money is managed, a massive salary can actually be a direct ticket to immense financial fragility. Part 1. The high income illusion. This whole illusion starts with a silent predator, inflation. It's basically this persistent, invisible rise in prices that gradually destroys the value of your earned income over time. Relying purely on a high salary is incredibly dangerous. I mean, you might negotiate a 5% raise at work, but if everyday inflation is running at 7%, you are mathematically poorer. Your income is just bleeding out completely unnoticed. And that directly hits your purchasing power. That's the actual real-world amount of goods or services your money can buy at any given moment. A massive salary means absolutely nothing if those dollars buy less real estate, fewer groceries, and ultimately less freedom every single year. The number on your paycheck might look huge, but what that money can actually do for your life is constantly shrinking. Moving on to Part 2, defining true wealth. We really need a fundamental paradigm shift here. See, income is temporary, plus it's highly taxed. Actually, earned income is the highest taxed money in America. And crucially, it stops the absolute second you stop working. Wealth, on the other hand, is permanent. It compounds over time. It literally generates money while you sleep, much like the portfolios built by Warren Buffett and elite investors. Basically, income is just the shovel. Wealth is the gold mine. So, how do we actually measure this financial masterpiece? Well, through your net worth. This is your absolute financial scorecard. You calculate it simply by subtracting what you owe from what you own. If your income is $500,000, but you owe $600,000 in consumer debt and have zero savings, your net worth is negative. You are technically poorer than a broke college student with $0 and zero debt. Part 3. Assets versus liabilities. It's wild, but millions of ambitious Americans tragically confuse these two forces. The rule is absolute. An asset puts money directly into your pocket. A liability takes money out. Think about a brand new sports car that depreciates the second you drive it off the lot, all while demanding high monthly payments. That is a liability. But an index fund, or maybe an investment property generating monthly rent, that's an asset. True wealth is built by aggressively acquiring assets and ruthlessly minimizing liabilities. Let's put this into perspective and look at two different profiles. On one side, you have a high-earning professional making $500,000, but beneath the surface, luxury car leases, a massive mortgage, heavy credit card debt. They look rich, sure, but they are secretly drowning. On the other side, an average earner making $75,000. It's a modest salary, but they hold appreciating assets like index funds and real estate. This average earner is quietly building an empire and will ultimately achieve a significantly higher net worth than the high earner. Because here is the hard truth. The illusion completely shatters the very second that paycheck stops. If the high earner loses their job tomorrow, their entire life collapses because those massive liabilities instantly consume them. But the average earner with cash-flowing assets, they have a permanent safety net. They have true, actual freedom. Okay, Part 4, mastering your cash flow. Cash flow is essentially the total amount of money moving in and out of your personal financial ecosystem. Think of it like a river. Directing this river efficiently is the absolute lifeblood of achieving financial independence. It's really not just about how much water is flowing, it's about exactly where you are digging the trenches to send that water. When you look at the wealthy, they disproportionately funnel their cash flow. They take the biggest slice and direct it straight into assets before funding anything else. They cover their basic living needs, and they keep the slice for liabilities razor thin. But the middle class? They often do the exact opposite. They fund their living needs, buy incredibly expensive liabilities on credit just to look wealthy, and then they wonder why there is literally nothing left to invest at the end of the month. Because look, if you do this backwards, this is the number you are left with: 0. 0 is exactly what a high income adds to your net worth. If your cash flow is entirely consumed by expensive liabilities, you could make $1 million a year. But if your cash flow out equals your cash flow in, your wealth grows by 0. You remain completely dependent on the next paycheck. Which brings us to part 5, the financial freedom blueprint. To actually build true wealth, you absolutely have to internalize these non-negotiable foundations. You have to separate the illusion of income from the reality of wealth. You must acquire assets, relentlessly minimize liabilities, optimize your cash flow, and protect your purchasing power from that silent theft of inflation we talked about. So, here is your step-by-step blueprint for turning temporary income into permanent wealth. Step 1, earn income. You got to secure the raw material. Step 2, control cash flow. Direct that money with absolute precision. Step 3, buy assets. Purchase investments that literally pay you. And step 4, build net worth. Watch your financial scorecard grow totally independent of your daily labor. This is the exact cycle that creates generational wealth. Ultimately, true wealth isn't about what you can afford to buy today. It's really about the freedom you own tomorrow. It is not about flashy, superficial spending. True financial mastery is the ability to wake up and do exactly what you want with your time, simply because your assets are working so hard that you don't have to.
Have you ever wondered what actually separates the everyday, middle-class grind from true, unshakable, generational wealth? It's not just a high salary. Today, we're diving into the WealthOS blueprint, uncovering the exact financial mechanics used by the top 1%. We're stripping away all the noise to focus purely on the absolute fundamental laws of assets versus liabilities. By the end of this explainer, you're going to see money completely differently, not as a mystery, but as a predictable, powerful machine. Let's get right into it.
We'll be breaking this down into 5 core parts. We're starting with the wealth illusion, moving into the hard mechanics of assets versus liabilities, then the wealth-building engine. After that, we'll hit some advanced financial intelligence, and finally, wrap it all up with the financial freedom blueprint.
All right, part 1, the wealth illusion, unmasking modern American spending.
Okay, let's dive into this. To understand how to actually build wealth, we first have to look at why so many people never do. And it starts with a pretty uncomfortable reality. In modern America, what looks like wealth on the surface is very often just a mountain of hidden debt. So why do high earners, doctors, lawyers, tech executives pulling in multiple 6 figures, why do they still end up going broke? It's a paradox, right? But it trips up millions of us. We are culturally conditioned to believe that a massive salary automatically equals wealth. We see the leased sports car, the huge mortgage on the oversized house, the luxury vacations, and we just assume they've made it. But this illusion of flashy spending is the exact opposite of actual long-term wealth retention.
The answer to this paradox really comes down to one defining difference: income versus wealth. Think of it like this. Income is just the money you earn. It's the water flowing into the bucket. Wealth, on the other hand, is your net worth and the purchasing power you actually keep. It's the water that stays in the bucket. Relying solely on a high salary without managing your cash flow is literally the fastest way to trap yourself in the paycheck-to-paycheck cycle. And honestly, it doesn't matter how many zeros are on your pay stub. If your lifestyle expenses rise every single time your income does, you aren't building wealth at all. You're just experiencing lifestyle inflation.
Which brings us to Section 2, Assets versus Liabilities, the foundational mechanics of wealth.
If you want to change your financial trajectory, you have to adopt the mindset of the wealthy. They view money purely as a tool for accumulation. And here is the golden rule, the absolute core of financial mastery. Assets put money into your pocket, they generate positive cash flow. Liabilities take money out of your pocket. They result in negative cash flow. That's the whole shebang. It's a stark, uncompromising contrast. Assets feed your financial independence and build your net worth, while liabilities just drain it. Every single thing you buy falls into one of these 2 buckets.
Let's look at a realistic American balance sheet to see how this plays out. Over in the asset column, you've got things like your 401k, real estate investments, and index funds. These are actively growing your net worth over time. Then look at the liabilities: auto loans, high-interest credit cards, standard consumer debt. Now, here's where people get tripped up. Many trick themselves into believing that a massive loan on a luxury SUV is an asset just because the car has physical value. But it's draining your net worth every single month through depreciation and interest. Make no mistake, it is a liability.
Now, you might be wondering, does this mean all debt is evil? Absolutely not. There's good debt and there's bad debt. Good debt is leveraged strategically. Wall Street firms, major real estate investors, and successful entrepreneurs use good debt, things like business loans or strategic mortgages, to acquire assets that generate way more value than the cost of the loan itself. They use it to build an economic moat. Bad debt, though, that's consumer debt. It's high-interest credit cards used for immediate gratification, or those depreciating auto loans we just talked about that tie up your future cash flow for something that is losing value every single day.
Moving right along to Section 3, the Wealth Building Engine. Scaling from foundations to independence.
So how do we move from basic budgeting systems into serious investing fundamentals? Well, the secret engine of Wall Street is the timeline of compound growth. Check out this progression. In year 1, you establish a system, something like dollar-cost averaging, where you're investing a set amount regularly, totally ignoring market noise. By year 10, dividend reinvestment really starts doing the heavy lifting for you. Then we hit year 20, and the time value of money kicks in, creating this beautiful hockey stick curve of exponential growth. And by year 30, you aren't just rich, you've established generational wealth. The math does the heavy lifting, but time is the required fuel.
And what exactly fuels that compound growth? A highly diversified, wealthy asset allocation. Think about this breakdown. 40% in broad market index funds and ETFs for steady, reliable growth. 30% in real estate and REITs to capture appreciation and rental cash flow, 20% in business ownership and side hustles for explosive upside, and a targeted 10% in individual stocks and bonds. You see, the rich diversify their risk and reward across completely different asset classes. This creates an ironclad, tax-efficient portfolio that can weather pretty much any economic storm. This entire strategy is deeply rooted in a classic Wall Street philosophy. Warren Buffett said it best: "The stock market is a device for transferring money from the impatient to the patient." That insight really hits the nail on the head regarding value investing. Wealth creation isn't about jumping on flashy short-term trends or trying to day trade your way to a quick buck. It's about long-term momentum. It is entirely about patience. But let's be real, patience is incredibly hard, and a lack of it leads to one of the most devastating financial mistakes you can make: buying liabilities before establishing a rock-solid emergency fund and budgeting system. This is the painful trap of upgrading your lifestyle before your passive income can actually pay for it. Think about it. If you get a raise and immediately go lease a more expensive car, you've just converted your new income straight into a liability. You completely skipped the foundational step of building your financial base.
Which brings us to Section 4, Advanced Financial Intelligence, the Psychology of the Rich.
As any seasoned investor will tell you, the math is really only half the battle. The other half? It's all psychology. Let's focus on one specific number: 3%. This is the historical average rate of inflation. If you're leaving your cash sitting in a basic checking or traditional savings account earning practically 0% interest, inflation is silently destroying your purchasing power every single year. You are literally losing 3% of your money's value annually just by standing still. To the financially intelligent, cash is not king. Cash flow is king.
To beat inflation and build real wealth, you have to master wealth psychology. You need the emotional discipline to navigate wild market cycles without panic selling the second the market drops. You've got to understand behavioral finance, how fear and greed drive the masses, so you can do the exact opposite. This requires optimizing your portfolio management and focusing your energy on growth investing to find companies with deep economic moats. At the end of the day, your brain is your most valuable asset or your most dangerous liability.
Let's bring it all home. Section 5, the Financial Freedom Blueprint and how everything works together.
We've covered the illusion, the mechanics, the engine, and the psychology. Now let's get into the practical, step-by-step blueprint you can apply to your balance sheet right now. Step 1. Build your emergency fund, but absolutely do it in a high-yield savings account to fight off that 3% inflation. Step 2. Maximize your employer match in a 401k or traditional IRA. That is literally free money at immense tax efficiency. Step 3. Aggressively eliminate your bad debt, like those credit cards, and guard your credit scores like a hawk. And Step 4. Systematically acquire passive income by routing your extra cash into ETFs and mutual funds. This is the exact roadmap to shift your entire balance sheet.
As you execute these steps, something incredible happens. A powerful divergence occurs on your personal balance sheet. It's a beautiful thing. Your liabilities systematically decrease while your assets continuously increase. The result? Your net worth absolutely skyrockets. You cross a threshold where you are no longer working for money, your money is working for you.
So, the crucial point of this entire explainer really comes down to these takeaways. Assets feed you while liabilities bleed you. Never forget that a high income does not equal a high net worth. It is only what you keep that counts. Leverage good debt to build economic moats, but aggressively destroy your bad debt. Utilize tax-advantaged accounts like a Roth IRA to shield your gains. And finally, recognize that time and compound growth are for sure your greatest assets in this entire journey.
All of this optimization, all these mechanics, they serve one ultimate goal: total financial independence and the freedom of time. We aren't building this just to impress people we don't even know with a flashier sports car. The real luxury we are building here, the true essence of this entire WealthOS roadmap, is the ability to wake up every single day and choose exactly how you want to spend your life.
Which leaves you with one final, cinematic choice. Will you spend your life paying for the illusion of wealth, or will you build the reality of freedom? The math is clear. The blueprint is laid out right in front of you. The choice is yours.
Today, we're unpacking something huge, the complete American Financial Mastery Roadmap. But look, we're not going to just stare at a dry list of financial terms. No way. Instead, we're going to look at your money as a living, breathing, natural ecosystem. I want you to picture the grand scale of the American landscape. Think about the raw, undeniable power of nature out there, because honestly, that's exactly how wealth actually operates.
Okay, so let's define the absolute core of this entire ecosystem: cash flow. Now, try not to think of it as just, numbers blinking on a screen. Think of it as an immense force of nature. It's literally the water in your financial river, and it rushes with the exact same elemental power as the mighty Mississippi. It's the energy animating your whole financial existence. To actually master your money, we've got to observe, control, and eventually redirect this massive current.
So here's our map for today. We'll start with the force of cash flow. Then we'll look at trapping the river with banking, growing wealth through investing fundamentals, setting up tax shields and retirement, diving into advanced wealth and intelligence, and finally, mapping out the financial freedom blueprint. Let's get into it.
Section 1. The force of cash flow. Money foundations.
Now, you really need to notice the difference between the water you catch and the reservoir you're actually building. See, income, that's just the rain falling into your river. But wealth? Wealth is that deep, lasting reservoir. And how do you build it? Well, you use assets. Those are the tools that actively pump water in. Liabilities, on the flip side, are basically the leaks and cracks that are constantly draining your hard-earned wealth away.
To keep that river flowing smoothly, you need strong banks, right? Budgeting systems and emergency funds, they're what prevent catastrophic floods. But you also absolutely must respect the time value of money. The whole idea that $1 today is worth more than $1 tomorrow. Why? Because of inflation. It's this invisible force just constantly evaporating your purchasing power. I mean, to put that into perspective, just average historic inflation can literally cut the buying power of your cash in half every 20 years. That's wild. But manage these banks well, and your river flows straight toward financial independence.
Moving downstream, Section 2. Trapping the river, banking.
Think of these everyday bank accounts as different-sized dams in your ecosystem. Your checking account is built for immediate flow. It's water passing right through to handle your daily needs. A standard savings account holds a little back, sure, but it usually earns literal pennies a year. But a high-yield savings account? Now that's where you safely pool your cash in a massive holding area to generate a strong, noticeable current all on its own. So here's an absolutely crucial point to wrap your head around. Debt isn't inherently evil. Debt is really just leverage. Good debt, like a well-planned mortgage, reasonable student loans, or a reliable auto loan, acts like a heavy-duty industrial pump. It expands your reservoir's capacity. But bad debt, like high-interest, mismanaged credit cards, honestly, that's a catastrophic breach in your dam that will just violently drain your resources dry.
And, well, to get access to those powerful industrial pumps in the first place, you need trust. Your credit report and your credit score? They're simply the weather forecast for lenders. Lenders look at this data to see exactly how reliably you manage your financial ecosystem. A high score means clear skies and favorable winds. And more importantly, it means they're going to give you the lowest possible interest rates, which, Over a lifetime, saves you tens of thousands of dollars. Literally.
All right, Section 3, Growing Wealth Investing Fundamentals.
Once the dam is built and the flow is controlled, it's time to dig irrigation channels and plant seeds. You've got different crops to choose from here. You can plant individual seeds, like single company stocks, or maybe some stabilizing debt like corporate bonds. Or, and this is a game changer, you can plant massive pre-diversified fields using mutual funds, index funds, and ETFs. These instantly spread your money across thousands of companies at once, which totally shields you from the failure of any single plant.
Now, any good farmer knows you don't just plant one type of crop, right? Balancing your asset allocation, which just means weighing your risk against your potential reward, is exactly what protects your harvest from a sudden financial drought. By diversifying, you're making sure that if one sector of the economy struggles, the rest of your ecosystem just keeps on thriving.
So how do these crops actually grow? Through the sunlight and rain of investing, compound growth in dividends. By utilizing dollar-cost averaging, which is just a fancy way of saying you consistently plant seeds on a regular schedule, you let compound growth naturally multiply your harvest over time. And the best part? You do it without ever needing to stress about predicting or timing the financial weather.
Let's move to our next section to see how we protect all this. Section 4, Tax Shields and Retirement.
Think of these retirement accounts as your greenhouses. Whether you're using a 401k or a traditional IRA for an upfront tax break today, or maybe a Roth IRA for completely tax-free growth tomorrow, what you're doing is placing an impenetrable dome over your crops. You're shielding them completely from the harsh elements of taxation.
And when it comes to retirement planning and maximizing your tax efficiency, please never leave an employer match on the table. I mean it. It is literally free water being pumped directly into your reservoir. It offers an immediate 100% return on your money right out of the gate, accelerating your retirement plan with just unmatched power.
Now we reach the advanced stage. Section 5, Advanced Wealth and Intelligence.
Here is where we stop just managing the river and start fundamentally changing the landscape itself. At this level, you aren't just relying on your primary paycheck anymore. By venturing into real estate investing, buying into REITs, or really leaning into business ownership, entrepreneurship, and side hustles, you're doing something incredible. You're carving out entirely new tributaries of passive income that flow constantly, day and night, straight into your main river.
Over in the stock market, your advanced strategy might be value investing, looking for deeply discounted assets. Or it could be growth investing, where you're chasing companies with rapid expansion. But regardless of your personal style, the ultimate goal is to buy assets protected by deep economic moats. Think of moats as these massive, uncrossable fortresses. It could be a universally loved brand name or exclusive patents, but it defends a company's cash flow from aggressive competitors.
But to build those fortresses, you need advanced financial intelligence. True mastery means understanding market cycles and, frankly, mastering your own wealth psychology. That means you don't panic sell when the financial weather gets rough. Behavioral finance teaches us that human emotion is actually the biggest threat to investing. By making rational choices and executing tight portfolio management, your ecosystem cascades into lasting, generational wealth.
Which brings us to our final step, Section 6. The Financial Freedom Blueprint.
Let's tie all 50 points together into the ultimate, perfectly functioning ecosystem. Let's trace the complete journey. Watch how it starts as a raw paycheck, gets safely channeled through your banking walls, is magnified by your tax-advantaged greenhouses, accelerates through advanced investment vehicles, and finally, culminates into an absolute ocean of generational wealth.
This quote really captures the whole shebang. Financial mastery isn't about hoarding money, it's about directing the natural flow of your resources to cultivate a life of total freedom. It's all about working with the natural flow, not fighting endlessly against it. You aren't hoarding stagnant puddles of money, you are engineering a mighty, self-sustaining river.
So I want to leave you with a thought to ponder about your own ecosystem. If cash flow really is an immense natural river, where exactly is yours flowing right now? And more importantly, what is it actively watering?
Think about every credit card offer, every mortgage rate, every 401k brochure you've ever come across. What if every single piece of the American financial system is really just a lever designed to impact one highly guarded number, your net worth? Today, we're doing a deep dive, a net worth explainer, American style, demystifying exactly how these levers connect and how you can pull them to your absolute advantage.
Okay, so here's our roadmap for today. We're breaking this whole thing down into 5 parts.
1. Foundations of net worth. 2. Navigating credit and debt. 3. Investing and building assets. 4. American tax advantage strategies. And finally, Part 5, the financial freedom blueprint. Let's get into it.
All right, diving right into Part 1, Foundations of Net Worth. So before we can actually play the game, we have to deeply understand the financial scorecard. And the golden rule of personal finance is beautifully simple. Your net worth is literally just the total value of your assets minus your liabilities. Basically, everything you own minus everything you owe. This single equation is the ultimate unfiltered measure of your financial success. It completely cuts through the noise of, what kind of car you drive or the square footage of your house.
Now, this brings us to a massive myth that trips a lot of people up: the difference between income and wealth. Listen, a high income does absolutely not automatically equal high wealth. You could literally make $1 million a year, but if your lifestyle costs $1,001, your wealth is actually decreasing. Income is just what you earn, but wealth, and ultimately your net worth, is what you actually keep.
And the way you keep that wealth is by mastering this foundational tug of war that is happening within your finances every single day. Think of it like this. Assets are things that put money into your pocket. We're talking investments, real estate, cash. Liabilities, on the other hand, take money out of your pocket. Loans, credit card balances, debt. If you want your net worth to go up, you need that asset side pulling way, way harder than the liability side.
Now, to make sure your assets are winning, you've got to have your core money foundations locked in. Basic checking and high-yield savings accounts are there to manage your daily cash flow. Then you have your emergency fund, ideally 3 to 6 months of living expenses. That is your absolute shield against unexpected shocks, like a random medical bill or a sudden job loss. Add in a solid working budget, and you're protecting yourself from quiet wealth killers like inflation. Because if your money is just sitting under a mattress somewhere, inflation is slowly eating away your purchasing power year after year.
Moving right along to Section 2, Navigating Credit and Debt.
Okay, so the American debt and credit machine heavily influences the liability side of our equation. And having a pristine 800 credit score, that acts as your American financial passport. A clean credit report unlocks the absolute best interest rates available in the entire market. Just to put that into perspective for a second, over a standard 30-year mortgage, having a top-tier credit score can literally save you tens of thousands of dollars compared to an average score. It is just this massive, invisible shield protecting your net worth.
But look, we have to demystify our liabilities here, because not all debt is created equal. Good debt, like a mortgage, is tied to an asset, your home, that generally appreciates over time and helps you build equity. But contrast that with bad debt, like credit cards or auto loans. Those aggressively drain your net worth with sky-high interest rates and rapidly depreciating value. The playbook here is really simple. Leverage the good debt and ruthlessly eliminate the bad.
Which brings us to Part 3, Investing and Building Assets.
Wall Street can honestly seem like this incredibly complex alphabet soup of financial jargon, right? Stocks, bonds, mutual funds, ETFs. But at their core, these are just simple, everyday tools. When you buy an index fund, for example, you are basically buying a tiny piece of ownership in hundreds of different businesses all at once. You're acquiring an asset that actively goes to work for you, often generating regular cash payments called dividends. You absolutely do not need an advanced finance degree to do this. You really just need to start participating. And participating as early as humanly possible is the ultimate secret. The difference between investing for 10 years versus 30 years isn't just triple the money, it is incredibly exponential. This is the absolute magic of compound growth and the time value of money. It's not just your money making money, it's your money's money making more money. Time is, for sure, your absolute biggest advantage when it comes to investing.
Of course, investing isn't just a straight line up. The market constantly fluctuates. And that's exactly why you have to balance risk versus reward. You do this by putting up safety rails, like asset allocation, which just means not putting all your eggs in one basket, and dollar cost averaging. Dollar cost averaging simply means investing a set amount of money on a regular, predictable schedule, completely regardless of what the market is doing that day. It takes all the panic and emotion right out of investing, and it protects you from the basically impossible task of trying to perfectly time the market.
Now, once you have those fundamentals down, Americans have some incredibly diverse, advanced ways to build massive assets. Beyond just basic index funds, you can dive into real estate investing or REITs. You can explore business ownership, entrepreneurship, or setting up side hustles for that sweet passive income. You can even refine your stock strategy by hunting for companies with strong economic moats through value or growth investing. Honestly, your options for building up that asset column are practically limitless. All right, let's get into part 4, American tax advantage strategies. So building up those assets is really only half the battle. We also have to protect them from the taxman. The American system offers these really distinct legal shields specifically designed for retirement planning: the 401k, the traditional IRA, and the Roth IRA. A 401k and a traditional IRA give you an upfront tax break today, meaning you keep more money in your pocket right now. A Roth IRA, on the other hand, taxes you today, but all that glorious compound growth we just talked about, it becomes completely tax-free when you pull it out in retirement. Choosing the right shield for your situation can legally save you hundreds of thousands of dollars over your lifetime.
And while we're on the topic of the 401k, here is one of the biggest open secrets in personal finance: the employer match. Every single year, Americans leave billions of dollars on the table by ignoring this. If your company matches, say, 5% of your salary, that is literal. Zero risk, completely free money. If you aren't contributing enough to get that full match, you are quite literally leaving a massive chunk of your compensation behind. It's an instant, guaranteed return that permanently boosts your net worth. Don't skip it.
Finally, Section 5, the Financial Freedom Blueprint.
Achieving real financial freedom isn't just about spreadsheets and checking your account balances. Protecting your hard-earned net worth actually requires advanced financial intelligence. You have to master your own wealth psychology and really understand behavioral finance. Because markets will go up and markets will inevitably crash, those are perfectly normal market cycles. Your ability to manage your portfolio and, honestly, more importantly, manage your own emotions during those wild swings, that is exactly what separates the people who stay wealthy from the people who lose it all.
So here it is, the ultimate financial freedom blueprint, bringing all these uniquely American financial tools into perfect harmony. Step 1. Optimize your cash flow and build that emergency fund to protect against life's random shocks. Step 2. Ruthlessly manage your credit score and eliminate bad debt so your liabilities shrink. Step 3. Invest consistently to capture that compound growth and build your assets. And Step 4, run all those investments through tax-advantaged accounts to maximize your efficiency. When you execute these 4 steps simultaneously, I promise you, your net worth becomes an unstoppable force.
Which leaves us with one final, incredibly important question. Once you master this playbook, what is the ultimate purpose of your generational wealth? Seriously, what are you building all this for? Is it for your kids, for charity, or maybe just for the simple freedom to spend your Tuesday mornings exactly how you want to? Mastering your net worth isn't about hoarding cash, it's about buying freedom. So go calculate your own net worth today and start pulling these levers.
Okay, let's dive into this. Welcome back, focused learners. Today we're breaking down a force that literally shapes every single financial decision you make, whether you realize it or not. We're going way beyond the basics to decode a highly specific and honestly often completely misunderstood concept: inflation. We aren't just going to sit here and define it. We're going to deconstruct exactly how the top 1% actually use it to their absolute advantage. So let's get into it. I want you to really think about this for a second. Is inflation quietly stealing your financial freedom, or are you actively using it to build long-term wealth? Because, in the modern economy, there's really no neutral ground. You're either on the losing side of this equation or you're on the winning side. For most people, inflation is just this terrifying news headline. But for the financially educated, it's a highly predictable mechanic of the system. Understanding this dual nature is absolutely crucial. It's literally the foundation of your financial future. Here is our roadmap for today's explainer. First, we'll diagnose the hidden wealth problem. Second, real-world economic impact. Third, how the wealthy operate. Fourth, avoiding common financial mistakes. Fifth, practical steps for beginners. And finally, number 6, achieving long-term financial freedom. All right, jumping right into Section 1, the hidden wealth problem. Before we can solve this issue, we really have to frame it properly. Unchecked inflation steadily erodes your purchasing power. It essentially acts as a hidden tax on the American household. Think about it like this. If you lock $10,000 in a safe today and just leave it there for a decade, the physical bills, they'll remain exactly the same. You haven't lost a single physical dollar. But what those dollars can actually buy, the groceries, the real estate, the energy, has severely diminished. It's a modern economic trend that silently but surely punishes anyone who's just relying purely on hoarding cash in a traditional savings account. Let's move to Section 2 and see how this builds. Real-world economic impact. So here's a crazy fact for you. Did you know a single dollar in 1913 had roughly the same buying power as $30 today? That is the concrete reality of what we're dealing with here.
By definition, inflation is the general increase in prices and the continuous fall in the purchasing value of money over time. Put super simply, your dollar buys less tomorrow than it does today. Establishing this baseline truth is so critical because every advanced strategy we're about to cover is engineered specifically to counteract this exact math. And this brilliantly illustrates exactly what we mean when we talk about the real world. This isn't just some abstract economic theory. Across the US, everyday American households are feeling the pinch on their daily living costs, right? Startups and entrepreneurs are suddenly navigating way higher operational expenses, forcing them to run leaner. Major companies are constantly adjusting their pricing models just to protect their margins. And honestly, perhaps most critically, everyday people are having to completely recalculate their retirement planning because the target number they thought they needed? Yeah, it's shifting further and further out due to these ongoing economic trends. Which brings us to Section 3, how the wealthy operates. This is where the whole narrative flips. Think about this perspective. Wall Street, Warren Buffett, and top real estate investors don't just survive inflation, they use it as a tool for wealth creation. The financially elite do not view inflation as a penalty. They view it as a rule of the game. When prices rise across the board, the people who actually own the assets that are rising in price are the ones getting richer. They apply wealth-building mechanics to what everyone else considers an absolutely insurmountable economic problem. Let's break down how this actually works in practice. Notice how real estate investors leverage debt to hold hard assets. Because inflation makes money worth less over time, the debt they owe actually becomes cheaper to pay back, all while their property values soar and generate passive income. It's a win-win for them. Meanwhile, entrepreneurs, they utilize pricing power. As their costs go up, they just raise prices, scaling their business for long-term success. And Wall Street, well, they park their capital in equities and diversified portfolios. They own pieces of those exact companies that are raising prices, securing their financial freedom. They are out there playing offense while everyone else is just playing defense. Moving right along to Section 4, avoiding common financial mistakes. So the crucial point is, if you want to join the ranks of the successful, you have to recognize the beginner traps. Hoarding cash under the illusion of safety, completely ignoring passive income streams, and being paralyzed by the fear of market volatility, that practically guarantees your purchasing power shrinks. The advanced approach, on the other hand, is about acquiring appreciating assets, leveraging strategic debt, just like we saw with those real estate investors, and investing heavily in business. One side is a sinking ship, guys. The other, that's your engine of wealth creation. Let's get into Section 5, practical steps for beginners. So how do you actually start applying this to your own life today? Let's walk through these highly actionable steps. Step 1, educate yourself continuously. You really need to treat personal finance and investing principles as a lifelong study. Step 2, and this is honestly the biggest hurdle for most people, shift your mindset. You have to move away from purely saving cash and pivot towards strategic wealth creation. Stop asking, how can I save, and start asking, what assets can I own? And finally, Step 3, begin actively exploring passive income streams or look into startup and business opportunities where you have some pricing power. You don't have to be Warren Buffett tomorrow for sure, but you do need to start moving your capital into assets that outpace that silent tax. And that leads us to our final section, Section 6, achieving long-term financial freedom. Now, what's really interesting about these key takeaways is how they form a complete long-term wealth-building system. The blueprint is clear. You must recognize inflation as a rule of the game, not just a penalty. You absolutely must avoid the trap of letting your hard-earned savings just sit there and depreciate in a checking account. You need to adopt the advanced insights of top investors, owning equities, real estate, and businesses. And most importantly, you have to take practical steps today toward passive income and asset ownership. This right here is your structured system for navigating the modern economy. Master the concept of inflation to build long-term wealth, secure true financial freedom, and engineer a better future. At the end of the day, money is just a tool, and inflation is simply the environment in which that tool operates. When you truly understand the environment, you stop being a passenger and you start being the architect of your own life. So we are diving deep into the American Financial Mastery Roadmap. And listen, we're going to uncover exactly how you can protect and, more importantly, multiply your absolute most critical asset. You know, a lot of people think personal finance is just about hoarding as many dollars as possible. But today, we are completely flipping that script. We're looking at a comprehensive system designed to secure your financial independence, not just by counting money, but by mastering the true metric of wealth. So I've got to ask, is your money shrinking while you sleep?
Because understanding this invisible, everyday threat to your wallet is absolutely step one toward financial independence. Think about it like this. If you stash a crisp $100 bill under your mattress today, yeah, you'll still have a physical $100 bill 10 years from now. The paper doesn't change. But what can it actually buy you a decade later? Thanks to the silent drain of the economy, it might only grab you about $50 worth of goods. All right, so here is our step-by-step roadmap to actually saving your money. We're going to start with the foundations, move right into defending cash and credit, skate things up to investing to beat inflation, talk retirement and tax advantages, touch on advanced wealth building, and finally, bring it all together into your ultimate blueprint. Let's get right into it. Starting with Section 1, the Purchasing Power Foundation and the core conflict, it is time to establish exactly what we are fighting for here. The crucial point to understand is that true financial success, it isn't about the raw number of dollars sitting in your account. It's all about your purchasing power, how much actual value those dollars retain. Purchasing power is the tangible value of your money. It's the groceries in your cart, the gas in your tank, keeping the roof over your head. If your bank balance goes up, but your actual purchasing power goes down, well, you're actually moving backwards. And that brings us face to face with its absolute nemesis, inflation. Inflation is literally a silent thief, and it is constantly draining the value of your cash while you aren't looking. It's the underlying engine driving prices up and pushing your purchasing power way down. So when we talk about cash flow, budgeting, or net worth, we're not just doing math for the fun of it. We are building a fortress to keep this thief out. To truly defend yourself, you have to ruthlessly divide your financial world into two buckets: assets and liabilities. It's simple, right? Assets put money, and therefore purchasing power, into your pocket. Liabilities pull it right back out. If you spend your life accumulating things that just lose value or require constant maintenance, you are essentially handing over your wealth willingly. And this brings us to a massive misconception: income versus wealth. Look, a high income guarantees absolutely nothing if every single dime you make is drained by massive liabilities. You could make $1 million a year, but if you spend $1,000,001, your purchasing power is zero. Nothing. It's your accumulated wealth built by stacking positive cash flow and solid assets that actually protects you against the changing tides of the economy. Moving into Section 2, defending cash and credit. Let's look at how your everyday banking as your very first line of defense. Okay, so you know you need an emergency fund, but where you park that cash matters immensely. If you just leave it in a standard checking account earning, 0.01%, inflation is eating it alive. A high-yield savings account acts as a critical buffer. Sure, it might not entirely beat inflation, but it acts like a tourniquet. It significantly slows down the bleeding of your purchasing power, preserving the true value of that safety net. Next up is your credit. Optimizing your credit score actually unlocks good debt. Think mortgages or low-interest auto loans that free up your capital to do other things. On the flip side, bad debt, like high-interest credit cards. If you're paying 20% interest on a new pair of sneakers, you are actively setting your future wealth on fire. A strong credit report is basically your VIP ticket to accessing favorable terms and protecting your cash flow. Let's hit Section 3, investing to beat inflation. This is where we transition from simply playing defense to aggressively multiplying your value. If you want to actually increase your purchasing power over a lifetime, you need a balanced asset allocation. By diversifying across stocks for high growth, bonds for stability, and real estate for that tangible value, you spread your risk out. And this is absolutely critical for generating returns that outpace the constantly rising cost of living. You simply have to put your money into vehicles that historically grow faster than inflation. What's truly wild to realize is that compound growth is your absolute strongest weapon to outrun inflation over the long haul. While cash basically remains flat and inflation just steadily rises and makes everything cost more, compound growth curves upward exponentially. It's what happens when your returns generate their own returns. It is literally the only mathematical phenomenon powerful enough to leave inflation completely in the dust. So how do you actually capture that growth? Well, you utilize tools like index funds and ETFs, which bundle together hundreds of top-performing stocks. And you make sure to reinvest those dividends they pay out. Combine that with dollar-cost averaging, meaning you consistently invest a set amount, totally ignoring whatever chaos the market is up to, and you smooth out your risk. You're constantly converting depreciating cash into appreciating assets. Moving on to Section 4, retirement and tax advantages. Here's how we shield your wealth to ensure the government doesn't unnecessarily erode the purchasing power you've worked so hard to build. You know, taxes are going to be one of your largest lifetime expenses, period. But accounts like 401ks, Roth IRAs, and traditional IRAs allow your investments to grow either tax-deferred or entirely tax-free. And hey, if your company offers a 401k match, you take it, always. That is essentially collecting free purchasing power. It's a guaranteed 100% immediate return on your money before the market even opens. Let's dive into Section 5, Advanced Wealth Building Strategies. These are the moves for those of you ready to create real economic moats and generate generational wealth. Up to this point, we've really relied on savings and the stock market. But true advanced wealth? That comes from building multiple streams of passive income. When you own a business, invest in real estate, or build up dedicated side. I am thrilled you're tuning in today because honestly, we're looking at something that is going to fundamentally change how you view your money. For decades, traditional financial advice has pitched the concept of an emergency fund as this dusty, boring savings account, something you just kind of reluctantly keep around just in case your car breaks down or, your roof springs a leak right over your favorite couch. But today, we're diving into the source material to transform this basic emergency fund from a defensive necessity into a highly dynamic, premium tool for wealth creation. We're going to completely deconstruct the emergency fund and rebuild it as a strategic blueprint for your financial independence. Let's get into it. So, let me ask you a start question. Are you one emergency away from financial ruin? It's a harsh reality check, right? In today's landscape of crazy economic trends, we're talking sudden market shifts, unexpected tech layoffs, just everyday unpredictability. A lot of ambitious American households are unknowingly walking a tightrope, and they don't have a net. You might have a fantastic income, maybe even a growing investment portfolio. But if a sudden, massive expense hits out of nowhere, are you truly insulated? Or are you literally one unexpected event away from watching your carefully built financial life just unravel? That high-stakes vulnerability is exactly what we are going to solve today. Here is our roadmap for today's explainer. 1. The Ultimate Wealth Foundation. 2. Real-world wealth building. 3. Fatal financial mistakes. And 4. Your actionable wealth blueprint. Okay, let's dive right into this with Section 1, the Ultimate Wealth Foundation. The source material actually redefines the emergency fund as a strategic capital reserve. We are entirely reframing this concept away from the boring, defensive, flat tire fund. Instead, I want you to think of it like a financial moat. Just like a castle needs a massive moat to protect its valuable interior from outside attacks, your ambitious financial goals need a moat of liquid capital. This reserve is the barrier that absorbs the shocks of life, so your long-term investments, your stocks, your businesses, your real estate, they can remain completely untouched and just continue to compound and grow over time. Now, check out the sheer contrast in mindsets here. On the left side, the average household views cash savings as this begrudging necessity, right? They're saving for a flat tire, a broken water heater, a rainy day. It is entirely reactive. But look on the right. Here you see the approach of wealthy investors and high-level Wall Street professionals. They view an emergency fund as a strategic asset. They aren't just saving for a rainy day. They are building that liquidity moat. This ensures that when an emergency happens, it's merely an inconvenience, not an absolute catastrophe. And more importantly, it positions them to swoop in and take advantage of opportunities when everybody else is panicking. Moving right along to Section 2, Real-World Wealth Building. This is the offensive power of cash in action. Think about it. Warren Buffett doesn't sit on billions because he's afraid. No way. He holds what Wall Street calls dry powder, so he can capitalize and buy assets at a massive discount during market dips. Startups use an emergency fund as a cash runway so they can survive unexpected funding winters without going bankrupt. Real estate investors? They use reserves to cover sudden property vacancies without defaulting on their mortgages. Even major companies use liquidity to weather modern economic shifts and just outlast their competitors. Every single one of them uses a strategic reserve not just to survive, but to win. The source material makes such a powerful point here. Luxury through freedom, not flashy spending. True wealth isn't about the flashy car or the designer clothes, it's about options. The ultimate purpose of an emergency fund, this strategic reserve, is to buy you freedom. When you have a fully funded financial moat, you have the freedom to walk away from a toxic job. You have the freedom to take a calculated risk on a new business. You get the peace of mind to sleep deeply at night knowing your journey toward passive income is totally protected. And honestly, that kind of freedom is the ultimate luxury. All right, let's get into Section 3. Fatal financial mistakes. Just look at the impact of an emergency here. On the left, the prepared portfolio experiences a shock, right? But the investments remain untouched. They maintain stable growth because the emergency fund just absorbed the hit. But on the right, yikes, the unprepared portfolio gets absolutely decimated. Why? Because of forced liquidation. If you lose your job and you have zero cash, you're forced to sell your stocks or crypto just to pay rent. And emergencies usually happen during economic downturns, meaning you are forced to sell your assets at the exact worst possible time, at a steep loss. You completely interrupt the magic of compound interest. It's a total wealth killer. So the crucial point here is zero. That is the exact amount of strategic leverage you have when you lack a cash reserve. Literally, zero. When you have no liquidity, you are at the absolute mercy of your employer, the overall economy, your landlord, and the banks. You can't negotiate, you can't pivot, and you certainly cannot invest in new opportunities. You are backed into a corner, and that is exactly the scenario we are building a blueprint to avoid. Which brings us to Section 4, your actionable wealth blueprint. Okay, here is the blueprint step by step. Step 1, ruthlessly calculate your essential household expenses. Now, actually, scratch that. I don't mean your lifestyle expenses. I mean, what does it cost to just keep the lights on, keep a roof over your head, and put food on the table? Step 2, you take that bare minimum monthly survival number and multiply it by 6 to establish what we are calling the 6-month freedom baseline. That's 6 months of pure liquid capital sitting in a high-yield emergency fund. Then, step 3 is where you customize. You scale this baseline up depending on the level of risk in your personal career or your investment portfolio. As you'll see here, this foundational emergency fund strategy scales up depending on your specific path. For example, if you're an entrepreneur, your income is naturally going to be volatile, so your strategic need jumps to a 6 to 12-month personal and business runway just to ensure survival. If you're in real estate, well, you need dedicated CapEx, or capital expenditure reserves, to ensure property stability for when, a roof inevitably caves in. And if you're an active stock market investor, you need that Wall Street dry powder to achieve your goal of buying the dip. The foundational strategy is the exact same, but the execution adapts to your ambition. To summarize everything we've uncovered in the source material today, mastering the concept of the emergency fund, your strategic capital reserve, is absolutely non-negotiable. It is the prerequisite to building long-term wealth. Without it, your financial house is basically built on sand. But with it, you buy yourself the breathing room and the structural integrity required to pursue genuine financial freedom and a secure, prosperous future. It's the ultimate defense that allows you to play a massive offense. I want to leave you with this final provocative thought. Take a hard look at your own life, your own portfolio, and your own ambitions. If a major economic shock hit tomorrow, are your assets actually protected? What exactly will your financial moat protect tomorrow? Build your reserve, protect your future, and secure your freedom. You have to ask yourself, what does it actually take to build a binge-worthy documentary-style finance explainer? Well, it definitely doesn't happen by accident, and it certainly isn't just about throwing numbers and spreadsheets up on a screen. It requires a meticulous, psychological blueprint. You see, the WealthOS framework treats a budgeting system not as this mundane chore you have to do every month, but as a cinematic journey. It's really about optimizing for long watch times, building immense authority with the viewer, and delivering an education that just feels incredibly premium. To really understand this blueprint, we're going to break it down into 5 key areas. First, defining our ambitious target audience. Second, crafting a premium visual identity. Third, the 10-step narrative formula. Fourth, grounding the concepts in real-world American examples. And finally, delivering the ultimate wealth message. Okay, starting with part 1, the ambitious target audience, and how we define that focused viewer. This blueprint demands a highly ambitious mindset from its target demographic. We're talking about core interests in things like personal finance, wealth creation, financial freedom, passive income, and startups. And honestly, this tells us absolutely everything we need to know about how to pitch a budgeting system to this specific group. Our viewers, they are not looking for quick penny-pinching tips to save a couple of bucks on their weekly groceries. No, they are ambitious Americans who are hungry for deep business insights. So for this audience, a budget and system actually has to be framed as the foundational engine for all of those higher-level goals. It's literally the tool that unlocks long-term success. Moving right along to step 2, a premium visual identity, or the aesthetic of wealth. The blueprint enforces a very strict mandate here. The visuals must project luxury through freedom rather than flashy spending. Because think about it, when you're explaining a budgeting system to an ambitious audience, the visuals can't look cheap, right? But they also have to avoid looking gaudy or materialistically distracting.
True wealth, according to this specific framework, isn't about buying a shiny new sports car or a massive gold chain. It's about buying back your time and your freedom. And that key psychological distinction really dictates the entire visual tone and the emotional resonance of the whole explainer.
Now, to achieve that exact tone, the framework relies on strict visual mandates. We're talking about a signature green and black aesthetic, paired with really clean, minimalist, Apple-style visual layouts. Notice the atmospheric elements they require, too: cinematic city skylines and moody Wall Street environments. When you take modern, sleek finance data visualizations and combine them with these emotional storytelling moments, wow, it elevates a standard, potentially boring lesson on budgeting right into a premium, documentary-quality experience. This specific combo projects absolute authority, and it's heavily optimized to keep viewer watch time exceptionally high.
All right, part 3. This is the meat of it, the 10-step narrative formula for structuring the explainer. So take a look at this. This is the core architecture, an unyielding 10-step formula. You don't just jump in and start listing out budgeting categories. You start with step 1, a powerful hook that creates massive curiosity and immediately tells the viewer why this matters. Then, step 2, you introduce the problem. Only then do you hit step 3, the actual explanation. From there, you ground it in a real-world example, apply it to wealth building, warn them about common mistakes, drop an advanced insight to reward the experts watching, and provide practical action steps for the beginners. Finally, you wrap the whole thing up with key takeaways and a strong closing message. This sequential journey is mathematically engineered to keep you engaged from the very first second to the last.
Now, if we zoom in on that broader structure, step 3, the core explanation, requires us to meticulously navigate these specific components. We have to define the budgeting concept and why it's important, but then we immediately pivot to the common mistakes people make. We integrate real-world examples, and this is crucial. We highlight how wealthy people use this exact budgeting system concept. The script has to be incredibly clear and beginner-friendly, offering those practical action steps while cleanly bridging the gap by dropping advanced insights for the more experienced viewers. It's basically a completely comprehensive A to Z educational package.
Which brings us to section 4, real-world American examples and why grounding the data is so important. Look, a budgeting system explainer could easily become way too theoretical, right? It can feel totally disconnected from everyday reality. So to prevent that, the WealthOS blueprint strictly dictates the use of highly realistic US-based touchpoints. The narrative actually must integrate examples like typical American households, Wall Street dynamics, major companies, and legendary investors like Warren Buffett. It also mandates tying the concepts back to entrepreneurs, startups, real estate investors, retirement planning, and modern economic trends. By anchoring the mechanics of a budget to the proven strategies of billionaires and major corporations, the information just resonates so much deeper. It proves to the ambitious viewer that this isn't just theory, this is how the real world of wealth actually operates.
And finally, part 5, the ultimate wealth message and closing with impact.
The ultimate goal of the entire explainer boils down to this one clear mandate: summarize the lesson and explain how mastering this concept helps people build long-term wealth, financial freedom, and a better future. The end game here is not just to inform someone about how to balance a spreadsheet. No, the goal is to genuinely empower the viewer. You're trying to leave them with a powerful, cinematic conclusion that reinforces one core belief: mastering a budgeting system is the ultimate key to unlocking true financial freedom. It has to end on a note of high emotional impact and massive possibility. So, what does this all mean for you? I want to leave you with this final provocative thought. How will you apply this cinematic 10-step framework to build your own compelling narrative? Whether you're designing your own personal budgeting system to achieve financial freedom, or maybe you're a creator trying to explain complex topics to your own audience, how can you leverage this high-end, highly structured media architecture to achieve your goals?
Okay, today we're unpacking a really comprehensive blueprint that basically decodes the actual mechanics of true wealth creation. We're going to cut right through all that noise, the daily stock tickers, those super flashy social media feeds, and we're going to look at the deep architecture of financial independence. So let's jump right in and look at the ultimate financial goal, how you actually go about buying back your own time.
Let me ask you a question right out of the gate. When you hear the words financial freedom, what's the very first image that pops into your head? For a lot of us, it's, a massive mansion, a fleet of sports cars, maybe even a private jet. But let's be honest here, right? A massive mansion often just means absolutely massive property taxes or, a broken boiler that you have to fix on a Sunday. And the data actually tells a completely different story. Nearly a third of lottery winners eventually go entirely broke. Why? Because they associate wealth purely with high-end consumption. And if you do that, you're literally trapping yourself in the exact cycle you're trying to escape. True financial independence actually looks quite different from what society kind of conditions us to believe. Think about the stark contrast between two very different mindsets here. On one hand, you've got flashy spending. This is the trap, right? This is upgrading your lifestyle the literal second you get a raise, or buying a depreciating luxury car that costs an absolute fortune to insure, and essentially chaining yourself to a massive monthly overhead. I mean, it looks like wealth, but it's really just financial fragility wrapped in a designer label. Now contrast that with true luxury. Luxury through freedom. True wealth isn't about the presence of expensive, flashy stuff. It's the absence of financial anxiety. It's the ability to wake up and have total 100% autonomy over how you spend your day. It's a huge, profound shift in mindset from just appearing rich to actually being financially independent.
Okay, let's dive into this and clearly define our terms. At its core, financial independence is the state of accumulating enough personal wealth and passive income to cover your living expenses without having to rely on active employment. Now, that's the textbook definition, sure, but let's break it down into reality. What it really means is that your money works for you, rather than you working for your money. Your investments, your equity, your passive income streams, they generate enough cash flow to pay for your housing, your food, your insurance, the whole shebang. And once that crossover point happens, active employment becomes purely optional. You've essentially just bought your life back.
To understand how people actually achieve this, we really need to trace the evolution of American wealth creation over the last few decades. The vehicles, well, they change, but the core principles remain exactly identical. Think back to the shoulder-padded 1980s. We saw the massive Wall Street boom, all about equities and aggressive market participation. Then you move into the 2000s, and flipping real estate became the go-to vehicle for the everyday investor. After that, the 2010s brought the startup era, where tech equity and scalable digital businesses minted a completely new generation of wealth. And today, sitting here in the 2020s, we're squarely in the era of modern passive income, leveraging digital assets, diverse portfolios, and decentralized opportunities. So while modern economic trends shift constantly, the foundational math of acquiring cash-flowing assets, that never does.
So how is this actually executed across different levels of finance? When you map it all out, the playbook is incredibly consistent. Whether you look at everyday American households using index funds for basic retirement security, or someone like Warren Buffett deploying value investing to build massive generational wealth, or even major startups scaling equity to disrupt entire markets, they're all doing the exact same thing. Seriously, they are acquiring and holding on to assets that compound over time. It's really not about finding some secret magic trick, it's about applying that core strategy at whatever scale you're currently operate at.
Let's zoom in on one specific name I just mentioned, because his approach basically perfectly summarizes this entire explainer. Warren Buffett's core principle is elegantly simple. Acquire assets that organically produce long-term value rather than liabilities that drain it. Simple, right? Yes, but also surprisingly difficult for most people to actually execute. Look, an asset puts money in your pocket. A liability takes money out of your pocket. The absolute secret to long-term success isn't outsmarting the market every single day. No way. It's just a relentless, disciplined focus on accumulating assets while aggressively minimizing those liabilities.
Which brings us to a rather uncomfortable question. If the math is so incredibly simple, and the principles are so crystal clear, why do so many smart, ambitious people stay trapped in the financial cycle? I mean, we see doctors, lawyers, high-earning corporate executives making incredible salaries, yet they're living paycheck to paycheck, absolutely terrified of losing their jobs. So what gives? Why doesn't a high income automatically translate to true financial independence?
Well, the answer generally lies in 4 massive money mistakes. First off, relying solely on earned income. If your only source of money is trading your hours for dollars, you have a hard ceiling you can literally never break through. Second, and this is the killer, lifestyle inflation. You get a $10,000 raise and boom, you suddenly sign a lease for a car that costs exactly $10,000 more a year. Third, ignoring modern economic trends. This is basically sticking your head in the sand while inflation quietly just eats away your purchasing power. And finally, the absolute biggest trap of all, confusing high income with actual wealth. Remember, income is just what you make, wealth is what you keep and grow.
Now, what's really interesting about this income breakdown is how it completely flips the script on the flow of money. When you look at the profile of truly financially independent individuals, you see a massive 60% slice of their cash flow that is purely passive income. Another 30% is coming from business equity or startups, really capturing the value of what they build. And only a tiny 10% comes from earned income, their actual active salary. This is the ultimate mindset shift from employee to owner. They've built an economic machine where their investments do all the heavy lifting,
completely detaching their actual survival from their daily labor.
And this brilliantly illustrates how this transition happens over a long-term horizon. Think about year one of your journey. Earned income is doing all the heavy lifting, and passive income is just a tiny, almost invisible sliver. Honestly, it feels slow. It kind of feels like it isn't even working. But fast forward to year 10, and you see that passive stream steadily rising as your investments start to really compound. Then by year 20, explosion. The passive income has exponentially overtaken active labor. This right here is the cinematic compounding power of patience. It's not some sketchy get-rich-quick scheme. It's an architectural build that requires decades to fully mature for sure. But the end result? Absolute financial independence.
So, the big question. How do we start building this architecture today to secure your own financial independence? Well, here is a highly practical, step-by-step action blueprint. Step 1. Audit and optimize your spending. You've got to cut out those flashy traps we talked about earlier. Step 2. Build a rock-solid emergency buffer. You just cannot invest confidently if you're one surprise medical bill away from total ruin. Step 3. Invest in broad market assets. Harness that modern economic machine, just like those American households and Wall Street investors do. And finally, Step 4. Develop scalable passive streams. Whether it's real estate, digital businesses, or a solid dividend portfolio, you need to start planting the seeds right now that will eventually grow into that massive, compounding passive income we just talked about.
Because at the end of the day, when you strip away all the data, the timelines, the asset classes, and all those complex investment vehicles, you are left with exactly one thing. One primary metric of success. Actually, scratch that. It isn't your net worth. It isn't your credit score. It certainly isn't the zip code you live in. The absolutely only metric of true financial independence that actually matters is time. Mastering your own time is the ultimate dividend of wealth.
Which leaves us with one final, kind of provocative thought to take away from this explainer. I want you to look at your daily habits, your monthly spending, and your long-term goals and ask yourself honestly, are you building a lifestyle or are you building your independence? Because every single dollar you earn is a brick. You can use it to build a golden cage of luxury and liabilities, or you can use it to build a fortress of financial freedom. The blueprint is right here in front of you. The choice of what to actually build, well, that's entirely yours.
If you've been following financial strategies for any amount of time, you know there's an absolute mountain of information out there, right? I mean, everything from basic budgeting all the way up to advanced real estate. But today, we're clearing away all that noise. We are zeroing in on the single most pivotal concept that drives this entire 50-step journey. Today, we're going to thoroughly explain the time value of money. Because honestly, without a really deep understanding of this one specific principle, the rest of the roadmap just kind of falls apart. It doesn't connect. So let's jump right in.
Okay, quick question for you. Would you rather have $10,000 today or $10,000 in exactly 10 years? Now, I know what you're thinking. It feels like a total trick question, doesn't it? For anyone even slightly tuned into finance, the intuitive answer is obviously today. You want the cash in your hands right now. But the underlying mathematical why behind that answer is the absolute key to mastering wealth. It's really not just about human impatience. It's about the financial physics of how capital actually moves and morphs through time.
Okay, let's dive into this and look at the very beginning of our source material. Section 1, Navigating the Financial Roadmap.
Before we can even begin to talk about advanced portfolio management, economic moats, or generational wealth, we absolutely have to establish the bedrock. The roadmap lays out 10 foundational items to master first, starting from understanding basic cash flow and ending at budgeting systems. But sitting right there at the very end of this foundational section, acting as a sort of gateway, is the concept that changes absolutely everything about how you'll handle capital. Here it is, item number 10 from the roadmap, the time value of money. It's the foundational principle that a dollar in your hand today is strictly worth more than a dollar promised to you in the future. And why is that? Well, because time is the ultimate lens through which we have to view our money. Money isn't just a static number sitting on a digital ledger somewhere. It has a real temporal weight to it. Having a dollar right now gives you immediate options, real potential, and an opportunity for growth that a future dollar literally just lacks.
Now, what's really interesting about this is how it charts the practical, step-by-step journey of a wealth builder. Understanding the time value of money isn't just some neat piece of trivia you pull out at a dinner party. It is the mandatory bridge you must cross. You start at step 1, mastering your basic money foundations. But you cannot truly unlock step 3, investing fundamentals, without crossing that step 2 bridge first. If you don't deeply, intuitively grasp how time fundamentally alters the value of capital, your investing won't be strategic at all. Honestly, it'll just feel like guessing.
So let's move along to our next phase, Section 2, the threat of inflation.
To truly wrap our heads around why time is such a critical factor, we've got to explore the devastating, silent forces that are actively attacking your idle cash. Because when we talk about the time value of money, doing absolutely nothing is not a neutral action. Sitting still is actually moving backward. When we compare money today versus money tomorrow, we see a massive, massive difference in utility. Money today has exceptionally high utility. You can deploy it instantly, use it to generate more value, or buy assets at today's prices. But money tomorrow? It has a severely eroded, weakened utility. Think about it. If you take that $10,000 we talked about earlier and literally stuff it under a mattress for a decade, the physical bills remain exactly the same, but the economic power behind those bills, it just rots away.
So the crucial point we need to focus on is item number 5 from our roadmap, inflation. Inflation is the invisible tax that is actively, continuously destroying your wealth over time. It is the primary reason why money tomorrow is mathematically and practically worth less than money today. It's this constant economic headwind you're walking against, 24 hours a day, whether you're actually paying attention to it or not.
Which brings us directly to item number 6 from the first section of our map, purchasing power. This defines what your money can actually buy out in the real world, at the grocery store, the car lot, the housing market. Just think about what a gallon of milk or a carton of eggs cost 10 years ago versus what they cost today. If inflation is the destructive force, purchasing power is the casualty. When inflation goes up over time, your purchasing power goes down. And this perfectly agitates the core problem we're talking about. If you leave your money completely idle, if you ignore the time value of money entirely, you are actively losing ground every single day.
Let's move forward to the solution. Section 3, the power of compound growth.
Thankfully, the roadmap doesn't just leave us stranded in the problem phase. This is where we learn exactly how to fight back. This is where we stop being a victim of time and instead force time to work for us. And this brilliantly illustrates the true battlefield of your personal wealth. We have the enemies of time, item 5, inflation, which we just discussed, and item 2, liabilities, which just continually drag you down. These are the forces draining your net worth as the clock ticks. But then we have the allies of time, item 2, assets, and the absolute heavy hitter, item 27, compound growth. The entire goal of financial mastery, the whole shebang, is to aggressively move your resources away from the enemies of time and strictly over to your allies.
Let's shine a massive spotlight on the real hero of our roadmap here, item 27, compound growth. This is that magical point when your money starts making money, and then, here's the kicker, that new money makes even more money. If inflation is the invisible tax stealing your wealth, compound growth is the invisible engine multiplying it. This is the ultimate solution where putting time on your side builds exponential, truly life-changing wealth. And naturally, the earlier you start, the more time you give this engine to rev up.
So you might be wondering what exactly fuels this compound growth engine. While the roadmap clearly lists the fundamental investing vehicles in Section 3 that allow you to practically harness the time value of your money. We are talking about foundational elements like item 21 stocks and item 22 bonds, stretching all the way to incredibly diversified tools like mutual funds, index funds, and ETFs. These are definitely not just random financial buzzwords thrown around on TV. These are the specific, battle-tested tools designed to help your capital outpace inflation and capture that sweet, sweet compound growth over long periods of time.
Let's see how this builds into a totally actionable, stress-free strategy with item 28, dollar cost averaging. You don't need to be some Wall Street genius who perfectly times the market. No way. Instead, you just follow 3 incredibly simple steps. Number 1, pick a set amount of money. Number 2, invest it on a strict, regular schedule. And number 3, just let time do the heavy lifting. By doing this, you are systematically leveraging the time value of money across all market cycles. You end up buying more when prices are low and less when they're high, completely removing pesky human emotion from the entire equation.
And finally, we arrive at our ultimate destination, Section 4, the Financial Freedom Blueprint. We've navigated the basic money foundations, we've confronted the very real mathematical threat of inflation, and we've armed ourselves with the core investing fundamentals of compound growth. And that brings us to the final chapter of the roadmap, the Financial Freedom Blueprint, how everything works together. Mastering the time value of money is literally the master key that unlocks this final chapter. It's the invisible thread connecting your earliest, most basic budgeting efforts directly to your most advanced portfolio management down the line. So I want to leave you with this final, provocative thought. Knowing what you know now about the relentless, totally unstoppable ticking of the clock, is your money actively working for you today, or is it just sitting there right now waiting to be worth less tomorrow?
Section 2, Banking and Credit. So before we start talking about, complex investment portfolios or compound interest, where does your financial journey actually begin? Like, what's the absolute starting line before you can invest, borrow, or build any sort of wealth? Most of us want to skip right to the fun stuff, but if we don't pinpoint this true origin point, the whole structure kind of risks collapsing later on. Okay, let's dive into this because it actually starts at step 11. Everything we're going to talk about today, literally every credit card, every loan, the whole shebang, it all rests entirely on establishing this one single cornerstone. If you don't get step 11 right, the rest of the financial ecosystem just completely locks you out. And here it is, number 11, checking accounts. Now, we really need to change how we think about this. A checking account, it's not just some digital bucket where your paycheck drops and your bills get paid. No, it's the ultimate central command station for your entire cash flow. Actually, scratch that. It's more like the engine of your financial liquidity. Every single move you make requires cash, right? And how you manage this specific account dictates your ability to handle risk, absorb economic shocks, and honestly, just survive day to day. If you're constantly running this account down to zero or getting hit with overdraft fees, you've got foundational cash flow instability. Mastering the daily flow of capital right here, building that cash buffer, that is the absolute bedrock. Without mastering the checking account, everything else is just fundamentally out of reach. Which brings us to step 12, savings accounts. But look, we have to view savings strictly through its relationship to that checking account we just talked about. Savings only really works when it acts as an overflow valve for your checking. By intentionally moving money out of the checking environment and parking it in savings, you're protecting your daily operations. You're keeping the checking account pure, focused only on active deployment, so that the command center never gets bogged down or accidentally drained. Let's move to and see how this builds. It's a super clear evolution. Step 1, you optimize your daily checking. Step 2, you siphon the excess into basic savings. And eventually, step 3, you graduate to item 13, high-yield savings accounts. This is where you fight inflation and grow wealth. But notice the pattern. You literally cannot capture those high yields if your checking account isn't efficiently capturing and categorizing your income in the very first place. All right, so once your everyday cash flow command center is rock solid, we enter the credit ecosystem. This is where things get interconnected. But here's the absolute kicker. Your ability to navigate this whole world of borrowing is just a direct reflection of how you manage your checking account. Lenders are literally just looking at your cash flow foundation to see if you can be trusted with their money. So, what's the gatekeeper here? It's item 14, credit scores. Your score dictates everything, your access to capital, your interest rates. But maintaining a pristine score requires, you guessed it, the cash flow stability from your checking account. A great credit score is basically just the mathematical output of perfectly managed cash flow. If your checking account runs dry, trust me, your credit score is going to collapse right behind it. And right behind that score is item 15, your credit report. This is the raw historical data, the ledger. Every single time you pay a bill on time, that positive mark is only made possible by the funds sitting securely in your checking account. Your credit report is basically just a long-term report card on your checking account discipline. Which leads right into item 16, credit cards. These are the daily tools that build up that history. But here's the reality check. A credit card is completely useless and honestly incredibly dangerous without a properly managed checking account backing it up. To win with credit cards, you've got to reliably pay that balance in full every month straight from checking. It's 100% tethered to your cash flow mastery. Okay, so once you've proven you can handle short-term credit cards with your steady cash flow, the progression moves directly into taking on debt. You're stepping into the big leagues of borrowing. But taking on structured debt puts massive, amplified pressure right back on that foundational checking account. Now, what's really interesting about this slide is the tension between good debt and bad debt. It's an absolutely crucial filter. Good debt uses other people's money to build wealth or boost your earnings, which ideally pumps more cash back into your checking account over time. Bad debt, it's the exact opposite. It's a permanent, destructive leak in your checking account. It drains your daily resources for things that lose value, actively sabotaging that foundation we worked so hard to build. So understanding that, we slow down and look at the structured progression of major life loans. And again, always remember, every single one of these structural loans demands a larger, more permanent flow of income directly out of your checking account. This sequence mirrors real life for a lot of us. First up, item 18, student loans, an early investment in your earning power that often leads to item 19, auto loans, because you need to get to that new job, right? And finally, the progression peaks at the ultimate milestone. Item 20, mortgages. So the crucial point is, a mortgage isn't just a big loan. It is the ultimate stress test of your checking account. Getting a mortgage means you've mastered every prior step. You used checking to build savings for the down payment, you maintained the credit report, you nailed the credit cards. It proves your central command station can handle massive liability over decades. If you're a focused learner, someone who really wants to master their money, you're in the exact right place. Today, we're going to set the stage to completely demystify the absolute bedrock, the true foundation of everyday personal finance. We're talking about the checking account. And specifically, we're going to zero in on the unique, kind of quirky mechanics of the American style. It's something pretty much all of us have, right? But honestly, very few of us actually stop to understand how it literally dictates our financial lives. So I want you to picture this right now. It's payday. You've worked hard, you've put in the hours, and boom, your company issues your payment. But where does that money literally make its very first stop? Like before the rent is paid, before the groceries are bought, before those 10 different streaming subscriptions automatically renew, where does that hard-earned cash actually land? Well, it doesn't drop into your pocket as a bag of gold coins, does it? No, it lands in a digital holding zone. Section 1, the Daily Financial Hub. Okay, let's dive into this, because truly understanding this holding zone, it completely changes how you view your money. We need to look at this account not just as some static, boring vault, but as the dynamic, pulsing center of literally everything you do financially. Think of your checking account as the grand central station of your personal finances. Picture a massive, bustling train terminal. You've got trains constantly arriving, right? That's your paycheck, maybe a Venmo transfer from a friend covering dinner, or, hey, a tax refund. And at the exact same time, you have trains constantly departing. Your rent check, the electric bill, or just typing your card for a quick cup of coffee. Money is continuously arriving and departing, all day, every day. Because of this nonstop traffic, this is absolutely, without a doubt, the highest traffic financial tool you will ever use in your entire lifetime. Section 2, defining the checking account. What is it exactly? Formally, a checking account is a deposit account at a financial institution allowing highly liquid withdrawals and deposits for everyday transactions. Now, I really want to emphasize those last two words, everyday transactions. That right there is the defining characteristic of this specific account. It's designed to be highly liquid, meaning the money flows super easily and without any weird restrictions. You aren't penalized for moving your money in and out on a random Tuesday afternoon just to buy a sandwich. It is built from the ground up to facilitate your daily life. Now, what's really interesting here is the clear contrast between a checking account and its sibling, the savings account. If checking is grand central station, savings is more like a long-term storage vault. Checking is for everyday spending. It offers very low or entirely zero interest, but it gives you incredibly high liquidity. Savings, on the flip side, is for long-term storage. It pays you higher interest to just keep your money sitting there, but it often limits how many times you can actually withdraw from it. This contrast proves that a checking account is built purely for action, not for resting. It's like the marathon runner of your financial portfolio, always on the move. Section 3, key American-style features. Let's look at those unique U.S. mechanics. So there are a few primary ways money moves around in the American system. First up, you have direct deposit, which is how most Americans receive their salaries seamlessly. Then you have debit cards, basically the plastic key to your digital cash. You also have ACH transfers, which is that invisible electronic network moving money between banks. But look at that third one, paper checks. This is such a fascinating cultural legacy. While much of the world has entirely abandoned the paper check, the American financial system actually still heavily relies on them. We use them for rent, paying contractors, small businesses, you name it. Your American checking account elegantly bridges the gap between these older 19th century paper traditions and instantaneous 21st century digital payments. Pretty wild, right? And this brilliantly illustrates exactly what happens during one of those modern 21st century digital payments. Let's walk through the near instantaneous life cycle of a standard American debit transaction, say at the grocery store. Step 1, you swipe, insert, or tap your debit card. Step 2, in a fraction of a second, the merchant system talks to your bank to verify that your Grand Central Station actually has the trains, the funds, available. Step 3, the bank approves it and the merchant gets paid. This entire super complex conversation happens in literal milliseconds. It makes your checking account feel like magic, but honestly, it's really just incredibly efficient technology. Section 4, keeping your money safe. Let's talk about FDIC insurance. So the crucial point is, when we talk about all our money zipping around digitally in milliseconds, it's completely natural to feel a bit of anxiety. Keeping all your operating cash in one digital place might sound kind of risky, right? Like, what if the bank fails? What if the digital vault cracks? Well, that brings us to this massive number, $250,000. This represents the absolute power of FDIC insurance, the Federal Deposit Insurance Corporation. In the American banking system, the U.S. government actually steps in and protects your deposits. If your bank is federally insured, and almost all legitimate banks are, your money is backed by the full faith and credit of the United States government, up to $250,000 per depositor per account ownership category. That means even if the bank completely collapses tomorrow, you do not lose your money. No way! This provides infinite peace of mind compared to, say, a wallet full of cash. Think about it for a second. If you walk around with $1,000 in your pocket and you drop your wallet or someone steals it, that money is gone forever. There's no backup. But because of FDIC insurance, utilizing an American checking account is vastly safer, more reliable, and just infinitely more secure than living a cash-only lifestyle. You are fully offloading the physical security of your cash to a federally backed institution. Section 5. The Foundation of Finance, your financial launchpad. Let's move to the big picture and see how this builds into the broader economy. Your checking account is your financial launchpad. Without this foundational hub, participating in the modern American economy is honestly virtually impossible. You need this account to build a history, to pay a credit card bill, to save for a mortgage, to invest in the stock market, or even to just secure an apartment lease. Everything, and I mean everything, in your financial life is tethered to this single dynamic account. It really is the rich soil from which the rest of your financial tree grows. Which leaves us, today we're taking a massive step back. We're skipping the complex algorithms, we're ignoring the wild market trends, and we are going right back to the absolute basics. Sometimes, honestly, the best way to really understand our financial foundation is just to look at the literal words we use every single day. So we're going to unpack a super specific foundational concept to see exactly what makes it tick. Okay, let's dive into this. The exact question we are exploring today is simply, what is a saving account? Now, you might notice something a little quirky about the phrasing right off the bat. In American banking, we almost exclusively call this a savings account, right? With an S at the end. But looking at this raw, stripped-down text, just saving account, actually helps us see exactly what this concept fundamentally is. There's no complex Wall Street jargon here. It just carries this core human desire for financial clarity. We're literally looking at the foundational language of the concept itself. Now, what's really interesting about this is that when we break down the literal words, the true meaning just reveals itself. Stripped of all that outside noise, a saving account is exactly what it sounds like. It's a conceptual tool designed fundamentally for the pure act of saving. Whether you're building up a nest egg or just stashing hash for a rainy day fund, the language itself dictates its primary purpose right up front. It tells you what it does before we even get to the word account. And this brilliantly illustrates a really cool duality in the phrase. Think about it kind of like a puzzle. On one side, we have saving. That's the active process, right? The act of keeping, reserving, or actively setting your hard-earned bucks aside. Then, on the other side, we have account. That's the designated place. It's the secure vault or the ledger where that action is actually captured. The concept perfectly unifies these two ideas. It's the active process finally finding its permanent home. So the crucial point is elegantly simple. It is exactly what its name declares. It's literally where the action meets the destination. By exploring the phrase saving account like this, we recognize that its entire definition is just baked right into the terminology. It doesn't try to be anything fancy or anything else. It's a concept specifically forged for preservation. We've broken this foundational text down to its absolute core components now. So I'm going to leave you with this. How does understanding this simple building block change your approach to your own finances? When you strip away all the distractions and just focus on the raw purpose, the action of saving, meeting a secure destination, it really forces clarity, doesn't it? Grasping these foundational terms absolutely matters because honestly, every complex financial strategy you will ever encounter is built right on top of simple truths just like this one. In that classic American pursuit of financial independence, saving your money is really only step one. Step two, well, that's making sure your money doesn't just sit there gathering dust in the background. Today, we're unpacking the high-yield savings account, We are going to strip away all that basic banking jargon and look at exactly why this specific tool is absolutely crucial for protecting your hard-earned cash from inflation. We'll be diving right into the structural mechanics of why some accounts are out there actively working for you, while others are just quietly draining your purchasing power.
Right off the bat, let's look at the big question. What is a high-yield savings account? Honestly, this is a question that completely surges in search volume the very second the Federal Reserve adjusts interest rates and the whole American economic landscape starts shifting. Now, you likely already have a traditional savings account, right? Probably at that massive brick-and-mortar bank right down the street from your house. And hey, it is incredibly easy to just assume that all savings accounts operate the exact same way. But actually, the underlying structure of the institution you choose fundamentally dictates whether your money is just stagnating or if it's actually growing. So when we talk about high yield, what we're really talking about is where your money is positioned in the broader macroeconomy.
To really get a clear-cut answer, we have to look at the defining engine here, which is the high yield itself. By definition, it's producing a larger financial return or interest rate compared to standard alternatives. But let's put that into perspective, because the reality here is actually kind of staggering. Traditional mega banks literally make billions of dollars by taking your deposited cash and lending it out for mortgages and loans at, say, 7 or 8%. But then they pay you a microscopic fraction of a single percent in return. They're essentially paying you pennies just to hold on to your money. High-yield accounts, on the other hand, are structured entirely differently because they operate primarily online, meaning no massive overhead from thousands of physical branches and, no expensive marble lobbies. They can take those operational savings and pass them directly right back to you. This means they can offer rates that are sometimes 10 to 15 times higher than the national average. And the best part? They still carry that exact same ironclad federal FDIC insurance. As you can see here, it all comes down to a very simple financial philosophy. Standard savings accounts mean lower returns, where your money just sits idle. But a high-yield savings account, that means higher returns, where your money actually works for you. Think of your dollars like little employees that should be constantly working to generate even more dollars. In a standard account, your money is basically taking a permanent nap. And look, in an environment where American inflation consistently chips away at your purchasing power over time, idle money is technically losing value every single day. Moving your capital into a high-yield environment totally shifts your cash from passive to active. You are taking it out of a stagnant holding cell and giving it a productive job to do. Plus, you get to do all of this without taking on the inherent volatility and risks of the stock market.
Let's break down the mechanics of high yield that we have up here. Maximizing idle cash, leveraging compound interest, and empowering the consumer. It's beautifully simple, but incredibly powerful. First up, maximizing that idle cash. If you're holding a liquid emergency fund, or maybe you're saving for a down payment, that cash absolutely needs to be instantly accessible. But it definitely shouldn't just be sitting there subsidizing your local bank's free lobby coffee and fancy leather chairs, right? Second, it leverages compound interest at a significantly faster rate. Since your base yield is so much higher, the money you earn in interest starts earning its own interest much, much quicker. It creates this really aggressive, amazing snowball effect. And finally, it empowers you as a consumer. High-yield accounts have effectively democratized high returns. They allow everyday savers like us to demand actual value from the institutions that are holding our capital.
So, bringing it all together, the bottom line is all about empowering your idle money to work just as hard as you do. Think about it. You trade your time, your energy, and your hard-earned expertise for a paycheck. I mean, it completely defies logic to then take the fruits of all that intense labor and just put it somewhere lazy. By utilizing a high-yield structure, you are virtually giving yourself a raise simply by making a smarter, structural choice about where your cash actually lives. It's an effortless optimization. It transforms your financial foundation from just a passive safety net into an active wealth-building tool.
Which brings us to the ultimate question you really have to ask yourself right now. Is your idle money working hard enough for you? Seriously, if you don't know the exact interest rate on your savings account right this very second, consider this your wake-up call to go log in and check. Compare your current setup to the mechanics we've unpacked today. Because when it comes to securing your financial future, complacency is expensive. Thanks so much.
All right, let's dive right in. Today we are putting a magnifying glass to that invisible 3-digit number that silently dictates, well, almost every major milestone in American financial life. I'm talking about everything from getting the keys to your first car to locking down a 30-year mortgage. It's a number attached to practically all of us, yet surprisingly few people actually understand how it works behind the scenes. So let's demystify the credit score.
Here's our roadmap to break this all down into clear, manageable steps. First, we'll look at your financial report card. Second, we'll define the credit score. Third, we'll open up the hood to see how scores are calculated. And finally, 4,
why your score truly matters in the real world.
Okay, Section 1, your financial report card.
You know, we throw this term around all the time here in the States, right? Especially when you're buying a car or trying to get that very first apartment. It acts a whole lot like an adult financial GPA. But let's just pause for a second and ask the absolute most fundamental question. What exactly is a credit score anyway?
Well, at its absolute core, a credit score is simply a measure of an individual's financial trustworthiness and reliability. It's this highly distilled metric cooked up by credit bureaus that banks and lenders use to figure out if you're actually going to keep your financial promises. In today's American economy, it is literally the baseline language of trust.
Think back to American high school for a minute. Your GPA measured your academic reliability, right? It graded your past performance to predict your future success for college admissions. Well, your credit score works exactly the same way, but for your wallet. Though, unfortunately, you can't just bribe a bank by leaving an apple on their desk. It takes your financial past, every single loan, every credit card payment, and grades it to predict your future reliability for lenders.
Moving on to Section 2, defining the credit score.
So, in the U.S., the standard FICO credit score falls on a numerical range between 300 and 850. 300 is the absolute rock bottom floor, and 850, that is a completely perfect score. Fun fact for you, the average American sits right around a 714. The general rule of thumb here is super straightforward. Higher numbers equal greater trust. If you can creep up toward that 800 mark, financial institutions are going to view you as an incredibly reliable, low-risk investment.
Section 3, how scores are calculated.
Now, the mystery of this score isn't just some arbitrary guess. It is quite literally a pie chart of your habits. As you build up your financial profile, 45% of your score is dictated by your payment history, 40% by the amounts owed, and 15% by the length of your credit. So miss a payment, and boom, that massive 45% slice takes a huge hit. But say you keep an account open and in good standing for a decade, that 15% history slice expands, pushing your whole score upward.
Because your payment history and the actual amounts you owe carry the absolute heaviest weight, the two most vital things you can do are pretty obvious. Number 1, pay your bills on time every single time. Number 2, do not max out your credit cards. In the banking world, that second part is called your credit utilization ratio, which is basically just how much credit you're currently using versus how much you actually have available to you. Master those two habits, and you absolutely master the formula.
Which brings us to Section 4, why your score matters. Your credit score directly impacts the absolute biggest milestones in an American life. We are talking about the rates you're going to get on a traditional 30-year fixed mortgage, the interest on your daily commuter car, and even whether a landlord approves your apartment application. Over a lifetime, a difference of just 50 points on your score can literally be the difference between easily securing a home or losing tens of thousands of dollars to high interest rates. It's wild. Let's actually break down how banks use this in everyday transactions. Step 1. You apply for a loan, and lenders check your score. Step 2, that number immediately determines your risk level in their algorithm. And Step 3, that specific risk level dictates your final interest rates and approvals. It is a rapid, completely automated problem solution framework. Lenders just need to know if you're a safe bet, and this 3-step process gives them the exact mathematical answer in mere seconds. As we wrap this up, it really helps to remember this precise quote. Your credit score is simply a cumulative grade based on your financial behavior. It's completely impartial. The score doesn't know your sparkling personality, it doesn't know your sudden life circumstances or your good intentions. It only knows the raw data of your past actions.
So today we're zooming in on something super specific, but honestly, it's deeply wired into the everyday lives of literally millions of Americans. We are talking about just 4 words. 4 words, but man, what a monumental American inquiry. It demands our attention. We're unpacking source material that cuts straight to the absolute core of our modern financial reality. No fluff, no filler, definitely no dense 100-page academic jargon. Just a pure, distilled, almost painfully raw query. Look, I've dug through massive data sets and crazy long articles for these explainers, but it is super rare to see a source so urgent and so incredibly relevant to us as a public.
Take just a quick second, right now, and let this exact, unedited source text sink in. What is credit reports? Okay, yeah, that unconventional grammar, it's not a typo. It's actually the central, tantalizing mystery of our explainer today. Notice the incredibly stark presentation. It literally represents the voice of the everyday American just trying to hack their way through a completely baffling financial landscape. And it all kicks off with the most basic yet honestly profound inquiry you could possibly imagine. Okay, let's dive into this. When we actually frame this exact source text as a quote, it totally highlights this raw, unfiltered search for clarity, right? For the American public, these 4 specific words are basically the gateway to financial mobility, getting a house, landing a job, you name it. Notice how the totally lowercase what is just slams directly into the capitalized credit reports. It's wild. So treating this foundational query with the absolute respect it deserves, that is exactly what we're going to do today.
Section 1. Asking the big question. The power of what is.
So, what is? It's the absolute fundamental act of seeking knowledge and demanding clarity. And this brilliantly illustrates that classic, pioneering American spirit, right? That drive to know exactly how the system works, starting from scratch, absolute zero. These 2 lowercase words, they just strip away all the assumptions. The source material doesn't assume you already have the answer. No way. It demands a baseline definition before we go any further. It's the ultimate driver of our curiosity today.
Section 2. The word credit. Breaking down the first half.
Notice that capital C. Standing completely on its own, credit carries just massive weight. I mean, in the American context, it represents an entire giant institution. Trust, borrowing power, your whole reputation. Think about why this specific word demands our attention. Our source text suddenly shifts gears, right? It goes from the total humility of a lowercase question straight into the imposing capitalized presence of a major system. It's a completely grounded inquiry into something that literally dictates almost every aspect of adult life.
Section 3. The word reports. The plural conclusion.
Now, what's really interesting about this juxtaposition here is the wild contrast. Credit is this abstract, singular concept, right? But reports, that is a concrete, capitalized plural. The inquiry isn't asking about one single piece of paper, it implies this ongoing, multifaceted recording of your entire financial identity. The tension between the singular, abstract idea of credit and the plural, documented reality of reports, that tension is literally the beating heart of our source material today.
Section 4. Why this matters. Your connection to the question.
So, we return to the full text. What is credit reports? Why does this matter so much to you and me? Because it perfectly mirrors the exact frantic query millions of Americans are typing into their search bars every single day. It's a pure digital artifact, a condensed inquiry into the invisible systems that literally govern our modern lives. The minimalist perfection of this phrase, it doesn't even have a question mark, perfectly captures that everyday, urgent pursuit of financial literacy. Look, if you don't crack the components of this question, you simply cannot navigate the American system. It is the ultimate puzzle we have to solve.
And finally, we add the punctuation our minds are just screaming for. What is credit reports? By transforming this raw, unedited source text into a fully realized question, we are left standing right at the edge of a great unknown. We've deconstructed the inquiry, we've analyzed the capitalization, we've weighed the singular against the plural, but the answer to this exact question is still echoing across the entire American landscape right now. What exactly are they? And more importantly, how do they define you?
So instead of getting totally bogged down in the weeds of APRs and, complex rewards tiers, we're going to embrace this raw, everyday question. We are stripping it down to the absolute basics, breaking it down literally word by word. Because honestly, sometimes to truly grasp a system that impacts every single purchase we make, you just got to hit the reset button and look at the most unfiltered framing possible.
Now, if we actually separate the terms from our source text, we find 2 completely distinct concepts. On one side, we have credit. Fundamentally, credit is really just trust. It represents borrowed capital. It's basically the financial system looking at your track record, pulling your FICO score, and deciding, yeah, we trust you to pay us back. Then, on the other side, you have the card. And here's the thing. The card itself has literally 0 intrinsic value. It's just a piece of plastic in your wallet or, the digital tap on your iPhone. It is merely the delivery mechanism for that trust. So the real aha moment hits when you smash those 2 words from our source text back together. A credit card is simply the combination of financial trust and a functional tool to actually utilize it. Think about it. You aren't carrying around a physical bank vault in your pocket, right? You're carrying a globally recognized tool that essentially screams, hey, a bank trusts this person, and here is the proof. And this just brilliantly illustrates the bottom line. Trust plus tool equals credit card. You absolutely do not need a finance degree to get this.
At its core, the answer to our source's totally bewildered what is literally just trust paired with a tool. Keeping this incredibly simple formula in the back of your mind really takes the mystery out of that piece of plastic you're swiping at the grocery store or the drive-thru. So, the big takeaway here? It's that asking the most basic, seemingly confused questions, yes, even with typos, is exactly how you cut through the noise to find real clarity. In a culture completely bombarded by targeted credit card mailers and flashy sign-up bonuses, we kind of forget to ask what the actual foundation is. Step 1, ask the raw question. Step 2, break it down, because that is exactly how you take back control of your financial understanding. We've finally answered the drawn-out what-a of a credit card by breaking down our source text. But getting that definition down leaves us with an essential, really personal question for you to take away today. You now know that the card is just a tool representing trust. So my final question to you is this. Do you actually know your own credit? Like, do you know exactly how much trust the financial system places in you right now? When it comes down to it, that might just be the single most important question an empowered consumer can ask.
Borrowing money. I mean, whether you're swiping a credit card at the grocery store, signing closing papers on a brand new house, or, taking out a loan to send a kid off to college, debt is completely woven into the very fabric of our financial system. But look, there is a massive misconception out there that we really need to clear up right out of the gate. We tend to lump all borrowing into one big, scary category. So today, we're going to break that down. We're going to look at how debt actually works, separating the tools that act as wealth-building multipliers from the traps that just become wealth-destroying anchors.
So, we're tackling a really critical question today to bust the classic myth that all debt is inherently evil. What exactly is good debt versus bad debt? Honestly, it's a question every American consumer needs to answer for themselves. See, somewhere along the line, a lot of us were taught that having a flat zero balance is the only way to win with money. And hey, while being completely debt-free is a fantastic goal, the reality is that the wealthiest individuals and the most successful companies in the country, they use debt constantly. They just use it very differently than the average consumer does. So it's not really about avoiding borrowing altogether, it's about understanding the actual mechanics of leverage.
Okay, moving to Section 1. Defining good debt. Investing in your future.
So what does this actually look like? Good debt is simply borrowing money to purchase assets that appreciate in value or generate long-term income. The absolute keywords you need to remember here are appreciate and income. You're essentially leveraging someone else's money, usually a bank's, to buy something that's going to be worth way more tomorrow than it is today, or something that'll just keep paying you back over time. You aren't just spending money, you're acquiring a financial asset. It's a highly strategic investment in your own personal net worth.
Think about those classic American milestones. A mortgage for a home, right? That's the cornerstone of the American dream. Real estate historically appreciates over time, so a mortgage lets you lock in an asset that actively builds equity. Then we have student loans for education. And yeah, I know tuition costs are a huge hot topic right now, but statistically speaking, getting a higher degree significantly increases your lifetime earning potential in the U.S. job market. In that scenario, you are literally the appreciating asset. And finally, small business loans. This is the absolute fuel for entrepreneurship. Borrowing capital to launch a business that generates revenue is the literal definition of putting money to work. In all these cases, you are deliberately using debt to build a stronger, more profitable tomorrow.
Now, on the flip side, we have Section 2, the bad debt trap, the wealth drain.
The crucial point we have to understand here is that this type of borrowing actively drains your wealth. It's borrowing money at incredibly high interest rates to purchase depreciating assets or consumable goods. Honestly, this is the stuff that keeps millions of Americans just totally trapped in the rat race. You are paying a massive premium for things that lose value the second you buy them or things that are literally gone the very next day. Just imagine paying a painful, say, 25% APR on a pair of sneakers you don't even wear anymore or a restaurant meal you ate 6 months ago. That is the very definition of a wealth drain.
Look, we've all seen this trap. High-yield credit cards used to fund a lifestyle upgrade at the mall. Or putting that crazy expensive Miami or Vegas vacation on plastic, telling yourself, oh, I'll pay it off eventually, right? And then there's the classic American trap. The 72-month, sky-high interest auto loan for a luxury car that immediately loses 20% of its value the absolute minute you drive it off the lot. You're basically paying interest on an asset that is actively dropping in value. It is the financial equivalent of trying to fill up a bucket that has a massive hole right in the bottom.
All right, let's pull this all together in Section 3, head-to-head comparison, the ultimate matchup.
Seeing them side by side like this makes the stark contrast completely undeniable. Good debt is defined by appreciating assets and lower, manageable interest rates. It's strategic, right? Bad debt, on the other hand, is defined by depreciating assets and cripplingly high interest rates. It's impulsive. One side acts as a wealth-building multiplier, while the other side literally borrows directly from your future. Every single time you sign a loan document or swipe a card, you are making a very deliberate choice between these two opposing forces.
If we follow an average American consumer's dollar right through this matrix, it gives us a crystal clear picture of how different borrowing scenarios impact overall net worth. You have to ask yourself, are you buying an income generator or just a consumable? Are you paying a single-digit rate that outpaces inflation, or are you getting completely crushed by a 20+% interest rate? Ultimately, the whole thing comes down to net worth impact. Good debt creates long-term growth, bad debt creates an immediate drain. Guys, this right here is basically the cheat code to understanding personal finance in America. If your borrowing aligns with wealth generation, you're growing richer. If it aligns with consumable spending, you're just working incredibly hard to make someone else rich.
And that brings us to Section 4, Your Financial Future, Why Knowing the Difference Matters.
By stripping away all the boring financial jargon, we really empower ourselves to make borrowing choices that actually serve our long-term goals. Mastering this exact difference is absolutely your greatest asset. Because, it's not really about how much money you make, it's about how you manage the money you have access to. The American financial system offers incredible leverage to those who understand how to use good debt to buy assets, but it is completely unforgiving to those who use bad debt to fund a lifestyle they can't actually afford. Knowledge truly is power when it comes to leveraging debt.
So, I want you to take a really hard look at your own finances today. Look at your mortgage, your car loan, your credit card statements. If you find yourself a little heavy on the bad debt side, hey, don't panic. You now have the exact blueprint to pivot your strategy, pay down those wealth drainers, and start putting your borrowing power to work for you. So before you make your very next big purchase, I want you to ask yourself, are you buying an asset that pays you, or are you paying for an asset that owns you?
Look, if you're part of the millions navigating the absolutely wild landscape of American higher education, you already know that figuring out how to actually pay for it is practically a rite of passage. I mean, it's right up there with those endless campus tours, SAT prep, and moving into a ridiculously cramped dorm room, right? For generations, we've kind of just treated this massive financial step as another box to check on the way to the American dream. But today, we're hitting pause on that conveyor belt. We're stripping away all the complex jargon, the endless political debates, and all that confusing financial aid paperwork to answer one deceptively simple question drawn straight from our source material. We're going all the way back to the absolute bedrock to unpack the fundamental reality of funding your college dream. Okay, let's dive into this. Our source text poses this exact and, slightly grammatically awkward, literal question: what is student loans? Now, if you follow the higher education space, this might seem, almost too basic at first glance. But for American students, parents, and recent grads, this is actually the absolutely crucial and honestly most overlooked starting point imaginable. So why do we gloss over it? Think about the crazy psychological disconnect happening here. We ask an 18-year-old who honestly might not even have a standard credit card yet to sign a legally binding master promissory note. And what's their focus at that exact moment? It's almost entirely on just getting into the school, securing their spot, and making all the logistics work. The actual gravity of the financial instrument is completely buried under the excitement of acceptance letters and orientation weeks. But before you can even begin to calculate a post-graduation budget or stress over which repayment tier you're going to qualify for down the road, you literally have to confront this core concept. It's the absolute cornerstone of the modern American educational experience, and yet it's the one thing we rarely stop to truly define before we sign our names on the dotted line. All right, Section 1, Defining the Concept, Breaking Down the Core. And this brilliantly illustrates what we're actually dealing with. At its absolute core, a student loan is borrowed capital specifically intended to fund higher education costs, requiring future repayment. Notice what's noticeably missing from that definition. Yeah, it's not a grant. It's definitely not a scholarship. It is capital. It's money given to you right now that acts as a highly specific investment in your future earning potential, carrying the strict legal obligation that you're going to pay it back later. And this is exactly where we need to elevate the conversation, because a student loan is vastly different from almost any other debt vehicle in the American financial system. Think about it. Think about a standard mortgage, right? If you can't pay your mortgage, well, the bank takes the house. There's a physical, tangible asset backing up that loan. If you default on an auto loan, the lender just repossesses the car.
But a student loan, there's nothing physical to repossess. You are essentially collateralizing your own future intellect. You're borrowing against your future self, pulling capital from your potential earnings at age 30 just to pay for your classroom seat at age 19. It's a really profound financial maneuver. You are the asset. And realizing that fundamentally shifts exactly how you should view the money hitting your university account.
Moving right along to section 2, why this matters, the bottom line. So the crucial point is, why actually spend time defining something that seems so incredibly obvious? Because in the mad dash to get into a top-tier university or, secure a spot in a highly competitive program, this basic reality gets entirely lost in translation. Understanding this foundation is absolutely the first step in the journey. Before you can even begin to parse all the nuanced differences between federal and private lenders or intelligently debate subsidized versus unsubsidized options, you've got to firmly grasp this reality. You aren't just receiving financial aid, which, let's be real, is a term that honestly sounds a bit too much like a gift. You are securing capital for an education. You're making a binding promise to your future lender. Let's look at a theoretical student. Let's call her Sarah. If Sarah views her loans simply as like magical school money that just somehow makes college happen, she might not think twice about borrowing a little extra for that really nice off-campus apartment. But if Sarah recognizes this as borrowed capital that she is personally collateralizing with her own future earnings, boom, she becomes an investor. She makes much smarter, more intentional choices about her college career, maybe opting for the more affordable housing or strategically picking a major with a much clearer return on that specific capital investment. Acknowledging that one simple fact, it empowers the borrower immensely.
Which brings us to a final, really important thought to carry forward. How does confronting the basic reality of what a student loan is completely change the way you view your own educational journey? When you strip away all that collegiate romance and realize you aren't just going to school, but you're actually actively managing borrowed capital, does it change the major you choose? Does it change the university you finally decide to attend, or the lifestyle you choose to live while you're actually there? Think deeply about the true nature of this everyday financial vehicle. Use that knowledge to shift yourself from being a passive recipient of financial aid to an active, engaged manager of your future capital. Take control of your future.
We are unpacking a piece of source material that touches on an absolutely huge part of the American experience. I mean, when we think about the modern American landscape, we instantly think about movement, right? We think about getting from point A to point B. But bridging the gap between our desire for that mobility and the, practical reality of actually affording it lies a massive, really complex financial structure. And that brings us to the most direct, quintessential question at the heart of the American consumer experience today.
Okay, let's dive into this. Our entire source text for today's explainer is literally just 4 words. What is auto loans? Now, you might be wondering, what's so special about that? Well, what's fascinating is the raw, unvarnished simplicity of this exact question. Notice the phrasing here. It doesn't ask about, complex amortization schedules or prime interest rate fluctuations. No way. It simply asks, in the most stripped-down way possible, for the core definition of a system that millions of us Americans participate in every single day. It's incredibly direct.
Section 1. Deconstructing the inquiry. To truly grasp the magnitude of this topic, we really must perform a minimalist deconstruction of the source material, word by word.
We start with the very first word, what. So the absolutely crucial point here is that what represents a fundamental American pursuit of clarity. In a wildly complex financial landscape filled with hidden fees, varying terms, and those incredibly dense multi-page contracts, the American consumer is just taking a step back to ask for the basics. What is the ultimate question of discovery, really? It's us, the consumers, looking to understand the fundamental nature of the agreement we're stepping into before we get completely buried in the fine print.
Next, we shift our focus to the word is. Now, is grounds us entirely in the present tense. It highlights the current, undeniable reality of present-day financing. We're not talking about what auto loans were back in the days of our parents, and actually, scratch that, we're not talking about what they might become in some distant, autonomous future either. The American consumer is dealing with the immediate pressure of the now. The monthly budget, the current paycheck, the reality of right this second. The word is forces us to confront the immediate reality of our financial obligations.
And then we arrive at auto. Now this word caps directly into the deeply ingrained American culture of driving. Think about it. The freedom of the open road, the sprawling interstate highway system, the daily commute, the great American road trip. In America, an automobile is rarely just a mode of transportation. It's an absolute necessity. It's a lifeline to employment and a historic symbol of independence. By isolating the word auto, we recognize that we aren't just talking about a generic financial product here. We are talking about the literal key to participating in modern American life.
And this brilliantly illustrates our next point, which lands heavily on our final piece, loans. Notice the plural there. This lands on the critical financial mechanism that underpins that whole American dream of car ownership. I mean, let's be real, very few people can just hand over a briefcase of cash for a vehicle today. Loans represents the leverage, the debt, the financial machinery that makes the auto possible in the first place. It is the reality of structured repayments, a borrowing against tomorrow to afford the absolute necessity of today. It's the heavy weight of modern consumer credit.
So, when we bring all these deconstructed pieces back together, we can finally appreciate the full picture. What is auto loans? These 4 simple words perfectly encapsulate the ultimate modern financial dilemma. The grammatical clash between the singular is and the plural loans kind of perfectly mirrors the tension the American consumer feels, right? We're trying to reconcile a single, unified understanding of our lives with a complex, multifaceted system of debt. It's just a remarkably authentic piece of consumer inquiry.
So, we end right back where we started, but hopefully with a totally transformed perspective. What is auto loans? Now, I'm turning this exact same source question back onto you. Looking at this simple question now, I really want you to challenge yourself. Ponder what this concept truly means for your own life, your own driveway, and your own monthly budget. Are you driving your loan, or is your loan driving you? Keep asking the simple questions, guys, because that is exactly where the real answers begin. A completely foundational, no-nonsense financial concept. USA-based investment fundamentals. Our source material today is incredibly brief, but man, is it deliberate. It totally distills the American style of investing, a style that's so often defined by hard data, really clear graphs, and undeniable visual evidence, right down to its absolute core philosophy. Today, we're going to break apart this exact phrasing, explore the real conceptual weight of these terms, and figure out why stripping literally everything back to this exact foundation is absolutely crucial for focus strategists.
So think about this for a second. If you just cut through the daily ticker tape and all those flashy charts we constantly see, what actually builds the American market, right? We hear endless debates about market trends, but the source material forces us to look right past all of that noise and ask a much more grounded question. It points us straight toward a structural reality. It basically demands that we stop looking at the superficial layers of finance and instead look at the bedrock. This is really all about the American style of market building. We're talking scale, pragmatism, and totally unyielding data-backed structural foundations.
Now, to really grasp this, we have to start by defining an investment fundamental exactly as it's derived from our source text. It is the essential underlying core principle of allocating capital. When our source explicitly pairs the word investment with fundamental, it's demanding that we ignore the market noise and focus on durable, verifiable metrics of capital allocation. It asks us, really, it tells us, to focus exclusively on core principles that have inherent structural integrity, stuff backed by hard evidence, not just some abstract theory floating out there.
And you can contrast this directly with speculation. Look, speculation is inherently about guessing, right? It's kind of like hoping the wind blows in your direction. It's totally fleeting, and honestly, a massive distraction. The investment fundamental, on the other hand, relies on concrete reality and highly measurable, graph-backed outcomes. Notice how the source material doesn't use a term like investment theory or investment guess. No, it uses the word fundamental. And that deliberate choice acts as this incredibly strict filter, totally separating serious, grounded strategy from risky, short-term gambling.
As you'll see here, these 3 core concepts form a completely focused strategic loop. It's like a giant puzzle where every single piece is absolutely critical. You identify the capital allocation. You ensure it's solidly grounded in a core principle, and then you anchor it in a robust geography, the investment, the fundamental, and the USA base. If you take out just one slice, the whole framework fails. It's a perfectly closed loop of logic that literally demands strict adherence to all 3 elements if you want the strategy to hold up under scrutiny.
Section 1. The core fundamentals, building a practical methodology.
Okay, so this source gives us a really strict 3-step framework. Step 1, identify the target vehicle. Step 2, ensure it possesses durable structural integrity, like does it actually rely on essential core values? And Step 3, confirm it passes the USA-based geographic filter. By applying this exact logical flow to your financial perspective, you just strip away endless complexities. You're basically left with this highly focused, highly disciplined checklist that acts as a real guardrail against making poor decisions.
Check out this quote directly from the text. Investment fundamental-USA based.
Notice that hyphen literally connecting the concept directly to the location and the distinct capitalization? The brevity here is absolutely the point. You know, in a financial world that is just overflowing with complex data images and endless charts, this phrase acts as a totally strict, singular filter. It's this stark reminder that the most durable strategies are very often summarized in just a few, perfectly selected, uncompromising words.
Now look at how the American market style relies heavily on transparent, graph-driven structural reality. This grants any fundamental rooted here in unmatched scale and incredibly deep institutional liquidity. When an investment fundamental is explicitly anchored to this baseline, it literally inherits that massive scale. It's no longer just a sound theory on paper, it is a sound theory backed by one of the most significant and quantifiable economic engines in the entire world. To put that into perspective, it's just on a completely different level than a non-specific fundamental.
Moving on to Section 2, the USA-based approach, the structural anchor.
So the absolutely crucial point here is that these investment fundamentals aren't just floating around in the ether. They are strictly and powerfully rooted in the USA. And you might be wondering, why is this so important to the source material? Well, because context matters. A fundamental principle in one environment might just completely fall apart in another. By explicitly stating USA-based, the strategy deliberately attaches itself to the regulatory environment, the consumer base, and the innovation ecosystem inherent to the United States. It's a very pragmatic, calculated decision to rely on a specific known foundation rather than some abstract, globalized unknown.
This entire framework boils down to this. It requires a singular, absolutely uncompromising focus. When your entire philosophy is distilled into investment fundamental USA based, there is zero room for a plan B, C, or D to distract you. It requires singular discipline. That means having the absolute fortitude to say no to 1,000 other shiny opportunities, simply because they don't fit this exact one-track criteria. Honestly, narrowing your vision in this way is exactly how you achieve absolute, measurable clarity.
All right, let's quickly summarize our map here. First up, we have the investment focus, which is all about avoiding the noise and ditching the speculation. Second, fundamental principles. These have to be structurally sound, relying on essential values that actually stand the test of time. And third, a USA-based application, which systematically leverages the massive scale of the American market. These 3 points, together, form a complete, rock-solid framework for navigating the techs.
If you're looking to build wealth on your home turf and you want to understand the exact concepts that set the stage for market participation, well, you are absolutely in the right place. Let's just get right into it.
So I've got a question for you right off the bat. Are you ready to dive into the U.S. market? I mean, that's the ultimate American dream, isn't it? Building real wealth, taking control of your financial destiny, really stepping up to the plate. Today, we're going to explore exactly how our source material tells us to do just that, breaking down this single powerful sentence that charts out the whole course.
Okay, here is our game plan for today. First, we'll unpack the U.S. market promise. Then, we're going to look at defining the best strategy. And finally, we'll figure out what it actually means to be ready to dive in.
All right, let's kick things off with Section 1, the U.S. market promise, building the foundation.
You know, every winning playbook needs a solid introduction to the playing field before you can actually score. So let's set that foundation. Our source material kicks off with this incredibly direct, powerful phrase, U.S. Stocks Introduction. And what I really love about this is just how unapologetically focused it is. There's no getting distracted by international noise or super complex alternative assets here. We are zeroing in entirely on domestic equities. We're talking about the companies built, grown, and thriving right here in our own backyards.
By definition, U.S. stocks represent the foundational asset class we're examining today. These two simple words, they're really the core engine of our financial exploration. We're keeping our focus strictly on the home turf, making sure we understand the very market that's driven American innovation and economic strength for decades.
Now, what's really interesting about this specific word, introduction, is how it tears down barriers. Because let's face it, Wall Street can sometimes feel like this exclusive club with a massive velvet rope, right? It's almost designed to intimidate the everyday American. But our source text, it completely tears that rope down. By framing this as an introduction, it assures us that this is an accessible starting line. You don't need a fancy finance degree to get started. You just need to be willing to take that first step and learn.
Moving right along, let's hit Section 2, defining the best strategy, your playbook.
Okay, so this is where we transition from just observing the field to figuring out exactly how we're going to play the game to win. The text doesn't just stop at giving us an introduction. Oh no, It immediately follows up with the phrase, with best strategy. And this is a real game changer. It completely elevates our source material, transforming it from a simple, passive primer into this active, actionable blueprint. It's telling us we aren't just going to casually read about the market, we are going to attack it with a defined, superior plan.
Now, what's really interesting about this slide is the clear contrast here. Most folks, well, they settle for a standard strategy. It's average, middle of the road, kind of just crossing your fingers and hoping for the best. But our text explicitly promises the best strategy. It absolutely demands excellence and top-tier planning to navigate the American financial landscape.
So the crucial takeaway is this. Best strategy literally means the ultimate optimal approach for tackling the market. And this phrasing is just incredibly empowering. It really sparks that classic American can-do spirit. It implies that the absolute optimal path has already been identified in the text, and it's just sitting there, waiting for you to use it. You aren't out there guessing. You are executing with precision.
All right, let's bring it home with Section 3, ready to dive in. Taking action.
This is where the preparation finally meets the pavement, and we get to the absolute most kinetic part of our source text. The final piece reads, to dive into the U.S. market. There's just an incredible, fearless energy to those words. Notice it doesn't say to carefully dip your toe into the U.S. market. No way. It says to dive. It calls for total commitment, really urging us to jump headfirst into the domestic arena with absolute confidence. Doing this requires a total shift in mindset. You really have to move away from hesitation. Waiting on the sidelines, getting paralyzed by analysis, letting the opportunity just pass you by while the market moves on without you. Instead, diving into the market is all about the bold, decisive action explicitly called for by our source material. It's about moving past fear and finally taking ownership of your financial future.
So let's see how this builds our complete roadmap. It's actually amazing how our incredibly concise source text outlines this perfect, logical, three-step action plan for any American ready to build wealth. Step 1, you grasp the introduction. You understand the basics of U.S. stocks. Step 2, you equip the best strategy. You don't just act blindly, you prepare to act optimally. And finally, Step 3, you dive into the market. You execute without hesitation.
When we summarize the entire deconstructed phrase from our source, we're left with these undeniable core playbook directives. 1. Focus strictly on U.S. stocks. 2. Secure an introduction. 3. Utilize the best strategy. And 4. Dive into the market. These aren't just words on a page, folks. They are pragmatic, powerful commands that form our ultimate playbook for domestic financial success. Which leaves us with this final, vital question. Armed with the best strategy, are you prepared to utilize this introduction and finally make your move? The source text we explored today isn't just a casual observation. It is a direct challenge to step up and actively participate in the American economy. The playbook is open, the strategy is defined, and the market is waiting.
Look, if you've been watching the shifting yield curves lately, or just trying to figure out how to protect your hard-earned money, you know that keeping your cash safe is absolutely top of mind for everyday Americans right now. Today, we're diving right in and taking a strategic look at a massive cornerstone of the American financial system, government bonds. Let's demystify this whole thing.
Think about this for a second. What if you could actually become the bank for the U.S. government? Literally flip the script. In our modern economy, we're all so used to paying institutions to borrow their money, right? Mortgages, car loans, credit cards. But using U.S. bonds flips that dynamic completely. You step into the role of the creditor, and the entity paying you for your cash? The United States government.
To respect your time, we've broken this explainer down into 3 simple, high-value parts. 1, an introduction to U.S. bonds. 2, how U.S. bonds actually work. And 3, the best practices for using them. Okay, let's dive right into this. Part 1, Introduction to U.S. bonds, the foundation. At its absolute core, a U.S. bond is basically just a simple IOU between you and Uncle Sam. You're lending money to a trusted friend, in this case, the country, to help fund its operations, and they promise to pay you back with a little extra. And the scale here is just staggering. We are talking about a massive pool of over $25 trillion in the U.S. Treasury market. By getting in on this, you're securing a contract where the government is legally obligated to return your money plus a fixed yield. It's essentially the ultimate risk-free rate.
All right, moving right along to Part 2, how U.S. bonds work. The mechanics.
The lifespan of a bond is incredibly predictable, which is exactly why people love them. It's literally just 3 steps. Step 1, you buy the bond. You hand over your cash. Step 2, you earn interest over time. This is called the coupon rate, and it just means you get periodic interest payments while you hold the asset. And finally, step 3, the bond hits maturity, and you get your original money back. Buy, earn, mature. It's that rock-solid predictability that makes bonds such a vital tool for lowering your financial risk.
And you know, that predictable cycle is exactly why bonds are the ultimate stabilizer for your wallet. Think about the stock market. Sure, equities offer great growth potential, but they're an absolute roller coaster, right? The volatility can be super stressful. If you only have stocks, a bad economic shift can really drain your savings. U.S. bonds, on the other hand, act like a massive stabilizing anchor. They aren't going to double your money overnight, no way. But that's not their job. They're there to protect your capital and give you a reliable yield when the stock market gets choppy.
Now, not all anchors are created equal. You basically have 2 flavors, short-term and long-term. Short-term bonds are great because they tie up your money for less time, meaning you have quicker access to your cash, but they usually pay a lower interest rate. Long-term bonds, where you might lock in your cash for a decade or more, generally pay higher yields to reward your patience. But keep in mind, long-term bonds can be a bit more sensitive if overall interest rates change before it's time to cash out. Figuring out how to balance these two is where the real strategy kicks in. So how do we use this for your specific financial goals? Let's get right into part 3, U.S. bond best practices, the strategy.
Now, what's really interesting about this slide is how these 3 core actionable practices work together to optimize your money. First, hold your bonds to maturity. This pretty much eliminates the risk of price changes in the secondary market. Second, build a bond ladder. This ensures you always have cash freeing up. And third, diversify your portfolio. Mixing bonds in with your broader stock investments means you get to enjoy the growth of the market while still maintaining that rock-solid floor provided by the U.S. Treasury.
Let's zoom in on that second point, bond laddering. This is an absolutely crucial tactic. It's a real game changer for everyday Americans trying to balance their financial strategy. Instead of taking all your fixed income cash and dumping it into one single 10-year bond, you stagger it. You buy some 1-year bonds, some 2-year bonds, and some 3-year bonds. It's like building steps on a ladder. Because they have different maturity dates, you constantly have bonds finishing up and returning your cash. When one matures annually, you can either spend that money or just reinvest it at the top of the ladder into a new long-term bond. This means you have a steady stream of returns, and you're always capturing optimal yields no matter what the economy is doing. And here is the magic number, 100%. If you stick to that first rule we talked about and hold a U.S. government bond all the way to its maturity date, you are guaranteed to get 100% of your principal back. Think about that for a second. We live in a world of wild crypto swings and shifting real estate markets, but this guarantee, backed by the full faith and credit of the United States, provides a true, literal, risk-free baseline for your wealth.
So the crucial point is this. Securing your financial future isn't just about trying to hit the jackpot with the hottest growth stock. It's about disciplined capital preservation. By actively managing your timelines, using straightforward strategies like building a bond ladder, and anchoring everything with U.S. Treasury backing, you are building an incredibly resilient, all-weather foundation for your personal financial security.
You now know the mechanics, the duration, strategies, and the very real structural advantages of sovereign debt. So I'll leave you with this question. Take a hard look at your own portfolio's risk profile today. In such an unpredictable economy, are you ready to anchor your financial safety net, or are you leaving your money fully exposed to the storm?
If you've ever felt like the financial world speaks this overly complicated language just to keep you out, hey, you are definitely not alone. But today, we're stripping away all that confusion. We're going to take the fundamental concepts of mutual funds and turn them into a direct, actionable playbook. By the end of this, you're going to have a crystal clear understanding of exactly how to put your money to work for you.
But before we get into the nuts and bolts, I want you to ask yourself a very direct question. What is really standing between your hard-earned cash and its true potential for growth? For a lot of hardworking Americans, the answer is just hesitation. It's leaving money sitting in a standard savings account or literally stuffed under a mattress, where inflation just silently eats away its purchasing power year after year. Think about it. If inflation averages just 3% a year, cash sitting idle loses nearly half its value in just over 2 decades. That is a staggering loss. But the time-tested, totally accessible solution to this problem of stagnant cash? Mutual funds. Okay, let's dive right in. Here's our straightforward roadmap for today. Number 1, mutual funds explained. Number 2, investing best practices. Number 3, how to start investing. And finally, number 4, choosing the right funds. Let's kick things off with Section 1, Mutual Funds Explained. It's time to clear the air, strip away the Wall Street jargon, and build our absolute basics. Now, what's really cool about this concept is how it takes a totally misunderstood idea and just simplifies it. A mutual fund is essentially a vehicle for collective investment. I want you to think of it using a very plain English analogy. Just picture a giant basket. You, along with thousands of other everyday Americans, pool your money together into this basket. Then, a professional manager uses that collective cash to buy a really wide, diverse mix of hundreds of stocks or bonds. So, instead of betting your entire life savings on one single company and crossing your fingers it doesn't crash, you actually own a tiny, heavily protected slice of the entire market. It's collective financial power working directly for your individual wallet. Moving right along to Section 2, Investing Best Practices. Because building sustainable wealth isn't about getting lucky, it's about rigorously following the established rules of the road. Consider this your mandatory checklist for your personal financial road trip. To succeed, you've got to adopt these core best practices. That means prioritizing long-term patience over short-term panic. Look, investing is a marathon, not a sprint. Letting compound interest do its thing over a 30-year career, that is absolutely your greatest asset. It also means using diversification as your shield to protect your cash from sudden market drops. And this is absolutely crucial. You've got to check your management fees, often called expense ratios. Even a seemingly tiny 1% fee can literally eat up tens of thousands of dollars of your returns over a lifetime. Keep those costs low. Also, employ strategies like dollar cost averaging, which is just investing a set amount every single month whether the market is up or down. That's how you build an unshakable financial foundation. That brings us to Section 3, How to Start Investing. Here is where we shift gears from understanding the theory to actually taking action. We're talking about a literal 1, 2, 3-step process to get in the game. It takes all the abstract financial advice out there and turns it into a concrete, empowering action plan. Step 1, decide where to house your funds. For most Americans, this means opening a tax-advantaged account like an IRA or maxing out a 401k through your employer, especially if they offer a company match. Seriously, a match is literally free money. Don't leave it on the table. Step 2, connect your standard American checking account to that brokerage platform. And Step 3, automate it. Set up automatic payroll deductions so that every time you get paid, a small portion is instantly invested before you even have a chance to miss it. It really is that straightforward. It turns your wealth building into a true set-it-and-forget-it system. Which brings us to our final section, choosing the right funds. This is the ultimate piece of the puzzle, drafting your portfolio. Figuring out exactly what to buy basically comes down to weighing different strategies against your personal timeline. Are you looking for the rocket ship growth of aggressive stock funds to build wealth for a retirement that's still decades away? Or do you need the shield of conservative bond funds to protect cash you're going to need very soon, like save for a down payment on a house? You can filter these choices without getting lost in an ocean of complicated ticker symbols. All you do is align your specific American dream, whether that's a college fund for the kids, a suburban home, or a quiet beach retirement, with the risk profile of the fund. You're deliberately choosing the specific basket that matches your exact timeline. When you connect all these pieces, foundational knowledge, study habits, and the right fund selection, you are finally in the driver's seat. You completely transition from being an anxious saver losing money to inflation to becoming a confident investor building true generational wealth. By mastering the core concepts, implementing disciplined best practices, setting of automated execution, and deliberately choosing funds that map directly to your life goals, you take total control. This is what real empowerment looks like for your wallet. You're moving smoothly from the basics straight through to confident execution, making the once complex world of investing totally accessible. The concepts are demystified, the practices are clear, and the step-by-step execution is right in front of you. The playbook is wide open. So the only question left is, are you ready to step up to the plate and take action on your financial future today? Today, we're diving into something I am super excited about, Main Street's Guide to Wall Street. We're going to focus on the serious mathematical advantage of the good old index fund. For decades, the whole American wealth building story has been totally dominated by Wall Street insiders. But today, we're stripping away all that complexity to give you a direct, actionable framework so you can capture that long-term market growth for yourself. So let's start with a really basic question. Why does investing feel so intentionally complicated? Seriously, just turn on any financial news channel. It's this constant, overwhelming stream of tickers, volatility alerts, and guys in suits debating alpha and beta. But here's the thing.
That's not just noise. It's basically a gated community built on complexity. The financial services industry kind of relies on this intimidation factor, right? They want to convince the everyday American investor that you absolutely need a highly paid professional just to navigate the market. But we're cutting right through that today. Here is our roadmap for this explainer. First, we'll look at the investing dilemma. Second, we'll meet the index fund. Third, we'll go over the core best practices. And finally, we'll lock in your long-term strategy. Let's get right into it. Section 1. The investing dilemma. Keeping your hard-earned dollars. Okay, so think about the life cycle of a single hard-earned American dollar that you decide to invest. On one hand, you've got the incredible power of compounding. That's your money working efficiently 24/7 to build your American dream. But on the other hand, you have the invisible tax of active management. Wall Street has basically spent forever selling us this illusion that high-fee fund managers can consistently beat the market, but mathematically, it's a completely different story. Those expense ratios, which are often around 1 to 2% every single year, create a massive drag on your portfolio. Over, say, a 30-year timeline, these fees act systemically. They literally eat away hundreds of thousands of dollars of your compounded growth. And the absolute kicker? They take that cut regardless of whether the fund actually performs well.
All right, moving on to Section 2. Meet the index fund, the ultimate sampler platter.
So, how do we bypass those crazy fees? We turn to the absolute hero of modern personal finance, the index fund. Honestly, the easiest mental model for this is thinking of it like the ultimate American barbecue sampler platter. Instead of agonizing over picking just one single winning stock, which, let's be real, carries huge risk, an index fund gives you broad market exposure all at once. For example, if you buy a fund that tracks the S&P 500, you're basically buying a tiny fractional share of the 500 most profitable companies in the U.S. economy. You own the whole basket. It's instant, low-cost diversification, just like that.
And the contrast in risk between these two approaches is just night and day. On one hand, picking single stocks is basically pure concentration risk. You have to constantly monitor earnings, try to outguess the market sentiment, and your portfolio is incredibly vulnerable if just one company messes up. But on the flip side, owning the index shifts your entire strategy. Because you own the whole basket, a really bad quarter for one company is completely offset by the success of the others. You're no longer placing stressful bets on individual corporate anomalies. Instead, you're investing in the relentless, historical, upward trajectory of the broader American economy. Let's look at how to actually do this in Section 3. Core best practices. The Everyday Investor's Playbook. Executing this strategy really comes down to 3 incredibly simple pillars. You don't need a finance degree for this, I promise. Step 1, start early. You want to leverage the mathematical certainty of compound interest. Let time do the heavy lifting. It is way more powerful than trying to chase high yields. Step 2, buy consistently. This is called dollar cost averaging. Basically, you automate your investments with every single paycheck. It totally removes the emotion from the equation, so you're buying shares whether the market is up or down. And step 3, ignore the noise. That 24/7 financial news cycle, it is literally engineered to trigger volatility-induced anxiety. A true index investor relies on behavioral discipline. You got to treat your portfolio as a long-term wealth vehicle, not some reactionary day trading account. These steps actually form an ironclad defensive strategy to protect your wealth. First, by using index funds, you drastically cut those expense ratios because they run passively on algorithms, meaning the yield stays in your account where it belongs. Second, you rely on that mechanical consistency we just talked about. And finally, and this is a big one, you insulate yourself against loss aversion. Look, human psychology naturally prompts us to panic and sell during a market correction. We get scared. But selling during a downturn just locks in your losses. By holding the index, you trust the structural resilience of the U.S. market to recover, exactly like it has after every single economic recession in our history. This brings us to Section 4, your long-term strategy, freedom over frustration. If there is one single golden rule of modern investing that you take away from this explainer, let it be this. Time in the market is always greater than timing the market. The financial industry makes so much money selling the illusion that you can tactically jump in and out to catch the exact tops and bottoms. But the data shows that virtually no one actually does this consistently. The real secret is just capital deployment and patience. You just let the structural growth of the market do the heavy lifting, compounding your capital until you reach genuine generational financial freedom.
So we've stripped away the Wall Street jargon to reveal the real structural advantage of index investing. You've got the playbook now, Eliminate the drag of high fees, grab that broad market diversification, and use the unbeatable strategy of automated consistency. The tools are fully accessible to everyday Americans, and the path forward is crystal clear. So the only question left to answer is, are you ready to stop timing the market and start letting the market work for you?
We're looking at US-based ETFs. Now look, you already know they're basically the cornerstone of domestic investing here in the States, right? But today we're moving way past the absolute basics. We're going to look at the actual best practices for optimizing your exposure to the American market. Whether you're fine-tuning a massive portfolio or just trying to squeeze a bit more efficiency out of your domestic assets, we are going to extract the real tactical insights you need.
So, are you truly ready to navigate US ETFs? I know, it sounds super straightforward, right? But building a genuinely optimized domestic portfolio goes way, way beyond just buying a broad index fund and walking away. You've got to consider things like tax efficiency, avoiding accidental sector overlap, and of course, fiercely managing those expense ratios. Okay, let's dive into this, because by the time we finish up today, we're going to elevate your strategy from merely participating in the American market to actively maximizing its full potential.
Here's our roadmap for today's explainer. First, a quick intro to US ETFs. Second, we'll cover core best practices. And third, building your strategy. Let's get right to it.
Section 1. Intro to US ETFs. The basics. Okay, so a USA-based ETF is essentially your introductory vehicle for investing in a diversified basket of American assets. Kind of like a sampler platter of the US economy. But, the true nuance for an informed investor lies in exactly how that basket is put together. We aren't just talking about a random assortment of companies here. We're looking at specific weighting methodologies. Think market cap weighted versus equal weight, for example. In today's landscape, where a massive chunk of the S&P 500's performance is, let's be real, heavily concentrated in just a handful of massive tech companies, understanding exactly what American assets your ETF is actually tracking is literally what separates average returns from optimized growth.
Now let's look at investing in a single US stock versus investing in a USA-based ETF. And this brilliantly illustrates the core advantage of mitigating unsystematic risk. Even the absolute best, most established American blue-chip companies carry inherent, single-company risks. Think about it. A bad earnings call, a sudden change in leadership, maybe some unexpected regulatory hurdles. By utilizing an ETF, you're smoothing out that unsystematic risk while effectively capturing the systematic risk, which is basically the broader, historical upward trajectory of the US market itself. It's just a far more efficient way to capture domestic growth without tying your entire financial fate to a single corporate boardroom.
All right, moving into Section 2, Core Best Practices, the Game Plan.
Let's see how this builds across our core implementation steps. Step 1. Research US ETFs. Now, this doesn't just mean glancing at the top 10 holdings. No way. Serious research means digging into expense ratios, really understanding the bid-ask spread, and aggressively checking for fund overlap. You definitely don't want to accidentally buy the exact same tech giants 3 times over across different funds. Then, Step 2. Select based on goals. You've got to balance growth versus dividend yield, based directly on your own current tax brackets and time horizons. And finally, Step 3. Monitor performance. You aren't just looking at the daily ticker price here. You need to be actively monitoring the tracking error to ensure the fund is tightly mirroring its target index without just sort of drifting off over time.
Expanding on these practices means focusing heavily on USA market fundamentals. And right now, well, that means keeping a really close eye on macroeconomic indicators, like Federal Reserve interest rates, inflation data, and that heavy tech weighting of the major indices we talked about. Diversifying your introductory selections requires moving way beyond just the S&P 500. Think about maybe incorporating the Russell 2000 to capture some of that small-cap American growth, or even sector-specific funds that align with broader demographic shifts. And above all, sticking to established best practices means utilizing tax loss harvesting and maintaining proper asset allocation, completely regardless of whatever the financial news cycle is panicking about on any given Tuesday. Now, what's really interesting here is the emphasis on mastering the introduction before applying the more complex best practices. It's incredibly tempting to jump straight into flashy instruments like options trading or highly leveraged funds, but the data tells a remarkably consistent story. Mastering the boring basics, like a low-cost, broadly diversified US ETF strategy, routinely outperforms hyperactive trading over a decade. Actually, year after year, studies show the vast majority of active stock pickers completely failed to beat their benchmark indexes. The real edge isn't in those flashy tactics. It's in the ruthless, disciplined execution of these core fundamentals.
Section 3. Building your strategy, putting it together.
So, the crucial point is this. We need to synthesize everything into a truly durable framework. Start with a strong introduction to the specific mechanics of your chosen funds. Then, apply those core best practices consistently by managing those expense ratios and closely monitoring tracking errors. And finally, maintain your focus on USA-based asset growth. Ultimately, as an American investor, your true edge in wealth building comes down to consistency, minimizing your fees, and confidently capturing the long-term compounding growth of the domestic markets. Honestly, that disciplined repetition, that is the actual engine of true portfolio growth.
So, the big question remains, how will US ETFs shape your portfolio? Will you use these tools to build a highly tax-efficient, steady retirement? Or maybe to aggressively target sector-specific domestic growth? The American market is incredibly dynamic, and the tools to conquer it are right here in front of you.
I am so excited to have you here today because, look, we are tackling something that is literally a cornerstone of American wealth building, U.S. dividends. But hey, we're not going to beat around the bush or get bogged down in endless financial theory, right? Here's your bottom line up front. To really leverage U.S. dividends to build your wealth, you absolutely need a firm grasp of how these profit-sharing payouts work. But you've got to combine that with non-negotiable best practices to protect your hard-earned money from those dangerous yield traps. Today is all about laying down that essential groundwork, step by step. So, are you ready for the essentials? Let's just be totally real for a second. If you're an everyday American, maybe sitting around the kitchen table right now trying to map out your financial future, man, it is incredibly easy to feel totally buried under a mountain of Wall Street jargon. Sometimes it feels like they're speaking a completely different language. But today, we are cutting out all that noise. We're ditching the complex terminology and getting straight to the core principles. If you're looking to get a clear, practical handle on this topic without the headache, you are definitely in the right place. All right, Section 1, Introducing U.S. Dividends. This right here is our foundational block. Because before we can even think about diving into complex investing strategies, we have to define the core framework. At its absolute most basic level, a U.S. dividend is simply a publicly traded American company taking a portion of its earnings and distributing it directly back to you, the shareholder. You own a piece of the business, so you get a cut of the profits. It's literal cash deposited straight into your account. And, people love to rush to the complex, sexy strategies. But if you skip understanding this fundamental mechanism, like how companies actually generate the cash flow required to pay you consistently, you're basically building a house on sand. We're keeping things fast-paced today, but we're absolutely not skipping this groundwork. A solid, no-nonsense introduction sets the stage for literally everything that follows. It's really about knowing exactly what game you're playing. See, when you invest for dividends, you aren't just crossing your fingers and hoping the stock price goes up so you can sell it later for a quick gain. No, you are actively buying an income stream. Understanding that baseline shift in mindset, that is the field you're standing on. It completely changes your rules of engagement before you ever even make a move. Moving right along to Section 2, Defining Best Practices. Let's establish the rules of the road. And this brings up a pretty crucial comparison, right? Like, why do we even need rules? Well, an introduction all on its own is essentially just raw information. Just knowing what a dividend isn't nearly enough to protect you from a bad investment. For example, without best practices, an investor might just chase the absolute highest dividend yield they can find, totally unaware that a sky-high yield often means the company is in severe financial distress. It's a huge red flag. But with best practices in place, that same investor stops, checks the payout ratio, and makes sure the company can actually afford those dividends long-term. The true value is really unlocked when the baseline introduction is paired directly with these protective established rules. We can actually organize this whole approach into a highly actionable two-step structure that I think perfectly appeals to that practical, roll-up-your-sleeves American mindset. Step 1, understand the concept. You're buying an income stream from profitable companies. Step 2, apply the best practices. This means doing things like diversifying across different sectors and analyzing a company's history to see if they consistently raise dividends over time. You identify the concept, and then bam, you immediately attach the proper way to execute it safely. It's a highly pragmatic, no-excuses approach that keeps you totally focused on what actually works for building lasting wealth. Which brings us to Section 3, the final takeaway, the ultimate bottom line. U.S. dividend introduction with best practices. This is the definitive takeaway that unites both the concept and the application into one completely unbreakable idea. You just cannot separate them if you want to be successful. You've got to understand the fundamental mechanics of profit sharing, for sure, but you must strictly apply the rules, like checking those payout ratios and avoiding those dangerous yield traps we talked about, to ensure those profits actually last. The introduction gives you the what, and the best practices give you the how. And when you fuse these two elements together, you've built yourself an incredibly solid, lasting financial foundation.
So, the big question, how will you apply these best practices? That's the provocative thought I want to challenge you with as we wrap up today. You've got the foundational framework now, and you recognize that rules like analyzing dividend history and avoiding those unsustainably high yields are absolutely non-negotiable next steps. So sitting there today, looking at your own financial journey, how are you going to take this exact foundation and put it into practice in your own portfolio?
Looking at the absolute powerhouse engine that is American compounding growth and exactly how you can use best practices to actually make it happen. We are talking about the core mechanism driving U.S. enterprise, right? That structural advantage that every high-level founder, investor, and builder in this country uses to their advantage. It's the reason why some companies are just stuck with stagnant margins forever, while others systematically capture dominant market share. But beneath the surface of those flashy overnight success stories lies a highly specific, repeatable mathematical process. So in this explainer, we're going to break down the exact mechanics of how operational moats and capital reinvestment build on each other. We'll look at why our American business ecosystem accelerates this and map out the strategic practices you need to trigger this whole phenomenon.
So what is the true mathematical mechanism behind explosive, literally unstoppable growth? Take a second and really challenge your assumptions here. A lot of folks just assume massive success requires some crazy black swan event, like going instantly viral or inventing a completely unprecedented technology out of thin air. But the reality, it's far more pragmatic and it's rooted in rigorous execution. The true mechanism isn't a single explosive launch, it's a relentless mathematical formula. It's a mechanism that starts incredibly small, focusing on incremental basis point improvements, but holds within it the power to completely restructure an industry's economics over time.
10,000x. Just let that number sink in for a second. That sounds insane, right? But this isn't some hyperbolic target. It is historical American market reality. Think about the classic compounding machines of the U.S. economy. A simple $1,000 investment in an early public company like Amazon, or the systematic capital allocation of Berkshire Hathaway, didn't just double. It underwent a 10,000-fold multiplication over decades. Now imagine applying that compound annual growth rate, that CAGR, to your business's revenue, your operational efficiency, or your customer lifetime value. When you successfully harness this mathematical leverage, a 10,000-fold return is the logical, inevitable end state of the math just compounding in your favor.
Moving right along to Section 1, the magic of compounding.
Okay, so compounding growth. It's basically the process where your initial growth generates even more subsequent growth over time, creating this massive snowball effect. But let's elevate that concept from a textbook definition into pure business strategy. This is all about building economic moats and leveraging capital reinvestment. Your initial investment, whether you're deploying capital, writing a new code base, or, say, optimizing a supply chain, produces a return. Instead of just extracting that yield and walking away, you reinvest it right back into the business. So in the next cycle, you're generating a return on your original asset base plus the retained earnings from the previous cycle. Over time, this drives down your customer acquisition cost, increases your operating leverage, and creates an environment where growth literally funds its own exponential expansion. And that is the true engine of compounding.
Now, you've really got to see the fundamental difference here between the sheer exhaustion of linear labor and the massive leverage you get with compounding systems. Linear growth, that's just trading hours for dollars. 1 unit of effort equals 1 unit of output. You add a salesperson, you acquire a few more accounts. It is predictable, sure, but it relies entirely on continuous manual effort. Compounding growth, on the other hand, operates on explosive exponential multiplication. This is where your standardized operating procedures, your automated workflows, and your reinvested capital do the heavy lifting, entirely independent of your physical time. While linear frameworks will eventually burn you out, compounding frameworks scale effortlessly. They lead to this explosive upward trajectory where results are completely divorced from your daily manual input.
Which brings us to Section 2, the USA growth context.
Now, compounding growth is a universal law, absolutely. But the USA environment acts as a really unique accelerator through that pragmatic, can-do, entrepreneurial spirit we're known for. And this isn't just about having a good attitude. It's about our structural and legal infrastructure. The American market is uniquely optimized to grease the wheels of rapid reinvestment. From standardized venture capital term sheets and the legal framework of Delaware C-Corps to highly fluid labor markets and massive, unified consumer demand, the whole ecosystem is designed to remove friction. When an American enterprise identifies a positive unit economic model, the capital markets allow them to pour fuel on that fire and scale the formula faster than anywhere else on the globe. It's an infrastructure built explicitly to maximize exponential multiplication.
Let's get into the how-to with Section 3, implementing best practices.
Triggering this whole dynamic requires a highly structured playbook. First up, step 1,
Establish consistent foundations. Look, you absolutely cannot compound a broken system. You need rock-solid, scalable unit economics. Next, step 2, implement best practices rigorously. And I don't just mean basic customer service. We're talking about automating operational workflows, establishing compounding flywheels, and utilizing data to optimize every single point of leverage. You literally must tune the operational engine to absolute perfection. Finally, step 3, allow compounding to take over. This requires immense strategic discipline. You have to let the automated systems run, aggressively reinvest the margins, and just have the patience to let that mathematical curve accelerate.
All right, let's tie this all together in Section 4, a real-world example.
Let's ground all this theory by looking at a classic American growth story, Domino's Pizza. Think about their early operational timeline. Year 1, it wasn't about aggressive global expansion. Actually, it was about rigorously perfecting a highly specific standard operating procedure, that famous localized 30-minute delivery system. It required heavy foundational effort, with seemingly tiny initial returns. But by year 3, the momentum visibly shifted. They began franchising that exact, perfected SOP. The compounding flywheel was activated, driven by standardized systems and reinvested franchise fees. Then, by year 5, they realized exponential national takeover. That massive scale was completely dependent on surviving the localized grind of year 1 and strictly adhering to the compounding system through year 3.
And this right here is the absolute proof of operating leverage in action. You'll notice the initial growth always appears kind of flat, representing that early foundational stage where the systems are literally just being built. Then we see the steady build, the franchise model, or the automated software really starts to gain measurable traction. Finally, we hit the explosive compounding peak. This drastic upward inflection, that deeply satisfying hockey stick curve, is the exact moment network effects take over. The cost to acquire a new customer or launch a new location drops drastically towards zero, while the revenue per unit just absolutely soars. This isn't a gradual step up, it is exactly what happens when a finely tuned American enterprise clicks into gear, the economic moat solidifies, and exponential multiplication simply takes over the market.
So I'm going to leave you with this final, provocative thought. We've examined the underlying math. We've unpacked the unique structural advantages of our American entrepreneurial ecosystem, and we've analyzed the precise strategic framework of establishing scalable foundations and leveraging time. The only variable left is execution. So how will you apply these USA compounding best practices to spark your own exponential growth today? What systemic operational lever can you pull right now that's going to compound for you tomorrow? Don't settle for the exhaustion of linear effort. Build scalable systems, respect the math, and let that compounding effect propel you toward that 10,000x future.
We're unpacking the core mechanics and the absolute best practices of dollar cost averaging. Look, if you've ever felt completely overwhelmed by the 24/7 financial news cycle, or, stressed out about exactly when to put your hard-earned dollars into the market, you are definitely in the right place. We're going to look at how everyday Americans can build serious, long-term wealth without the stress, without the guesswork, and without needing a fancy finance degree. We'll figure out the exact strategy that takes market volatility and literally turns it from a major source of anxiety into your absolute greatest wealth-building asset. Let's get into it.
So here's our agenda for today's explainer. We're going to hit the market timing trap, look at what dollar cost averaging actually is, break down how the strategy actually works, go over the best practices for DCA, and finally wrap up with winning the long game.
All right, Section 1, the market timing trap. We really got to start by addressing this universal financial anxiety that literally affects everyone. From young professionals opening that very first brokerage account, all the way up to middle-class families trying to plan for retirement. It's that paralyzing fear of, oh man, what if I buy at the absolute top of the market? It's a question we all ask ourselves when we're watching the financial news networks flashing red and green all day. Can you actually time the stock market? Well, when you really dig into it, relying on perfect timing turns out to be an emotionally exhausting and, frankly, nearly impossible strategy for everyday wealth building. I mean, even the pros on Wall Street get this wrong all the time. Waiting around for that so-called perfect moment to invest, it usually just leads to total paralysis.
And when you actually compare these two mentalities side by side, the contrast is just stark. On one hand, you've got market timing. It's highly emotional, packed with anxiety, and usually involves throwing these erratic lump sums into the market just based on a gut feeling or some scary news headline. But on the other hand, we have dollar cost averaging. It's logical, it's incredibly low stress, and it relies on a rock-solid, consistent schedule. Honestly, it's the difference between gambling on a coin toss versus building a brick wall, one steady brick at a time.
Moving on to Section 2. What is dollar cost averaging?
So the crucial takeaway here is the definition itself. Dollar cost averaging, or DCA, is the practice of investing a fixed dollar amount on a regular schedule, completely regardless of the asset's fluctuating price. I really want you to focus on those two elements for a second, a fixed dollar amount and a regular schedule. You're essentially putting blinders on, you're committing to this strategy, and effectively ignoring whether the stock market is currently hitting all-time highs or going through a really steep correction.
Now, you might be wondering, why is this so incredibly powerful? Well, because it allows you to completely remove the emotion from investing. Look, human beings are naturally wired to do the exact opposite of what makes a good investor, right? We want to buy when everyone else is super excited and prices are sky high, and then we want to panic sell when everyone's terrified and prices are rock bottom. But by focusing entirely on consistency, this approach empowers you. It completely removes that emotional panic that's so often triggered by sensationalized financial headlines. You aren't guessing anymore. You finally have a system.
Okay, Section 3. How the strategy actually works. It is really fascinating to see how the math behind this actually plays out. Let's say you commit to investing $100 a month. In month 1, the share price is $10, so your $100 buys you exactly 10 shares. Simple enough, right? But then in month 2, the market takes a dive. The news is totally panicking, and the share price drops to $5. Now, if you were trying to time the market, you'd probably be terrified. But with DCA, your consistent $100 investment automatically buys you 20 shares. You literally just loaded up while the asset was on a massive sale. Then in month 3, the market booms. The price shoots up to $20. Your same $100 now buys you just 5 shares. You bought fewer shares when they were expensive and way more when they were cheap, all without ever having to even think about it.
Implementing this brilliant strategy really just boils down to 2 super simple, highly effective steps. First, pick a fixed dollar amount you can actually afford. This could be $50 a week or maybe $500 a month. Just make sure it fits comfortably into your budget. Second, set an automated recurring schedule. Whether you're setting up your workplace 401k or just a personal brokerage account, you can automate this literally today. Set it for the day after your paycheck clears and simply let the technology do all the heavy lifting for you.
Let's slide into Section 4, Best Practices for DCA. When it comes to straightforward American-style personal finance, there are a few absolute golden rules we need to cover. First up, commit to consistency over perfection. It doesn't matter if you missed the absolute bottom of the market. What actually matters is that you bought this month and you're going to buy next month. Second, automate your contributions. Seriously, if you have to log in and manually click buy every single time, your emotions are eventually going to get the better of you. Make it automatic. Third, ignore the daily financial news panic. The media makes their money by keeping you anxious, but your wealth is built by staying calm. And finally, the ultimate rule here, never, ever pause your investments during market dips. Remember that math we just looked at? The dips are exactly when your fixed dollar amount is buying the most shares. Stopping during a dip completely ruins the entire mathematical advantage of the strategy.
And finally, Section 5, winning the long game. When you track this strategy over time, you start to see this massive snowball effect. At 1 month in, while you've just set your automation, it might not feel like much has changed yet. At 1 year, you're really starting to see those shares accumulate, and you've actually survived a few market ups and downs without panicking. Huge win. But look at year 10. Over a decade, your cost basis, which is the average price you paid for all those shares, has completely smoothed out. So while the day-to-day market might be a total roller coaster, sticking to your DCA best practices over the years builds serious, undeniable financial momentum.
And it all comes back to this classic piece of financial wisdom. Time in the market beats timing the market. Everyday wealth really is built on steady, discipline, patience, and just pure consistency. It isn't built on Wall Street insider secrets or getting lucky on some random single stock pick. It's about getting out of your own way and letting time and math work together in your favor. So I want you to look at your own financial habits right now and ask yourself this one final question. Will you let market anxiety dictate your future, or will you automate your wealth today? The choice, and honestly, the tools to confidently win the long game are entirely in your hands right now.
Let's just jump right into it. If you've ever stepped foot inside an American boardroom or, pitched a high-stakes idea to your team, you already know the vibe. It's electric, right? It's totally charged with ambition. But underneath all that drive, there's always this fundamental tension. Today, we're unpacking the ultimate U.S. corporate playbook, the dynamic of risk versus reward, and specifically, how it's governed by USA-based best practices. We're going to break down the exact methodology that separates those flash-in-the-pan failures from the true, enduring success stories across the American business landscape.
Okay, let's dive into this because it really all boils down to one question. How do we bridge the gap between a wild gamble and a guaranteed win?
Look, let's face it, every great American business venture starts with a leap into the unknown. But there is a massive difference between just closing your eyes and jumping and actually calculating your trajectory so you land exactly where you need to be. You want that win. But that space between where you're standing right now and that ultimate victory, it's filled with uncertainty. Bridging that gap is the core action-oriented dynamic of strategic decision-making that we'll be focusing on today. Section 1, the risk-reward dynamic. This is the core tension that really acts as the starting point for any corporate playbook. And this brilliantly illustrates that inherent tug-of-war in business. Over on the left, you've got risk. The potential for loss, the crazy unpredictability of the market, and just the sheer cost of taking action. But then on the right side, you have the reward. We're talking market share, revenue growth, basically the ultimate goal. The honest truth, blind risk without a system is incredibly dangerous. You absolutely cannot just cross your fingers and hope for the best. But at the exact same time, you can't reach that reward without pulling through the risk. The secret here isn't to ignore this dynamic, is to completely master it. Which leads us nicely right into Section 2, defining USA best practices, or as we like to call it, the playbook. So we're defining USA-based best practices as the ultimate mitigating framework and structural methodology used to govern risk and optimize results. Okay, but what does that actually mean for us on the ground? Well, it means using specific, highly evolved practices that are native to our really rigorous American corporate environment. We're talking about things like phased venture capital funding, where capital is only unlocked as you hit specific performance milestones, which totally limits your financial exposure. Or, rigorous beta testing protocols and strict layered compliance structures. Think of these methodologies as the mentor in your business journey. When you apply this structural framework, you're fundamentally transforming what would be a sheer gamble into a highly calculated, totally defensible play. You do that by taking absolute control of the variables. Let's move on and see how this builds into a really fast-paced, actionable sequence. Step 1, identify risk. You absolutely have to see the board clearly, audit those vulnerabilities, and know exactly what you're up against. Then, step 2, deploy USA-based best practices. This is where you bring in that mitigating framework. When the market shifts, you don't panic, you execute the playbook. You run the compliance checks, you phase the funding, you test the data. And finally, step 3, capture reward. Because you properly identified the threat early on and then deployed the right structural methodology, you're now positioned to actually claim that victory. It is a precise 1-2-3 mechanism for sustained growth. Moving right along into Section 3, balancing the ultimate equation, specifically within the American context. Now, what's really interesting about this slide is that when you integrate these 3 elements, a truly balanced strategy emerges. Look, applying USA best practices doesn't just magically eliminate risk entirely. That's a total myth. Mitigated risk is always going to be part of the equation. But what the playbook actually does is structurally optimize your path to that potential reward. By wrapping your risk up in these proven methodologies, you contain it. You keep the strategy perfectly balanced, so your entire operation can just keep driving forward without completely derailing the second that friction hits. So the crucial point is this. If you take away anything from our explainer today, let it be this exact sequence. First, acknowledge the inherent risk. Don't hide from it. Map it out. Second, ground your strategy in USA-based best practices. Use that structural methodology to build your bridge right over the gap. And third, maximize the optimized reward. Why? Because when you govern the downside with absolute discipline, your upside finally has the freedom to truly scale. These elements link together seamlessly for a winning, high-performance outcome. So I'll leave you with this question. What is your optimized risk-to-reward ratio, and are you executing the best practices playbook to maximize it? Whether you're navigating Wall Street, Silicon Valley, or just Main Street right here in the US, your professional risk tolerance basically defines your ceiling. Are you out there just taking wild gambles, or are you deploying a real structural methodology to guarantee your win? Take a hard look at your own playbook today. I'm talking about asset allocation. So many of us just log into our retirement accounts, stare at this massive wall of confusing mutual fund names, maybe pick a few that sound good and just cross our fingers, right? Well, there's actually a real science to this. Today, we're going to break down the foundational principles that can seriously help secure your financial future. We've got a super clear roadmap for today. We'll start with what is asset allocation, then why it matters for you. Next, we'll hit some US investing best practices, and finally, adjusting through your life. By the end of this, you're going to know exactly what this means for your 401k or IRA. All right, part 1. What is asset allocation? Let's just go ahead and shatter the intimidation factor of all this financial jargon right out of the gate. The really crucial takeaway here is that asset allocation is literally just how you spread your money out to protect your nest egg while still going after some growth. It's the strategy of dividing up your investment portfolio across different asset categories. Usually that means stocks, bonds, and cash. It's just a way to actively balance your risk and reward. That's the whole shebang. It's not about finding some magical secret algorithm. It's simply about intentionally organizing your money into different buckets based on what you actually need that money to do. And it really comes down to 3 main categories when building out a financial future. Up at the top, you've got your stocks. Their primary job is growth and appreciation. But, they come with a high risk level. They bounce around a lot. Then we have bonds. These are designed for income and capital preservation, sitting at a much more moderate risk level. And finally, cash. The goal here is pure liquidity and safety, which means low risk, but yeah, also the lowest return. Honestly, your entire investing journey is essentially just figuring out the perfect mix of these 3 asset classes. Now that we've got the definition locked in, let's look at part 2, why it matters for you, the everyday American investor. An absolutely incredible 90%. Seriously, studies consistently show that up to 90% of your portfolio's returns are dictated by your overall asset allocation, rather than just picking individual winning stocks. I mean, think about the financial news cycle, right? We are constantly bombarded with alerts about this controversial CEO or that hot new tech startup or which individual stock is surging today. But the reality? 90% of your long-term success comes from the simple, quiet math of how you divide your money between stocks, bonds, and cash. To really visualize how this works, think of your portfolio kind of like drafting a sports team. Stocks, they're your offense. They're out on the field trying to score points and drive massive growth. Bonds, on the other hand, are your defense. Their job is to protect the lead and preserve your wealth when the opposing team, the market, starts pushing back. And cash? That's your bench. It's sitting on the sidelines, totally safe, just waiting to be deployed for sudden emergencies. You literally cannot win a championship with a roster made entirely of quarterbacks. You absolutely need a strong offense, a solid defense, and a reliable bench to win the long game. This directly contrasts the golden rule of diversification against a really common American misconception, the idea that you just need to pick the next big tech stock to secure your entire retirement. A diversified asset allocation spreads risk across multiple asset classes to smooth out market volatility. If one sector takes a hit, the others can help balance it out. But single stock risk? That concentrates all your potential risk and reward into the totally unpredictable performance of one single company. Look, betting your entire retirement on one stock isn't investing, it's just gambling. Diversification is how we build a truly resilient portfolio. Let's move right along to part 3, U.S. investing best practices. We're going to outline the actual rules you can apply to your investments right now. Okay, before we even talk about specific percentages, a core U.S. best practice is just making sure you're using the proper financial vehicles to shield your money from unnecessary taxes. You absolutely want to maximize tax-advantaged accounts, like your employer-sponsored 401ks and your personal IRAs. By applying your asset allocation strategy inside these specific accounts first, you're allowing your investments to grow either tax-deferred or completely tax-free. And that drastically amplifies your compound interest over time compared to just using a standard taxable brokerage account. It's a real game changer. So what does a strategy actually look like inside that 401k? Well, an aggressive portfolio sees stocks dominating at 80%, with bonds at 15% and cash at just 5%. If you've got a really long time horizon, like say you are decades away from retirement, an aggressive portfolio relies heavily on the offensive stocks to absolutely maximize growth. You have the time to ride out the inevitable dips and crashes of the stock market, so you can totally afford to take on that higher risk for a higher potential reward. On the flip side, though, for a conservative portfolio, the script is entirely flipped. Now bonds make up a massive 70%, stocks are reduced to 20%, and cash is up to 10%. This setup relies heavily on the defense of bonds. This is the absolute best practice when you're nearing retirement and you really need to protect what you've built. When you're going to need to start actually withdrawing this money to live on in a few years, you just can't afford a sudden 30% drop in the stock market. So you trade that high growth potential for high stability. But, setting their percentages once and forgetting it, that just isn't going to cut it. A fundamental best practice is this process called annual rebalancing, which really just involves 3 simple steps. First, review your target allocation percentages. Second, assess your current portfolio mix. And third, buy or sell assets to restore those original targets. Why is this so necessary? Well, let's say your stocks have an incredible year. They might grow to become 90% of your portfolio instead of your target 80%. Suddenly, your sports roster accidentally has way too many offensive players, meaning you're taking on too much risk. Rebalancing forces you to sell high and buy low, naturally restoring your intended balance. For our final section, we're looking at Part 4, Adjusting Through Your Life. We're charting the actual chronological journey of an American investor. Your strategy definitely shouldn't be static. It must actively shift from offense-heavy to defense-heavy as you age. At each 25, your focus is aggressive growth. You can absolutely afford the risk. By age 45, you enter your peak earning years, and your focus shifts to balanced wealth building, kind of leveling out that risk. And finally, by age 65, your goal transitions to conservative income and preservation. Bottom line, your portfolio has to evolve as your life circumstances evolve. In practice, the percentage of equities, meaning your stocks, generally decreases as your time frame to retirement shrinks. You start with the massive 90% equity exposure at age 25. By age 45, you've dialed it down to 60%. And by the traditional retirement age of 65, you're down to a highly defensive 40%. This downward slope is often called a glide path, and following it is honestly one of the smartest things you can do to ensure a totally smooth landing into retirement.
To tie all of this together, I love this quote. The most important key to successful investing can be summed up in just 2 words: asset allocation. That perfectly summarizes everything we've covered in this explainer. It's really not about being some kind of stock-picking genius. Structure, discipline, and balance, those are the true secrets to actually achieving the American dream of financial independence. I want to leave you with this final, absolutely vital question to ask yourself the very next time you log into your retirement account. Is your portfolio built for your tomorrow? Does your current asset allocation actually reflect your age, your risk tolerance, and your real financial goals? Take 15 minutes this week to just check your necks, consider a rebalance, and make sure your money is structured to serve you for the long haul. Thanks for hanging out with me to explore this concept and keep building that financial future.
Today, we're conceptually unpacking the actual foundational building blocks of American financial planning. We're exploring exactly how the U.S. tax code is specifically designed to accelerate your long-term wealth. You know, in the world of financial strategy, we so often get bogged down in the weeds, right? The complex spreadsheets, the endless acronyms, the daily market fluctuations. But today, we're stripping all of that away. We are looking directly at the core structural framework of building a future in America. We're going to explore how mastering the intersection of your savings goals and government tax incentives can absolutely redefine your financial trajectory. Now, the central thesis we're exploring today is straightforward, but honestly, it's wildly impactful. It boils down to this. The American financial system offers unique, localized advantages, and mastering the intersection of taxes and retirement is the absolute key to building real wealth. This isn't just some theoretical idea. It represents a complete, self-contained philosophy of long-term planning. It gives us the ultimate goal, the primary tool required to get there, and the specific geographic and legal environment where the whole thing takes place. It's really about recognizing that the tax code isn't just a set of rules for what you owe the government, it's a strategic playbook for how you can legally keep and multiply your own money.
So as an American viewer, you might be wondering, how does mastering this specific intersection of taxes and retirement actually impact my own financial trajectory? Why should I care about this specific integration? Well, because this formula dictates the what, the how, and the where of financial independence. If you misinterpret any single part of this equation, you risk leaving massive potential on the table. Understanding this synergy is really about understanding the fundamental rules of the game you're already playing, whether you realize it or not. It's about looking at your life's work not just as earning an income, but as navigating a very specific strategic landscape designed for your ultimate benefit.
Let's start deconstructing this by isolating your ultimate foundational goal: retirement. In the modern American economy, retirement is really the definitive objective, right? It's the true north of this entire conceptual map. But let's be real for a second. Retiring comfortably today requires massive resources. When you factor in rising healthcare costs, unpredictable inflation, and simply living longer, relying solely on standard savings accounts just won't cut it. The sheer scale of the capital required to sustain yourself for decades without a paycheck is immense. And that heavy lift? That is exactly why achieving this goal requires highly specialized tools.
Now, what's super interesting here is how tax advantages act as the specific, powerful leverage paired with that retirement goal. Notice the key isn't just generic saving or investing, it is specifically tax advantages. This is a massive distinction. Tax advantages act as an incredible accelerator.
We're talking about utilizing mechanisms like pre-tax contributions that immediately lower your current taxable income, or tax-deferred compounding, where your investments grow completely free from annual tax drag. These structural efficiencies are the secret engine that actually makes the heavy lift of your retirement goal possible. This dynamic perfectly illustrates the tension between your ultimate destination and the actual tools you use to get there. On one side, we have the goal of retirement. It's heavy, it's significant, and as we just discussed, it requires massive resources. On the flip side, we have the tax advantages, the leverage. The strategy positions them as equal partners in this equation, creating a perfect counterweight. You literally cannot optimally achieve the goal without utilizing the leverage, and the leverage has no true meaning without the goal to guide it. It's a completely symbiotic relationship. Notice that little crucial conjunction, and. There's an explicit integration of these two ideas. The IRS actually rewards you for planning your own financial future, making taxes and retirement a permanently unified strategy in the U.S. These two concepts are not mutually exclusive, and they definitely aren't sequential. They're permanently and simultaneously bound together by the tax code itself. The code dictates that you don't just plan for retirement in a vacuum, and you don't just seek tax advantages randomly. You have to do both, together, as a singular, unified action. You are heavily incentivized to weave tax efficiency directly into the DNA of your long-term investments.
So this leaves us with a very logical, three-step roadmap derived directly from our framework. We've taken the overarching strategy and translated it into actual progression. Step 1. You absolutely must conceptualize and define your retirement goals. Step 2. You must actively seek and leverage those tax advantages to fuel that goal. And step 3, you must apply this entire framework strictly within the parameters of the U.S. system. It's a highly efficient progression that takes you all the way from an abstract personal goal to a very specific, actionable application.
All right, so the really crucial point is the specific landscape where this entire equation takes place. Applying this framework within the U.S. completely changes everything because it grounds these broad financial concepts firmly into reality. This strategy doesn't just float around in the theoretical ether, it actively anchors to the American financial terrain. That U.S. qualifier sets strict boundaries and specific rules of engagement. It tells us that this isn't some universal truth applicable anywhere on the globe. It's a highly localized, specialized framework built explicitly around American legislation.
We really have to ask, why does framing these advantages strictly within the American context matter so much to your strategy? Well, it matters immensely because the U.S. is just this highly unique ecosystem of laws and structural incentives. Navigating this specific terrain means understanding powerful tools like 401k employer matches, which, let's be honest, is essentially free money, as well as the tax-free growth potential of Roth IRAs, or strategically using standard deductions. To succeed in this framework, you have to play the game on the field that is provided, utilizing these very specific tools built directly into the American landscape. By breaking all this down, we reveal 3 interconnected pillars that basically form the whole shebang, a complete, comprehensive financial strategy for the American audience. Pillar 1, the retirement focus gives you your direction. Pillar 2, the tax leverage gives you your momentum. And Pillar 3, the American landscape, gives you your environment. Think of it like a tripod. You pull one single leg out, and literally the whole conceptual structure collapses. They rely entirely upon one another to support the full weight of your financial future.
Bringing it all back together, we can see this core subject isn't just a passing thought.
I want to leave you with a final, provocative thought. Are you actually ready to maximize your American advantage? Because ultimately, what we've laid out today is just the absolute purest form of the formula. We've talked about the goal, the leverage, and the landscape. But hey, a formula is only as good as its execution, right? It is entirely up to you to take these foundational concepts like pre-tax compounding and employer matches and actively calculate your own ultimate result. Keep exploring, keep learning, and start leveraging that structure that is right in front of you.
Today, we're looking at the ultimate engine of American wealth building. And yeah, we're talking about the 401k. Now, if you've got a job, you've probably heard this term tossed around by HR, maybe during orientation. But today, we aren't just giving you a textbook definition. We're actually breaking down exactly how it works under the hood, and more importantly, the absolute best practices you need to maximize it. So let's jump right into this framework and see why getting this right is an absolute necessity for your financial future.
But, before we can ever get into the really complex investment strategies, we have to start at square one. What exactly is a 401k? I mean, honestly, it's a combination of numbers and a letter that sounds a bit like a secret code or, I don't know, a droid from Star Wars or something.
But surprisingly enough, it's literally named after a mind-numbingly boring subsection of the IRS tax code, Section 401, Paragraph K. Yet somehow, this completely obscure bureaucratic label holds the key to millions of Americans' retirements. We are going to deconstruct how this mechanism actually operates, the rules it follows, and how you can leverage it to its maximum potential.
So our source material lays it out pretty simply. It says a 401k is a company-sponsored retirement savings account in the United States. Okay, simple enough. But practically speaking, what does that actually mean for your bottom line? Well, it means your contributions are pulled directly from your paycheck before the tax man even gets a look at it. And let me tell you, that pre-tax advantage is your very first major best practice. By contributing, you're effectively lowering your taxable income today while simultaneously paying your future self. You're basically shielding a portion of your wealth from immediate taxation, which allows a much larger initial seed amount to enter the market and begin growing from day one.
Now, what's really interesting about this is, to truly master this account, we have to look at how its mechanics actually lock together. Think of it kind of like a financial engine built from three primary components: you, your employer, and the investment options themselves. It is definitely not a passive safety deposit box where your money just sits there gathering dust. It's an active working mechanism. And the way these pieces interact, that determines whether you coast comfortably into your later years or whether you end up struggling. The best practice here isn't just mindlessly checking a box during your employee onboarding. It's really understanding how to optimize every single one of those moving parts to work in perfect synchronization over the span of your entire career.
All right, so we have these three core pillars: company-sponsored, for retirement, and a savings account. These are the foundation. But actually, scratch that. Let's clarify that last point immediately. Calling it a savings account is almost a total misnomer here. It is absolutely not a traditional savings account where your cash just sits idle, earning pennies in interest. No, it is an investment vehicle. And the best practice here is aggressive utilization of the investment options within this framework. Usually we're talking about mutual funds or index funds. You do this so that compound interest can do all the heavy lifting for you over the decades. If you just leave your money sitting in the account's default cash sweep, inflation is going to eat it alive. You literally have to actively put those dollars to work in the market.
So, the crucial point is, because it's company-sponsored, the employer essentially acts as your gateway. But here is the most important takeaway of the entire system, like the absolute golden rule. Many employers offer a match, and here's how that works. If a company offers to match, say, 5% of your salary, and you only put in 3%, you are actively leaving free money on the table. It's essentially part of your overall compensation package that you're just declining to accept. The ultimate best practice of the 401k is to always, without exception, contribute at least enough to get that full company match. I mean, think about it. That is a guaranteed 100% return on your investment the very moment those funds hit the account. You simply won't find those kinds of guaranteed numbers anywhere else in finance.
Now let's talk about the timeline for a second. This is a retirement account, meaning it is strictly designed for the long game. And the IRS, they aggressively enforce this long-term view through mechanics like the early withdrawal penalty. If you try to pull funds out of a traditional 401k before you reach the age of 59 and a half, you aren't just paying regular income taxes on that money. No way. The IRS slaps you with a massive 10% penalty right off the top. This enforces a really critical best practice. Treat this money as untouchable. It is not your emergency fund. Structuring your overall finances so you never, ever have to raid your 401k ensures that your compounding engine runs uninterrupted for decades.
Let's move to and see how this builds into the broader picture. How did we even end up with this specific system? Well, to understand the current landscape, we have to look at a massive historical shift. Decades ago, the standard corporate model heavily relied on pensions. These were defined benefit plans, where the company actually guaranteed a specific monthly payout to you upon retirement. The company took on all the investment risk. They took on the funding responsibility. But the financial landscape shifted radically. The 401k was introduced, and corporate America rapidly moved away from traditional pensions, transitioning almost entirely to what we call defined contribution plans. That single legislative pivot completely changed the entire nature of financial planning in this country. And because of that massive shift away from pensions, the 401k places the burden of retirement squarely on the shoulders of the employee, you. It's a uniquely American financial reality where your ultimate success depends entirely on your own literacy and your own discipline. And honestly, this is exactly why understanding the best practices is so incredibly vital for American workers today. It means maintaining consistent contributions regardless of what the stock market is doing on any given Tuesday. It means avoiding emotional trading when the market dips, periodically rebalancing your portfolio, and really understanding the IRS annual contribution limits so you can maximize those tax advantages as your income grows. You are the portfolio manager of your own future now. So we've unpacked not just what a 401k is, but how the underlying mechanics actually work and the best practices you absolutely need to exploit it. From capturing every single dime of your employer match, to understanding those fierce penalty systems, to just letting pre-tax compound interest run wild, the structural framework is there. The rules are set by the IRS, but the ultimate success of this American retirement engine comes down to one critical factor, and that is your consistency over time. So knowing the incredible power of what's under the hood right now, what are you going to do with your next paycheck?
We're coming at you with a super quick, highly focused breakdown of something that is literally foundational to your personal finance journey. If you spend any time at all looking into how to lock down your financial future, you've definitely heard some buzzwords flying around. But today, we're cutting through all that outside noise to look at exactly what this one specific vehicle is, right at its core. Okay, let's dive into this because wrapping your head around this concept is going to completely shape how you look at your long-term money strategy. Let's get to it.
Now, what's really interesting is the exact name of the financial vehicle we're looking at today, the Roth IRA. It doesn't hide behind a bunch of crazy, complex Wall Street jargon, right? It just stands completely on its own. When financial planners and really just everyday Americans are talking about the future, this is the name that constantly bubbles right up to the surface. But to actually get a grip on its power, we can't just, glance at the name and move on. We need to break down exactly what those letters actually mean and why they're put together.
And this brilliantly illustrates the real foundation of the whole thing. IRA, Individual Retirement Account. Let's actually think about those three words for a second. Individual means, well, it's yours. It's not some giant pooled corporate pension, and it definitely isn't a generic sweeping government fund. It is 100% tailored to you. Retirement points exactly to its primary job. I mean, this isn't a day trading account you use to fund next week's beach trip, right? It's built specifically for the long haul, for the day you finally decide to clock out of the workforce for good. An account is basically just the basket holding your future. But here's where the plot thickens a bit, because a Roth IRA is absolutely not your standard run-of-the-mill account.
Let's see how this builds, because the Roth IRA is explicitly designated as a special type of individual retirement account. Special. That is a very specific, deliberately chosen word. Out of all the financial vehicles out there, out of all the possible ways you could stash your hard-earned cash, the Roth IRA gets elevated above the rest. In the totally clinical, dry world of finance, actually calling something special implies there are unique mechanics, totally unique rules, and potentially some major advantages that completely separate it from that standard IRA we were just talking about.
So, the crucial point here is exactly where all of this applies. This particular retirement vehicle is firmly anchored geographically. It's a special type of individual retirement account located exactly right here in the US. So, for our American audience tuning in today, this means the rules, the structure, and that whole special designation are entirely tied to the United States domestic financial system. It really grounds everything we're talking about in reality. You don't have to go looking in some offshore tax haven to find it. This special account exists exclusively right here within the American financial landscape.
Which brings us to a really major question. We know it's a special type of account in the US, but what exactly makes it so incredibly special? The strict definition actually just stops right there. It leaves the unique tax codes and the gritty specific mechanics totally up to our curiosity. And you know what? That is exactly the takeaway I want you to have from this explainer today. You now have the exact definition, you know its location, and you know its unique elevated status. But I want this one burning question to drive your very next step. What truly makes the Roth IRA so special?
We're looking at an absolute foundational pillar of American personal finance, the traditional IRA. For millions of us Americans, navigating the future means finding a reliable, structured way to build wealth over decades. This specific tool is literally front and center in that conversation, and understanding exactly how it works is your absolute first step toward true financial independence.
Here's our roadmap for today's explainer. We'll start with what a traditional IRA actually is, then explore the tax deferral advantage, lay out the rules and contribution limits, walk through the withdrawal timeline, and finally, look at securing your American retirement. We've got a tight path ahead, so let's get right to it.
All right, Section 1. What is a traditional IRA? Let's define the vehicle. So before we unpack anything else, just think about this for a second. In a world totally full of complex financial jargon, confusing corporate 401ks, and wild, volatile brokerage accounts, what vehicle actually cuts through all that noise? When you strip away the endless 24/7 financial media and those super complicated trading strategies, everything points us in one laser-focused direction. For the everyday American worker trying to secure their future, having a single primary tool that just works predictably is absolutely essential. It's the bedrock of a stable financial plan, giving you a clear path forward without needing to be some sort of Wall Street insider. And that brings us to our absolute baseline, the traditional IRA. Now pay attention to the context here, because this is built entirely within and exclusively for the United States. We aren't talking about global equivalents or international pension schemes today. We're zeroing in on this exact financial tool exactly as it operates right here within our borders. It's a product of the U.S. economic framework designed specifically by the government to incentivize us as citizens to save for our own futures. Getting a handle on this localized context is huge, because the benefits and the structure of this account are just so deeply intertwined with how the American economy and our legal systems actually operate.
Let's keep this momentum going and jump right into Section 2, the tax deferral advantage, a U.S. perspective.
This perfectly highlights the core dynamic we're analyzing today. You've got the financial vehicle itself, the traditional IRA, and its jurisdiction, the United States. You really cannot grasp the absolute power of this vehicle's tax deferral status without anchoring it directly to the U.S. tax code. It's a system literally built from the ground up to benefit the American worker. By letting you contribute pre-tax income, the U.S. government is essentially handing you a massive head start. Your money gets to grow free of that heavy drag of annual taxes. That means compound interest can work its absolute magic so much more effectively over the decades. It's this deliberate structural advantage designed by the U.S. system to encourage long-term, self-reliant wealth building.
Moving right along, let's tackle Section 3, Rules and Contribution Limits, Navigating the Framework.
Now, the crucial point here is maintaining strict adherence to our foundational focus. Before we get completely bogged down in yearly numerical shifts, because let's be real, those exact dollar limits change every single year based on inflation and legislative updates, the primary rule you have to understand is its definitive American jurisdiction. Understanding the boundaries of the U.S. system is step one before you ever start calculating your individual limits. The IRS sets these rules to strike a balance, right? They want to incentivize everyday Americans to save, absolutely. But they also want to prevent ultra-wealthy individuals from hoarding unlimited, untaxed capital. Once you grasp that overarching framework, you realize these rules aren't just arbitrary numbers. They're structural boundaries designed to make the system fair and sustainable for our entire workforce.
All right, let's slide into Section 4, the withdrawal timeline, a logical progression.
Our timeline maps out a really foundational progression. Day 1, you identify the traditional IRA as your primary wealth-building subject. Day 2, you solidify its connection to the United States economic system. And Day 3, you prepare to navigate the specific IRS withdrawal rules once you hit retirement age. This is exactly how you build a rock-solid, step-by-step financial understanding. Because, the timeline of an IRA isn't just about opening an account one afternoon, it is a decades-long journey. You start by putting the money away during your peak earning years. Then, you let it ride alongside the American economy. Finally, as you reach those golden years, you start engaging with those specific IRS timelines, the age milestones that dictate exactly when you can pull your money out penalty-free and when you're actually required to start taking distributions.
And that brings us to our ultimate destination, Section 5, Securing Your American Retirement. Bold, direct, and the absolute essence of what we've been covering today. The traditional IRA in the United States? The biggest, most crucial takeaway from this explainer is that unbreakable link. When Americans think about securing their future, this specific vehicle is the foundational starting point. Basically, everything else in American retirement planning builds outwards from here. Whether you're a teacher, a construction worker, or a tech entrepreneur, this structure provides a universal baseline for financial independence. It perfectly represents the self-directed nature of the modern U.S. retirement landscape. Gone are the days when everyone just relied completely on corporate pensions. Today, the power and, frankly, the responsibility is entirely in your hands, using tools exactly like this one to build your own personalized safety net.
Which brings us to our final and honestly probably the most important question. How are you going to leverage the traditional IRA right here in the United States for your own future? We've established the rock-solid foundation today, the what and the where of this uniquely American tool. Taking that knowledge and applying it to your own life, that's the next step. Whether that means going out and opening your very first account tomorrow, or maybe just checking in on the one you've had for years to make sure it's actually aligned with your long-term goals.
Today, we're unpacking a highly concentrated, just 3-word concept that honestly holds an incredible amount of weight when it comes to your financial leverage right here in the American workplace. It's short, it's simple, and it's something you absolutely need to take advantage of. If you're looking to maximize your professional compensation and, really capture every single dollar on the table, well, this is exactly where you need to be.
So here is our entire source text for today. Employer match, USA. Literally just 3 words. But hey, don't let the brevity fool you. Together, they represent one of the absolute most significant inherent financial advantages available to the American workforce today. We're going to break down exactly why this highly concentrated phrase is such a practical and deeply lucrative tool for your financial future. All right, let's kick off this micro-deconstruction. Phase 1, the foundation. Our foundational word is employer. Now think of the employer as more than just the company that signs your paychecks. They are the primary provider of a massive financial arena. They're setting the stage, creating the baseline platform where this wealth-building synergy can actually take place for you. Because, let's be real, without this starting block, the rest of the equation simply doesn't exist. Now, what's really interesting about this next part is how we move to deconstruction phase 2, the advantage. The real action word here is match. This is absolutely the pivotal advantage. You see, when an employer offers a match, they're taking a standard benefit and elevating it into a dynamic partnership. It's basically the ultimate mechanism of multiplication. Or, to put it in the absolute most practical terms, it's free money. You put $1 in and the company meets you right there, matching your effort to actively accelerate your compensation. It's a total game changer. And this brilliantly illustrates the massive leap in value we're talking about here. On one side, you have your standalone employer. Stable, sure, but totally static. It's just your standard working arrangement. But the second you add that magic word, employer match, the value proposition absolutely skyrockets. The whole concept evolves from just showing up for a paycheck into an active, highly beneficial wealth-building partnership that compounds over time.
Which brings us right to our final word, deconstruction phase 3, the target.
That grounding word is USA. This firmly anchors the entire concept specifically for an American audience. You know, the American workplace has this very distinct, energetic, and self-driven style when it comes to benefits and compensation. We're talking about a culture where maximizing your personal leverage is absolutely key. This word tells us exactly who this powerful advantage is built for, aiming it squarely at the American economic landscape. So, we've got our 3 distinct pieces on the board. The critical question is, what happens when they finally combine? Think about the synergy waiting to happen here. We've essentially taken the engine apart to see how the individual pieces work, right? But the true, undeniable power is unlocked only when we synthesize the provider, the multiplier, and the target into one unit. Let's move to and see how this builds a cohesive, logical narrative of advantage. It's actually a super straightforward progression. Step 1, the employer initiates the platform. Step 2, the match actively accelerates and multiplies that value. And step 3, the USA context grounds it, aiming this highly efficient wealth-building engine directly at the American workforce. It's just a simple 3-step process that dramatically increases your earning potential. Let's consolidate this into some really clear takeaways. Think of this as the anatomy of the advantage. First off, you need a defined provider setting the stage. Second, you must secure that paired benefit, the match, which is your all-important multiplier. And third, it's tailored specifically with that energetic American focus. These are the exact conditions required to completely maximize your leverage as an employee. So, the crucial point is this. When you hear these 3 words, you aren't just hearing a random phrase. You are looking at a formula. Employer match USA. It is the provider, the multiplier, and the target, all working together in perfect harmony to create a massive financial advantage that you should absolutely be capturing. Which leaves us with one final, totally essential thought for you today. Are you fully leveraging the match advantage in your own American workplace? This isn't just some abstract concept, folks. It is a fundamental wealth-building tool for your professional and financial life.
We are jumping straight into the uniquely American challenge and, honestly, the massive opportunity of self-funded retirement. Look, decades ago, employer pensions did the heavy lifting for a lot of people. Today, not so much. The burden, but also the total power, sits squarely on your individual shoulders. It's a landscape that demands a very specific, distinctly American style of financial strategy. We're going to unpack exactly what it takes to build your own personal financial fortress, break down the actual mechanics of wealth building, and hand you the absolute best practices for securing your future. All right, let's just dive right into it.
Right out of the gate, I've got to ask you, what does it really mean to achieve financial independence in the modern U.S. landscape? It's so easy to just think of retirement as an age. You know, I'll hit 65 and it'll all magically work out. But when we actually dig into the reality of the U.S. financial system, we realize pretty quickly that we need a highly specific, totally actionable approach. So today we're going to isolate the real mechanics of financial independence to show you the absolute best ways to plan for your future.
So let's start with the core objective here, retirement. But let's actually upgrade that definition right now. Because for the focused learner, retirement isn't just an age where you clock out for the last time. It's a financial number. It is a state of true financial independence. In this American style we're talking about, the destination is entirely up to you to define and, crucially, to fund. Whether your goal is stepping away from the 9-to-5 at 50 or maybe pursuing your passion projects at 65, knowing your exact target number is your anchor. For example, using concepts like the 4% rule helps you figure out exactly how much you need invested to comfortably live off those returns. Because let's be real, without a specific target number, you're flying blind. There's zero direction.
And that brings us to the execution phase, planning. If retirement is your target number, planning is the concrete engine that actually gets you there. We aren't talking about abstract wishes here. We're talking about actionable vehicles for wealth creation. We're talking about setting up automated contributions, maxing out those 401ks, fully funding your IRAs, and building the absolute ironclad discipline of paying yourself first. You don't just accidentally stumble into financial independence. No way. You have to engineer it. Planning literally means setting up the systems today so your money is constantly working for you in the background.
Now, there's a very real friction here, right? We've got this grand, long-term vision of financial independence balancing against the active, daily discipline of saving. It's tough, but the magic that bridges that gap? Compound interest. Think about the incredible power of early investing. Someone who starts consistently putting away just a few $100 a month in their 20s can literally outpace someone who saves way more but waits until their 40s to start. It's crazy, but it's true. Daily action literally builds the destination over time. You absolutely need the vision to start, but you desperately need the mechanics to actually finish.
Now we introduce the crucial context for this entire blueprint, the USA. The United States financial system requires an unbelievable amount of individual agency and financial literacy. Unlike other global systems that might lean heavily on state-provided safety nets or, mandatory, robust employer pensions, the U.S. model places the steering wheel directly in your hands. It's a highly localized framework, and it demands active, informed participation if you want to navigate it successfully.
And this specific context completely shapes our approach. This required autonomy? It's actually baked directly into the U.S. tax code. The government literally incentivizes forward momentum through tax-advantaged accounts. Think Roth IRAs, think traditional 401ks. These are specialized tools engineered to reward people who take personal responsibility for their future. In the American style of planning, the mathematical reality is incredibly clear. Nobody is coming to save you. Leveraging these specific tax advantages isn't just some nice-to-have option. It is an absolute, critical requirement for long-term success.
So let's pull back for a second and look at the architecture of the strategy we've been building. We've got 3 core pillars here. First, retirement. This means establishing your vision by pinpointing your specific target number for financial independence. Second, planning. This translates to automating your investments and consistently paying yourself first. And third, USA. This requires you to maximize those tax-advantaged accounts to effectively navigate a system that is entirely built on self-reliance. If you rip out the target number, the automated systems, or the tax strategies, the whole framework collapses. They are completely intrinsically linked to create your financial future.
When you put it all together, it becomes a unified, powerful mantra. It's a cohesive life strategy. Just imagine someone who fully embodies this philosophy. They calculate their enough number super early in their career. They set up auto transfers so they never even see the money they're investing. Out of sight, out of mind, right? They absolutely max out their employer match because, hey, that is literally free money. And then they diligently let compound interest work its absolute magic inside tax-sheltered accounts over a 30-year span. That is a realistic, incredibly powerful scenario of what it looks like to effectively conquer this uniquely independent financial landscape.
So how do you actually put this into practice today? Let's break this down into 3 simple, actionable steps. Step 1, calculate your target retirement number. Figure out exactly what it costs to fund your life and use those metrics to lock in your ultimate goal. Step 2, build the systems. Automate your savings, max out any available employer match, and set up those recurring investments so you aren't relying on pure willpower every month. Willpower fades, systems don't. And step 3, invest consistently in the American market. Use those tax-advantaged accounts to let compound interest do all the heavy lifting for you over the decades.
Which brings us to our final takeaway. We've laid out the actionable strategies. We've analyzed the uniquely American financial landscape, and we've outlined exactly how to build a robust financial fortress. But listen,
A strategy only works if you actually execute it. The tools, the crazy power of compound interest, the tax advantages, the automated systems, they are literally sitting right there waiting for you. So I leave you with this. How are you going to approach your future? It is entirely in your hands to take charge.
All right, let's think about something that is incredibly close to home and honestly, probably on your mind a lot. Your wallet. You work hard for that American paycheck, right? You put in the hours, maybe you're building a career, growing a small business, and you finally watch those earnings hit your bank account. But as we all know, there is a massive, massive difference between what you earn and what you actually get to keep. And that gap, of course, is taxes. Seriously, consider this for a second. The average American is going to pay over $500,000 in taxes over their lifetime. $500,000. So today we're taking a super focused look at this core concept of keeping more of your hard-earned money exactly where it belongs, with you. We're going to unpack the absolute necessity of understanding how our system works, and not just as, a civic duty, but as a completely crucial strategy for your own personal wealth. Okay, let's dive into this. When you hear financial experts or accountants throw around this term tax efficiency, I know it can kind of sound like, well, confusing corporate jargon. But instead of thinking of it as some dry accounting term, think of it as a critical financial defense mechanism. It's literally the shield that protects the money you've already made. Like, for example, just deciding whether to put your retirement funds into a pre-tax 401k or a post-tax Roth IRA. That right there is a prime example of putting up that defense. Here in America, we don't just earn money, we have to actively manage how that money interacts with Uncle Sam. Being tax efficient means you aren't just passively accepting whatever tax bill comes your way anymore. Instead, you're proactively setting up your financial life so your tax footprint is as small as legally possible. It's really a total shift from playing defense to playing smart, strategic offense with your dollars. So, at its core, tax efficiency is basically the financial strategy of structuring your decisions to minimize your tax liability and maximize your retained earnings, all strictly within the rules of the U.S. system. I like to think of the U.S. tax code as a massive, super complex rulebook for a very high-stakes game. And when I say massive, I mean it. The federal tax code spans tens of thousands of pages. It's huge. Efficiency simply means you know those rules well enough to play a winning game. It's about timing when you sell an asset. It's choosing the exact right type of account to hold your investments in. It's structuring your everyday financial decisions, whether you're a freelancer hustling on the side, a regular W-2 employee, or running a small business, so that you aren't leaving unnecessary tips for the IRS. It is 100% legal, highly encouraged, and absolutely vital if you want to grow your net worth. And the reason we really have to focus so heavily on this in America specifically is our famously, or maybe infamously, complex tax landscape. We don't just have one simple flat tax right here. We've got a progressive federal income tax system, and then on top of that, you have state income taxes, which, as you probably know, vary wildly depending on whether you're living out in California or down in Texas. Then you add in local taxes, property taxes, capital gains taxes, and this ever-shifting maze of deductions and credits that seem to change every time new legislation passes. Understanding how, say, capital gains are taxed totally differently than your regular income, that's where real wealth is protected. Mastering tax efficiency is absolutely crucial exactly because of these unique complexities. If you just stumble through this landscape blindly, you are practically guaranteed to overpay. The whole system is basically built in a way that heavily rewards those who pay attention and penalizes those who don't. So the crucial point is, why do we actually put in the effort to understand this crazy landscape? Because this abstract idea of efficiency translates directly, dollar for dollar, into your personal wealth. A dollar saved in taxes isn't just a dollar earned. It's a dollar that can be invested. It's a dollar that can compound over time and ultimately fund your family's future. That is the sheer power of tax-deferred growth. Think about it. If you can legally avoid a 24% tax hit today, that 24% stays in the market, compounding for decades. When we talk about your bottom line, we are really talking about your financial freedom. By efficiently applying the rules of the U.S. tax code, you're essentially giving yourself a raise without ever having to ask your boss or work extra hours. You are simply stopping the leaks in your financial bucket. All right, so how do we actually achieve that bottom line growth? It basically breaks down into 3 core actions. Number 1, navigating U.S. tax rules. This is your foundation. Now, you don't need to be a CPA. Nobody's asking you to memorize the tax code, but you do need a general awareness of how different types of income are taxed. Number 2, minimizing liability. This is the action phase. This is where you actually utilize tools, things like health savings accounts, choosing between standard versus itemized deductions, or using tax loss harvesting to legally lower the amount the government says you owe. And finally, number 3, keeping more of what you earn. This is the result, the end game. By navigating the rules and minimizing that liability with those specific American tax vehicles, you successfully keep your hard-earned dollars right in your own pocket. It's a straightforward, logical flow that puts you completely back in the driver's seat of your financial life. So the ultimate question I want to leave you with today is this: how tax efficient is your wallet right now? Really think about your recent financial decisions. Are your investments actually sitting in the right types of accounts? Are you taking full advantage of the deductions available to your specific profession or lifestyle? Are you maybe just tipping the IRS out of habit, or are you utilizing the U.S. tax code exactly as it was designed to help you build wealth? The rules of the U.S. tax system are out there, just waiting for you to use them to your advantage. Please don't let the complexity intimidate you into leaving your money on the table. Take a hard look at your pay stub, seek out the strategies that fit your life, and start playing the game to win.
Picture this. You're sitting right at your kitchen table, laptop open, maybe a cup of coffee in hand. You've actually mastered the basics, right? You know how to budget, you live below your means, and you've got that emergency fund tucked safely away. And hey, that's fantastic. But here's the reality. Just simply saving your way to a comfortable retirement? Well, it's getting harder by the day. So today, we're going to level up your financial playbook. We're moving way past just putting pennies in a piggy bank, and we're looking at the actual mechanics of true generational wealth creation.
So I gotta ask you, are you ready to graduate to the big leagues of wealth creation? Because look, basic personal finance, it's kind of like hitting singles in baseball. It gets you on base, and yeah, it is absolutely necessary. But what we're gonna look at today is how to swing for the fences. We're gonna unpack some concepts that honestly might sound a lot like Wall Street jargon at first, but don't worry, we're gonna break them down into everyday conversational language. You literally do not need a finance degree for this, just a willingness to think a little bigger about what your money can actually do for you.
Okay, here is our roadmap for today. Number 1, what is advanced wealth? 2, the real estate route. 3, building your own business. 4, mastering the markets. And finally, number 5, the passive income goal. Let's just dive right in.
Section 1. What is advanced wealth? Moving beyond the basics.
So, advanced wealth building, it's really a major shift in your mindset. We aren't talking about quick fixes here, or, skipping your morning latte to save $5. No way. It's a long-term strategy. It is the conscious, deliberate process of buying and creating assets that produce value over time. You're basically shifting from trading your time for money to using your money to buy back your time. It's all about building engines, and today we're looking at the blueprints for 3 specific types of these engines.
All right, Section 2. The real estate route. Bricks, mortar, and paper.
Let's break down 2 very, very different approaches to the exact same asset class. First up, there's traditional real estate investing. Now, this is the hands-on approach. You're buying physical property. We're talking bricks, mortar, tenants, and toilets. It requires some serious sweat equity, and yeah, you might get a frantic call at 2 a.m. because a pipe burst. But the upside? It's massive. You get direct tax benefits, forced appreciation through renovations, and you physically own a tangible piece of the American dream. But on the flip side, what if you want all those financial benefits of real estate, but you absolutely refuse to be a landlord? Well, enter REITs, real estate investment trusts. A REIT is basically a company that owns, operates, or finances income-producing real estate. You just buy shares on the stock market, exactly like you're buying Apple or Ford. It's completely hands-off, paper real estate. You can own a tiny fraction of a massive shopping mall or a huge data center, and you get a share of the rental income paid right out to you as dividends. So you really have to weigh your personal philosophy here. Do you want boots-on-the-ground control, or are you looking for hands-off liquidity?
Moving on to Section 3, building your own business from the ground up.
The modern business builder almost always evolves through 3 very distinct phases. Step 1 is the side hustle. This is where you're working your normal 9 to 5, but on nights and weekends, you're grinding. Maybe you're driving for a rideshare, doing some freelance design, or selling crafts right out of your garage. It's basically your after-hours proof of concept. Then, if things go well, you graduate to Step 2, entrepreneurship. You take the big leap, and that side hustle officially replaces the day job. But here's the catch with this stage. You are usually doing literally everything. You're the CEO, the marketing department, and the janitor. If you stop working, well, the money stops too. At this point, you kind of just own a job, not a business. Which naturally leads us to the ultimate goal, Step 3, business ownership. Now, this is a massive mental shift. You've built systems, you've hired a team. The entity itself can function, grow, and generate revenue whether you're sitting at your desk or chilling on a beach somewhere. You've officially transitioned from working in the business to working on the business.
Which brings us to Section 4, mastering the markets. Strategies for stocks.
Okay, now let's talk about economic moats. This is a term made famous by some absolutely legendary investors, and it is crucial to understand. Think of a medieval castle, right? To protect all the wealth inside, you dig a giant, deep moat right around it. Well, in business, an economic moat is essentially an unbreachable fortress a company builds to protect its profits from competitors. When you're looking to build advanced wealth in the stock market, you are actively looking for companies with wide moats. That can mean incredible brand loyalty, like people buying a certain smartphone no matter what the competitors do. Or it could be a patent on a life-saving drug, or even the network effect of a massive social media platform. Basically, finding companies with strong economic moats ensures your investments don't just survive, but they actually thrive over decades.
But the absolutely crucial point here is how you actually go about picking those companies. Let's look at two legendary, totally contrasting philosophies. First up is value investing. This is bargain hunting at its absolute finest. You're looking for companies the market has just unfairly beaten down or totally ignored. It's kind of like walking into a thrift store and finding a pristine, vintage designer jacket priced at like $10. You know the true intrinsic value is way, way higher, so you buy it and just wait for the rest of the world to realize its worth. You're looking for solid, established companies that are trading at a serious discount. Now, in total contrast to that, we have growth investing. See, a growth investor doesn't really care if the stock looks a little expensive right now. They are hunting for the rapidly expanding powerhouses, the innovators, and the disruptors that are literally changing the way we live. They'll gladly pay a premium today because they firmly believe the company is going to double, triple, or even quadruple its earnings down the line. So value is all about the bargain, growth is all about the potential. You just really have to know which game you're playing.
And finally, Section 5, the passive income goal, the ultimate destination.
Passive income, I really want this to sink in for a second. This right here is the true destination of advanced wealth building. Whether you chose the real estate route, the business route, or the stock market, they all serve this one master goal. Passive income is basically money that flows into your bank account with little to no daily effort on your part. In real estate, it's those rent checks arriving like clockwork on the first of the month from a property manager, or those dividends from a REIT. In business, it's profit distributions from a company that's being run by a great CEO you hired. And in the markets, it's the dividends from value stocks or the long-term appreciation of your growth stocks. Look, the goal of advanced wealth isn't just to have a really high net worth on paper, it's to build enough passive income streams to completely cover your living expenses. Because when your money makes enough money to pay for your actual life, that's when you have bought back your ultimate freedom. So today, we are absolutely deconstructing the fundamental mechanics of a massive macroeconomic engine, and that is real estate in the United States. We're going to literally strip this concept right down to its core components to understand exactly how it functions from the ground up. You know, if you want to see how the financial gears of this specific market actually turn and how capital is strategically deployed within it, well, you are definitely in the right place. Let's get right into it.
Okay, let's dive into this. What actually happens when you combine tangible assets, capital allocation, and the American economic landscape? We aren't just talking about the basic, everyday mechanics of buying a house or, renting out an apartment. No way. We are talking about the collision of the physical world with the abstract, high-level realm of advanced financial strategy. Things like leverage, tax advantages, debt structures, the whole shebang, all operating within the boundaries of a highly developed economic system. It's literally a formula that has driven immense wealth generation. And to really understand the whole picture, we absolutely have to look closely at its individual parts.
You see, the entire foundation of today's analysis boils down to a single, surprisingly brief phrase: real estate investing in USA. Well, it sounds incredibly simple, right? But this perfectly distilled concept actually encapsulates trillions of dollars of value, centuries of evolving property law, and super complex capital markets. It represents this fundamental human drive to build and structure wealth over time. So let's take a scalpel to this phrase and really explore the advanced economic principles it actually represents.
All right, let's start with the foundation: real estate as the tangible asset. Now, in a modern economy that is increasingly digital, where wealth is often just numbers on a screen, pixels in a database, or the algorithmic trading of equities and bonds, real estate stands entirely apart. Why? Because of its physical permanence. This tangibility is absolutely crucial in macroeconomics. It provides intrinsic value and scarcity, basically acting as a highly effective hedge against fiat currency fluctuations and inflation. Plus, and this is a huge deal, unlike traditional equities, you have the unique ability to physically force appreciation through structural improvements. That makes it a distinctly controllable asset class, which is a real game changer.
But here's the catch. Physical permanence alone is static. It just sits there. It requires momentum. So the crucial point is the action, investing. In this context, investing isn't just passively deploying capital and, crossing your fingers and hoping for a return. Not at all. It involves actively utilizing financial mechanisms that are totally unique to this space. Take the strategic use of debt or leverage to dramatically multiply your returns. It's about navigating those dual engines of cash flow generation and long-term equity appreciation. So, whether it's through sophisticated commercial financing or just adding sweat equity to a residential portfolio, this is the exact action that transforms a static plot of land into a highly active, dynamic financial endeavor.
Now, those assets and actions, they don't exist in a vacuum, right? They require an environment. And what's really interesting here is how placing this activity within the USA provides a completely unique framework for this asset class. We're talking about things like the widespread availability of the 30-year fixed-rate mortgage. That is a financial product that is incredibly rare globally. It's an economic landscape literally defined by highly advantageous tax codes. Think 1031 exchanges and depreciation benefits, all backed by a mature, highly liquid secondary mortgage market driven by massive institutions like Fannie Mae and Freddie Mac. This specific environment entirely dictates exactly how capital can flow and how leverage can be utilized safely.
So when we bring all these elements together, we reach a really powerful synthesis. This is the exact point where all the gears click into place. The stability of the U.S. legal and economic system allows financial institutions to confidently lend capital, often at significant leverage, mind you, against the physical permanence and intrinsic value of real property. And that creates a remarkable wealth-building flywheel. Think about it. Without the robust legal framework, banks simply wouldn't lend. Without the leverage, the investor returns wouldn't scale. And without the tangible asset, there's no foundational collateral at all. Together, they construct a highly sophisticated macro industry out of completely interlocking economic incentives.
So today, we're zeroing in on a massive structural concept in the financial world, and it's all wrapped up in just two little words: REITs USA. Now, the goal here is to take this foundational phrase and really peel back the layers. We want to break down its core conceptual framework step by step, making sure you walk away with a crystal clear understanding of the exact mechanics running under the hood of this financial vehicle. Let's dive in. So, have you ever wanted to own real estate, but you just completely lacked the massive capital it actually takes? Think about the incredibly high barrier to entry when we're talking about traditional commercial property ownership. You might look up at a soaring commercial skyscraper or drive past a sprawling apartment complex and think, wow, that's a brilliant asset. But honestly, the sheer amount of capital required makes direct ownership literally impossible for most of us. And yeah, I know financial acronyms can seem super intimidating and clunky at first, but the structure we're looking at today was designed specifically to solve that exact liquidity and access problem. All right, moving on to Section 1, decoding the acronym. So let's break down this acronym. REIT stands for Real Estate Investment Trust. Now, the absolute operational key here, it totally rests on that very last word, trust. In the finance world, a trust is a vital mechanism where resources are managed on behalf of a collective group. It basically shifts the heavy burden of ownership and all the risk that comes with it away from you as an individual, handing it over to a managed entity that acts on behalf of a ton of people. It creates a highly functional, accessible gateway right into this asset class. Okay, let's actually review the ground-up mechanics of how this gateway really operates. It's like a highly efficient engine. Step 1, investors pool their money together. You're combining your individual capital with thousands of other people to massively multiply your purchasing power. Step 2, the trust buys the property. With all that aggregated capital, the entity can suddenly go out and acquire large-scale, ultra-premium real estate. And finally, Step 3, returns are generated. Whether it's through tenant rent coming in every month or the property naturally appreciating in value over time, that financial output flows right back into the investor pool. It's just a remarkably straightforward engine of collective financial scale. Which brings us to Section 2, the American context. Now, let's talk about the second half of our phrase. That USA designation is super important because it dictates the very specific economic environment for these trusts. The United States real estate market is vastly diverse, right? We're talking everything from ultra-dense urban centers in New York City to sprawling, massive industrial parks out in the Midwest. And all of it is governed by unique regulatory frameworks and specific economic cycles. By attaching USA to a REIT, we are firmly framing the absolute geographic boundaries. That means all the pooling, all the purchasing, and all the returns are strictly tied to the unique dynamics of the American economy. So the really practical takeaway here is the sharp contrast between direct and indirect exposure. Think about it. Traditional U.S. property ownership requires absolutely immense capital, direct hands-on management, and you've got concentrated risk tied up in just a single physical asset. It's daunting. Conversely, U.S. REIT ownership offers fractional exposure. You suddenly gain meaningful participation in the broader American property landscape, completely bypassing those massive capital requirements and all the messy management overhead. Instead, you get to engage purely with the financial returns of that environment. It's a real game changer. Let's wrap this up in Section 3, the bottom line. Let's summarize the core conceptual takeaways we've decoded today. First, the REIT provides an incredibly accessible real estate mechanism. It literally uses pooled money to entirely bypass those massive traditional capital requirements. Second, this entire engine we've been talking about is centered strictly within the USA market, operating entirely within the boundaries and rules of the American economic landscape. We've taken what seems like a really dense financial concept and efficiently peeled back the onion to reveal its fundamental structural value. We're doing something totally different. We're taking a highly focused look at an incredibly concise and honestly profoundly loaded piece of source material. We're going to unpack something so fundamental. So get ready, because we are literally stripping things right back to the absolute core. Let's look at the entire source text exactly as it appears. Ready? Here it is. Business Ownership USA. That's it. Now, I know exactly what you might be thinking. I can practically hear you through the screen. Wait, is that the whole thing? Yep, it's stark, it's wonderfully minimalist, but hey, don't let its brevity fool you. There's a whole universe of meaning, of ambition, and of structural reality packed into these 3 exact words. Okay, let's dive into this. When we see a quote this totally distilled, Business Ownership USA, well, we owe it to ourselves to really unpack it, right? We're going to do a deep analytical, word-by-word deconstruction of this source, just to understand the immense conceptual weight it actually carries. We're going to look at how these 3 distinct concepts collide to form something far, far greater than the sum of their parts. Let's isolate that very first word, business. I want you to focus entirely on this core concept of commerce and enterprise that it represents. Before we even talk about who has it or where it is, we just have this one solitary idea, the act of business. It implies motion, doesn't it? It implies creation, exchange, effort, value. It's the engine. Which leads us to a pretty massive question to ponder. What is the fundamental nature of enterprise? When we look at this single word from our source text, it forces us to deeply reflect on the conceptual weight of a business. We aren't looking at external data points or textbook definitions right now. No, we're looking at the raw idea of human beings coming together to produce, to trade, to really build an entity from the ground up. It essentially represents human agency at work. Now, what's really interesting about this is the conceptual shift as we move to our second word, ownership. We transition completely away from the active entity itself and into the state of possessing it. It's like shifting into a completely different conceptual gear. We've gone from the what, the business itself, straight to the who and the how. So ask yourself, what does it actually mean to hold the ultimate responsibility? You see, ownership isn't just a legal status in the context of this document. It represents these deeply abstract ideas of control, of possession, and of ultimate accountability. Think about it. When you attach ownership to something, you tether it to a person or a group. You assign risk and you assign reward. It's a very heavy, very permanent sounding word, especially when you compare it to the kinetic energy of business. So the crucial point here is how these 2 words interact. We have the active, moving entity of business pushing right up against the authoritative, static state of ownership. There's a real dynamic relationship and honestly a lot of tension here. Creating an enterprise requires one set of skills, right? Hustle, innovation, constant movement. But holding the rights to it, maintaining that ownership, well, that requires authority, structure, responsibility. The text forces these 2 opposing forces together. Okay, let's move along and see how this all builds. USA. The text drops the final piece of the puzzle right here. This single geographic and cultural abbreviation completely changes the landscape. It takes those previous 2 massive abstract concepts, business and ownership, and violently anchors them in a very specific, highly recognizable reality. Suddenly, we are no longer talking in the abstract. So we have to ask, how does this specific geographic context shape the meaning? Placing these concepts squarely within the United States alters their scale and their interpretation entirely. This isn't just enterprise in a vacuum anymore. It brings to mind the specific frameworks, the historical ambitions, and the cultural weight of doing all of this within the USA. The abbreviation acts as a container, giving a really unique flavor and boundary to those massive ideas that preceded it. And this brilliantly illustrates the sheer power of context. Let's look at the recombined text, Business Ownership USA. Having pulled it apart, look at how much heavier and more complex this phrase feels right now. We see the kinetic energy of the business, the authoritative weight of ownership, and the specific cultural arena of the USA all standing shoulder to shoulder. It's wild how our microanalysis reveals the true macro impact of these three simple words.
Incredibly concentrated, we're going to deconstruct the very anatomy of modern opportunity. If you've been racking your brain wondering exactly how the biggest opportunities come to life nowadays and, what the ultimate vehicle is for actually capturing them, well, you're in exactly the right place. We're going to break this whole thing down logically, so let's just get right into it.
Okay, let's dive right into this. Where does the biggest opportunity come from nowadays? It's a massive fundamental question, isn't it? Literally everyone, from a single individual working out of a garage to these sprawling multinational organizations, they're all constantly trying to figure this out. What is the ultimate vehicle for modern success? We hear all the time about, new tech trends or super niche markets, but our source material for today cuts right through all that noise. It points us toward a single, undeniable answer.
Entrepreneurship. Just entrepreneurship. Let that sink in for a second. In the context of today's crazy landscape, entrepreneurship isn't just an activity or a side gig. It's the definitive answer to our opening question. It's the absolute core of where major, life-changing opportunity originates nowadays. It's this active pursuit of creating real value. And as we'll see in a moment, it's basically the master key that unlocks everything else.
Our source material sums this whole concept up with one exact, incredibly potent phrase. Listen to this. Entrepreneurship in United States and global world opportunity too. Now, what's really interesting about this exact phrasing is just how much raw, unfiltered potential is packed into it. We're actually going to anchor our entire explainer around these exact words today. Because honestly, hidden right there within this brief little statement is a complete step-by-step roadmap for modern success. Let's conceptually meditate on this for a second. Based on the text, we can define entrepreneurship as the primary mechanism, the actual engine for generating modern opportunity. Our source is framing this up not just as a standard career path or a fancy job title you put on a resume. Instead, it's the foundational vehicle for accessing today's limitless potential. It's the engine that actually generates the opportunity itself, rather than you just sitting around waiting for someone to hand it to you. It's entirely proactive.
Moving deeper into the text, we get to see exactly where this engine operates. On one front, we have the United States, representing the domestic arena, and then, right alongside it, the global world, representing absolutely limitless scale. And this brilliantly illustrates how the biggest opportunity exists simultaneously on both domestic and international fronts. You really don't have to choose one over the other anymore. They're intertwined environments just waiting to be navigated. It's a complete dual-threat landscape.
By breaking this down logically, we realize the source is doing something really powerful here. It's completely erasing traditional borders. The mindset required to capture the biggest opportunity nowadays doesn't just stop at the shoreline. Modern opportunity is inherently dual-tracked. You're looking at a landscape where your domestic success and your global reach are literally just two sides of the exact same coin. The whole world is the playing field now.
Now, I want you to really focus on the final words of our source sentence, opportunity two. So the crucial point is the massive conceptual weight of that tiny three-letter word, two. It's incredibly significant. It means this is not an either-or scenario. It signifies this additive, boundless expansion of your potential. You can conquer the domestic market and there's the global world opportunity too. It's a massive multiplier effect. It's basically saying the sky is the limit and then some.
Let's see how this builds into a totally actionable sequence. This is what we can call the opportunity arc. It logically maps out the implicit sequence of growth hidden entirely within our single source sentence. Step 1. Embrace entrepreneurship. You've got to get that engine started first. Step 2. Leverage those domestic U.S. markets to build your foundation. And then Step 3. Expand out to the global world. It's a completely seamless progression from a single idea to massive worldwide scale.
We're diving straight into a massive, fundamental shift happening right now in our economy. The rise of side hustles in the financial U.S. This is really a story about the modern American worker, our economic resilience, and how we are all adapting to a rapidly, almost unbelievably fast-changing world.
All right, here's our game plan for today. First, we'll break down the modern side hustle. Second, we'll look at how it's shaping the financial U.S. Third, we're going to measure the American economic impact. And finally, we'll wrap up by asking, what comes next?
But before we get into the weeds, we have to stop and ask ourselves a really fundamental question. What's actually driving the American worker today? I mean, why are so many of us clocking out of our 9-to-5s only to turn right around and clock into something else? Keep that question in the back of your mind as we go.
Let's jump right into Section 1, the modern side hustle.
Now listen, we're not just talking about picking up an extra shift at the diner or doing a quick odd job for some spending cash. The modern side hustle is a dedicated secondary stream of income. It represents a massive pivot in our traditional American work ethos. You know, that old idea where company loyalty for 40 years and a gold watch at retirement was the ultimate unquestioned goal. Yeah, that's fundamentally changing.
Think about the stark contrast here. For the longest time, the classic setup was a total reliance on a single corporate employer, a strict, locked-in 9-to-5 dependency. But today, the modern model is entirely defined by economic agility. In an economy that feels more unpredictable by the day, having that agility isn't just a nice little bonus. It's practically a baseline requirement for everyday American peace of mind.
Moving right along to Section 2, Shaping the Financial U.S.
So the financial U.S. isn't just a location on a map. It represents a very specific, everyday gauntlet of economic hurdles. We're talking about the relentless pursuit of financial security while constantly trying to adapt to the cost of living. Whether it's the steep climb in housing costs or the sudden sticker shock on a carton of eggs at the grocery store, traditional wages are just flat out struggling to keep pace with normal household expenses.
And this creates the ultimate intersection where individual grit meets environmental pressure. It's everyday Americans taking a hard look at the economic playing field, realizing the old playbook just doesn't guarantee a win anymore, and deciding, you know what, I'm going to pave my own path to opportunity.
The progression here is honestly pretty straightforward. Step 1. We navigate the traditional economy, paying rent, filling up the gas tank, battling inflation. Step 2. We identify a clear gap and realize we need supplemental income just to stay afloat, let alone get ahead. And Step 3. We actually initiate that modern side hustle as a practical, actionable solution. Which brings us to Section 3, the American economic impact.
The sheer necessity of this supplementary income is literally rewiring our culture. It's rapidly becoming the absolute norm, and it's sparking a huge resurgence of that classic American entrepreneurial spirit. Everyday people are turning hobbies and skills into legitimate micro-businesses. We are redefining the American dream, from simply having a good boss and a white picket fence to actually owning our own time and building multiple avenues of success.
Ultimately, the side hustle is definitely not just some fringe activity anymore. It's not a desperate last resort. It's becoming a central, load-bearing pillar of surviving and thriving in the modern U.S. economy. It is the definitive, proactive way American workers are taking back control of a financial narrative that might otherwise feel completely out of their hands.
All right, let's look to the future with Section 4, What Comes Next?
We really have to weigh two completely different possibilities here. On one hand, is this massive hustle culture merely a temporary financial bridge? You know, just a way to overcome current localized economic hurdles? Or is this the permanent new standard? Have we crossed a threshold where single income dependency is a thing of the past, permanently replaced by a portfolio approach to American finance?
We're tackling a genuinely unique challenge. We've been handed literally the most minimalist source text we have ever analyzed. But you know, within its incredibly tiny footprint lies this massive cultural and economic narrative. So let's just do a complete unboxing of meaning right here, right now.
Okay, let's dive into this. I want you to just sit with this for a second. Passive Income USA. That is the stark reality of our entire source document today. No hidden footnotes, no complex charts, just this raw, unfiltered phrase. So why do these specific words carry so much gravity? Let's put them under the microscope. Exactly 3 words. I mean, I have to admit, the extreme brevity of our analytical task today is kind of comical. My producers actually handed me the source document, and I literally flipped the paper over looking for the rest of the text. But having only 3 words forces us to pay attention to every single syllable. Let's slow things down and take this apart piece by piece. We'll begin with the very first word, passive. Just think about the feeling this evokes. Before we even get to money or geography, the text opens with this highly seductive state of being. It immediately sets a tone that is the exact opposite of the hustle, the time cards, and the daily grind we typically associate with modern life. Now, what's really interesting about this word is how completely it rejects effort. Listen to the definition. Not participating actively. Inactive. Non-exerting. It inherently implies a state of rest and a complete lack of friction.
I mean, historically speaking, in the context of human survival, non-exerting usually meant you weren't going to make it. But here, it's presented as an aspirational baseline. You are at rest. You are inactive. And then, boom, we hit the second word, income. Feel the immediate shift in momentum there. We were just resting, right? We were inactive. And suddenly, we're confronted with income. This is exactly where the semantic tension is introduced, creating a friction that makes this brief phrase so intensely compelling to the human brain. Let's actually define income. Money received, especially on a regular basis, for work or through investments. Income traditionally implies an active gain. It implies a yield. It implies an earning mechanism that is entirely kinetic. You do something, you get something. You provide labor, you harvest the crop, you clock in, you receive income. It's basically the fundamental law of economic physics. Action equals compensation. And this brilliantly illustrates the core contradiction of our text. On one side, we have inactivity and absolutely zero effort. On the other, earnings, yield, and the direct result of work. Slamming these two completely opposing concepts together creates a powerful oxymoron. It's the irresistible psychological allure of getting the reward without the exertion. You achieve the earning while maintaining that resting state. Passive income isn't just a financial term. When you deconstruct it like this, it's the ultimate modern fantasy mapped out in 2 words. But the text doesn't just stop with that fantasy, does it? It brings us to the final word of our document, USA. This is a truly fascinating structural choice. The first 2 words were conceptual, right? They could exist anywhere in the human imagination. But by adding this third word, the text suddenly drops an anchor. It pulls the fantasy out of the clouds and slams it down onto a map. The United States of America. This isn't just a location. It's a specific, geographic, national, and economic anchor. Appending USA grounds the abstract tension of passive income into a very tangible, highly specific context. It taps right into the cultural heaviness of the American dream. It implies a system of capitalism, a legal framework of property and markets, a place where this contradictory fantasy of effortless earnings is theoretically supposed to be possible. It transforms the phrase from a universal human wish into a specific national destination. Let's move to and see how this builds, because this is where the phrasing really locks in. It's a step-by-step escalation. Step 1, passive, you desire rest. Step 2, passive income, you desire rest, but you obviously still require resources. The oxymoron is born. Step 3, passive income USA. You desire this contradiction, and you firmly believe there is a specific geographic theater where it can actually be realized. Each additional word dramatically shifts the weight and meaning, layering complexity onto an incredibly simple foundation. So we arrive right back where we started. But look at our complete text now. It feels a little different, doesn't it? The gravity has shifted. It is no longer just a random string of characters you might type into a search engine. Because we've deconstructed it, we clearly see the architecture, the longing for rest, the demand for resources, and the belief in a geographic promised land, bundled into just 17 letters. So the crucial point is this: isolation changes our understanding. When we take these 3 isolated words and place them exactly in this order, they form a complete, highly sought-after cultural artifact. They synthesize human psychology, economic desire, and national identity into the tightest possible package. What you should really take away from this explainer today isn't just a grammar lesson. It's the realization that language is deeply encoded. The things we desire most are often expressed in contradictions, like effortless reward, and we constantly seek a place, a USA, where those contradictions might magically resolve themselves.
We're unpacking the actual architecture behind American corporate dominance. We're talking about economic moats. We'll be exploring exactly how the most powerful companies in the U.S. build and fiercely defend their long-term competitive advantages, year after year, and honestly, decade after decade. Let's get right into it.
To frame all of this, let's start with a classic metaphor from Warren Buffett. The business is the castle. The competitive advantage is the moat. It's brilliant because, in our hyper-competitive capitalist landscape, high margins naturally attract invaders, right? So the moat is simply that structural defense system keeping competitors from just storming the gates and taking the treasure.
Section 1. Defining the economic moat.
So an economic moat isn't just, say, a trendy product or one single lucky great quarter. It's a distinct structural advantage that protects a company's market share and profitability over the long haul. It essentially ensures that when a rival tries to undercut prices or, completely clone a service, the original company can just hold its ground and maintain its core profitability.
There's a pretty stark divide in the corporate ecosystem. On one side, you have a wide moat company. This kind of business absorbs economic shocks and enjoys predictable, long-term profits, all because of its built-in defenses. But on the flip side, a no-moat company is entirely vulnerable. Without that structural defense system, competitors can easily replicate what they do, which inevitably drives their margins right down to zero. It's brutal out there.
Moving on to Section 2, the American market landscape.
Now, you might be thinking this is all just some abstract Wall Street theory, but it's actually about your wallet. Economic moats directly dictate the prices you pay at the grocery store, the software you rely on at work every day, and the brands you instinctively trust. When a U.S. company has a wide moat, they gain significant pricing power. That basically means they capture more of your dollars every single day without losing your business.
Which brings us to Section 3, Types of U.S. Moats. When we evaluate corporate dominance here in the USA, we're typically looking for 3 distinct blueprints. We've got the network effect, switching costs, and cost advantage. Let's unpack the actual mechanics behind each of these pillars so we can really understand how this defense is built from the ground up.
First up, the network effect. And honestly, the most fascinating aspect of this is that the users themselves do all the heavy lifting to build the moat. A platform becomes exponentially more valuable with every single new participant. Think about it. Once millions of Americans are locked into a specific digital marketplace or a social network, it becomes virtually impossible for some upstart to lure them away to a totally empty alternative.
Our second pillar is switching costs. This defense works by locking customers inside the ecosystem, making it just painfully time-consuming or really expensive to leave. Whether it's untangling your personal finances from a legacy bank or a massive company migrating its enterprise software, the company doesn't even need to have the absolute best product anymore. They just have to make leaving feel like the absolute worst option. And the third pillar is cost advantage. This one is an elegantly simple yet brutally effective moat. It's the sheer ability to produce goods or services at a consistently lower cost than literally anyone else in the market. When an American company achieves massive scale or maybe controls a unique process, their operating costs just plummet. And that allows them to do one of two things. They can drastically lower their prices to completely crush competitors, or they can keep their prices average and simply enjoy massive, untouchable profit margins.
Now, while a business might lean heavily on just one of these pillars, a truly unstoppable company combines them. By stacking the network effect, switching costs, and cost advantages all together, they create this multi-layered defense system. It essentially makes their market position and their profit margins virtually impregnable.
All right, Section 4, the future of competition.
Here's the catch, though. Modern innovation is fundamentally rewriting the rules of siege warfare. Step 1 is technological disruption, which introduces an entirely new way to solve a problem. That triggers Step 2. Accelerated competition, allowing agile startups to just completely bypass those traditional barriers. And Step 3, the legacy moat simply evaporates. Massive cost advantages mean absolutely nothing against free AI tools, right? And high switching costs? Well, they vanish with one-click migration software. The sieges today are faster and they are so much smarter.
Every single second, we're bombarded with this chaotic stream of data. Flashing red and green charts, algorithmic trading alerts, social media hype cycles, and 24-hour news networks literally screaming about the next big market crash or the next guaranteed moonshot. It's a total circus, basically designed to trigger anxiety, FOMO, and rapid emotional decision-making. But if you look past all that chaos and actually observe how the ultra-wealthy operate, you'll notice something completely different. They aren't glued to minute-by-minute candlestick charts. They absolutely aren't chasing the latest meme coin or tech fad. The most successful capital allocators on the planet, the individuals and institutions building true generational wealth, rely on a bedrock foundation that is, honestly, shockingly simple. So, in this explainer, we are going to strip away the distractions and the jargon to examine the absolute core of elite wealth generation. We're looking at a philosophy that serves as the ultimate financial moat. Let's dive right in.
When we strip finance down to its absolute essence, we're left with this massive foundational concept, value investing. Now, for the casual market participant, sure, this might sound like just another strategy on a giant menu of options. But for the financial elite, this isn't merely a tactic. It is a ruthless, ironclad discipline. It's literally the ultimate filter for high-level capital allocation. Operating under this framework requires an active, conscious decision to completely ignore the herd. It means acknowledging that the market is frequently irrational, driven by the bipolar swings of human greed and human fear. The wealthy understand that the crowd is almost always wrong at the extremes. Because of that, this concept acts as a psychological fortress. It protects their capital from the temptation of speculation. By strictly adhering to this philosophy, elite investors insulate themselves from the daily noise and operate on a completely different playing field, one where patience is weaponized and deep, fundamental truth always overrides temporary public opinion. To truly understand how this engine works, we kind of have to isolate the concept of value and redefine it through the lens of the wealthy. For the average person, value is so often confused with price. They look at what an asset is trading for on a random Tuesday and just assume, okay, that number reflects reality. The ultra-rich know this is an incredibly dangerous illusion. Price is simply what the market is asking. Value is what the asset is actually worth. Finding value means ruthlessly identifying the core utility, the cash-producing potential, and the enduring competitive advantage of a business or asset completely independent of its current market quotation. So, how do the wealthy actually do this? Well, they exploit the gap between a business's intrinsic worth and the public's emotional reaction to it. They're the ultimate contrarians. When a temporary macroeconomic shock sends the market into a blind panic and perfectly healthy, cash-flowing assets are sold off at steep discounts, that's when the elite step in. They are looking to buy $1 for 50 cents. They aren't looking at the sticker price. They're valuing the economic engine underneath. It requires intense observation, an obsession with fundamentals, and honestly, the emotional fortitude to buy when everyone else is frantically selling. They understand that true value just sits quietly, waiting to be recognized by those with the capital and the patience to look past the panic.
But here's the catch. Recognizing intrinsic worth is really only half the equation. The wealthiest individuals don't build empires just by sitting around observing value, right? They take highly calculated, aggressive action. And this brings us to the dynamic component, the actual mechanics of investing. For the elite, investing isn't about throwing a little bit of money at 100 different things and hoping something pops. That kind of over-diversification is often just seen as a hedge against ignorance. Instead, when the truly wealthy invest, they're making deliberate, asymmetrical bets. They patiently hold on to their capital, sometimes for years, just waiting for the perfect pitch. And when they finally spot it, that rare, undeniable intersection of high intrinsic value and a deeply discounted price, they don't just nibble. No way. They deploy capital with massive, overwhelming conviction. They take the resources they control today and aggressively drive them into that pocket of value to force a future outcome. It's a highly structured, strategic strike. This is the kinetic energy of wealth building. It shifts the entire paradigm from passively saving money to aggressively capturing mispriced reality. It is the absolute ultimate expression of delayed gratification, but it's fueled by cold, hard logic and a total refusal to act until the odds are overwhelmingly stacked in their favor.
So, what does this all mean when we put it together? This synthesis is exactly where generational wealth is minted. What happens when you combine the steadfast, contrarian pursuit of undeniable worth with the disciplined, highly concentrated allocation of capital? You create an absolutely unstoppable financial engine. This isn't just a pairing of two words, it's a philosophical marriage that dictates every single move an elite investor makes. Think about the profound power of this intersection for a second. It means you absolutely refuse to trigger the dynamic action of investing unless it perfectly aligns with the immovable truth of value. This acts as a permanent, unbreakable filter. If an opportunity doesn't possess deep, intrinsic worth, it literally doesn't matter how exciting the narrative is or how fast the stock is climbing, the capital stays locked away. Conversely, when true value is identified, the capital is never allowed to sit idle. It's deployed with ruthless efficiency. This combination is the ultimate financial moat that the rich build around their portfolios. It ensures their actions are never dictated by the chaotic noise of speculation, but are always permanently anchored in mathematical reality. By forcing these two concepts together, you stop reacting to the market and you start systematically extracting wealth from it.
As we wrap up this explainer on such a foundational philosophy, the real question isn't just about understanding the theory, it's about application. How might adopting the ruthless, value-first filter of the ultra-rich completely rewrite your own financial future? If you demand deeply discounted intrinsic worth before you ever allocate a single dollar of your hard-earned capital, what distractions suddenly fade away? What hyped-up trends do you easily just ignore? Imagine operating with that level of clarity. When the market inevitably panics again, instead of feeling fear, you'll be out there hunting for mispriced assets. By shifting your mindset from a reactive market participant to a disciplined evaluator of true worth, entirely new paths to wealth generation become clear. Let that challenge sit with you. Take a hard look at your own portfolio, question your recent financial decisions, and ask yourself, are you truly buying value, or are you just paying the market's price? Welcome back, Focus Learners. Today, we're looking at a foundational paradigm, but presented in its absolute minimalist form.
I mean, we have a highly concentrated source text today that literally strips away all the noise. The clutter, the endless charts, the sprawling data sets you typically see in any financial analysis. Instead, we're left with just the bare essence of a concept. We're going to unpack this core idea and really think about what it means right at its foundation. Okay, let's dive into this deliberately. We are looking at a fundamental strategy today, one that drives entire markets and shapes portfolios around the world. Yet here it is, distilled down to its absolute simplest expression. Now, what's really interesting about this slide is the sheer, unadulterated focus of this single word: growth. When we examine our source material, we're presented first with this concept just entirely isolated from everything else. In a business and financial context, growth represents the upward trajectory of value. It's all about a company increasing its revenue, expanding its market share, innovating new products, and scaling its operations, right? The source doesn't qualify it. It doesn't soften it with terms like incremental or steady. No, it gives us the pure concept to confront. So what does it truly mean for an asset to grow? Well, it means a consistent push toward greater intrinsic value and expanding potential. It's a forward-looking posture, really aiming for a future state that is significantly larger and, frankly, more dominant than the present. It's absolutely a powerful starting point for any analytical framework. Let's move to and see how this builds. We transition from a state of pure expansion to a very grounded action: investing. It implies a deliberate, highly calculated commitment of resources. We're talking about time, energy, and most importantly, capital. The source text introduces this second element with a real sense of purpose. It's not just some casual financial term, it's honestly an entire philosophy of delayed gratification. It's the act of allocating capital today with the rock-solid expectation, backed by rigorous analysis and strategy, of course, that it's going to yield something substantially more over time. By isolating this one word, the source material forces us to respect the pure mechanics of the act itself. If the previous concept was the ultimate target, well, this is the engine. It's the practical mechanism we use to deploy our resources into the market, taking on measured risk for that future reward. And this brilliantly illustrates the synthesis, the inevitable collision of our two isolated concepts. When we bring them together exactly as they appear in our source text, growth investing, a totally clear, actionable strategy emerges. The raw potential of growth is suddenly harnessed, it's channeled, and it's given direction by the disciplined mechanics of investing. The source material pairs these two concepts perfectly to define a unified paradigm. It is literally the deliberate, calculated act of committing capital specifically toward the pursuit of expansion. It means prioritizing companies or assets that show the highest potential for future value creation. Often this means looking at companies that might be reinvesting every single penny of their capital back into the business, rather than, say, paying dividends right now. It's all about allocating resources toward an expansive future. This synthesis is the ultimate takeaway of our explainer today. It's just this elegant economy of two words working in perfect harmony to describe a massive, incredibly dynamic sector of the financial world. So, the crucial point is, how are you going to engage with this strategy? We've stripped it completely down to its foundation. We've examined the upward trajectory of the first half, the rigorous discipline of the second, and the really powerful synergy of their union. The source text gives us the core framework, but, it leaves the actual application entirely up to us. As focused learners, you now have the conceptual baseline. The idea is reflecting right back at you, prompting a response. How will you apply this fundamental concept to your own strategies, your own portfolio, or even just your understanding of the broader market? Does prioritizing future expansion really align with your goals, or do you seek something else? I'm going to leave you with this final thought to ponder deeply as you move forward. We've got a seriously fascinating concept to unpack today, one that literally cuts right to the core of mastering the modern American financial landscape. Whether you're trying to manage your household budget, running a local storefront, or scaling a massive nationwide enterprise, the way we think about money here in the United States requires a very specific toolkit. So, we're going to break down exactly what that toolkit looks like using just a single piece of source text. We're taking abstract concepts and turning them into clear, actionable strategies, so you can see exactly how all the pieces fit together. Let's get right into it.
Okay, I want to start by asking you a quick question. Are you just driving, or do you actually have a map? Think about your classic cross-country American road trip. You wouldn't just, jump onto Route 66 or Interstate 80 without knowing your destination, checking your gas gauge, or looking at the weather ahead, right? Yet when it comes to money, a lot of folks are basically just driving blind, kind of hoping they end up somewhere good. In this explainer, we're going to lean into this road trip analogy to make our core concepts really tangible. Because the terrain we're navigating today isn't asphalt and dirt. It's the financial landscape of the United States.
Now, our source material today is literally just 5 words. Advanced, financial, intelligence, USA-based. I know, they might look pretty simple at first glance, but these words, they're going to serve as our complete roadmap for today's analysis. Every single strategy we discuss is packed right into this one phrase. Our job is to unpack it word by word and show you exactly how to build this specific type of capability for yourself. Okay, let's dive into this with Section 1, Decoding Financial Intelligence, the Foundation. So, the absolutely crucial point here is understanding what baseline financial intelligence actually is. It's defined as the baseline capability to understand and navigate financial principles. Going back to our road trip analogy for a second, having basic financial intelligence is kind of like knowing how to read the dashboard gauges on your car. You know exactly how much fuel you have in the bank. You know your speed, which is your income versus your expenses. And you know if the check engine light is blinking. Maybe that's a credit card bill getting a little too high, right? It's fundamental, it's totally necessary. But, as we're about to see, on its own, it's just not quite enough to master the complexities of the modern American economy. Which brings us to Section 2, the advanced difference, looking ahead. Let's actually compare these two directly. On one side, we've got basic financial intel. This is highly reactive. It's looking at your current bank balance and deciding if you can afford to buy dinner tonight. It's basically looking down at the pedals while you're driving. But on the other side, we have advanced financial intel. Now, this is looking a full mile down the road. It's anticipating that nasty traffic jam way before you hit it. It's knowing, hey, there's a toll booth coming up in 3 miles, and making sure you already have the exact change ready to go in your cup holder. Basic intelligence tells you where you are right now, but advanced intelligence, it dictates exactly where you're going and how you're going to maneuver around all the roadblocks to actually get there. So let's break down the engine of this advanced capability. First off, it's forward-looking. You aren't just filing last year's taxes, you're actively projecting next year's liabilities. Second, it's strategic. Every single dollar is a tool with a very specific job to do, rather than just being a byproduct of your labor. And third, it's highly adaptive. When interest rates change or, inflation spikes, an advanced mindset doesn't panic, it pivots. The word advanced from our source text implies a proactive, finely tuned engine. It means you aren't just reacting to the financial weather, you are completely prepared for it, no matter what it does. Moving right along to Section 3, the USA-based context, rules of the road. Now, I want to pose this direct question to you. Why does USA-based actually matter? Why did our source text specifically include those 2 words? Well, it matters because the American financial landscape has very specific, frankly, incredibly complex rules of the road. You can be absolutely brilliant with money in an abstract, theoretical sense, but if you don't understand the specific mechanics of the United States system, your engine is going to stall out pretty fast. Just consider the distinct American landscape elements at play here. First, you have local market dynamics. The difference between real estate in Ohio versus California is just staggering. Then you've got the specific U.S. tax environments. Now look, if you've ever tried to explain the United States tax code or the whole concept of an American FICO credit score to someone from another country, you know exactly why this requires a specialized skill set. It is a total labyrinth of federal, state, and local regulations. And finally, U.S. currency strategy, understanding how the dollar operates both domestically and globally. USA-based isn't just some geographic tag. It is an entirely distinct set of financial physics. And this brilliantly illustrates Section 4, Real-World Application, Theory Meets Practice. Let's put this into practice. Imagine you're running a small business, maybe a boutique marketing agency in Chicago. Or perhaps you're managing a complex household budget down in Texas, juggling college funds, 401ks, and a mortgage. Here's how it all comes together step by step on our road trip. Step 1, you map the route. That's your baseline intel. You know your monthly overhead, your payroll, your household expenses. Step 2, you anticipate the traffic. This is your advanced strategy. You foresee that supply chain costs might rise next quarter. So what do? You adjust your pricing model today. You build an emergency fund because you know an economic pothole is eventually coming. And step 3, you navigate the U.S. highways. This is your U.S.-based execution. You utilize specific U.S. tax deductions for your business. You optimize your capital based on Federal Reserve interest rate shifts. You leverage American retirement accounts like IRAs to protect your wealth. You see how that works? The whole phrase operates as a single, unified strategy. Which brings us full circle, right back to our original source phrase, advanced financial intelligence USA-based, When we started this explainer, it was just a string of text. But by breaking it down, we've moved from simply checking the dashboard to anticipating the road ahead to mastering the highly specific, complex highways of the American economic system. It really is a solid, complete blueprint for how you manage your money day to day. So, I want to leave you with this final thought. Is your financial intelligence actually built for the advanced American landscape? Are you just driving around, hoping for the best, reacting to every single bump in the road? Or are you applying a forward-looking, highly strategic, specifically USA-tailored map to your financial future? Take a hard look at your own dashboard, evaluate your route, and start driving with advanced intention.
Instead of, burying ourselves in massive spreadsheets, we're actually going to dissect a singular, incredibly dense financial axiom. It's literally just 6 words long. But these 6 words, they basically form the blueprint for understanding how massive systems, like Wall Street, actually operate, and the exact mindset you need to successfully navigate them. Let's dive in.
So, let's just let this exact source text hang out for a second to set our boundaries. Market cycles, advanced financial intelligence. It's super brief, right? But it establishes this incredible direct relationship between 2 massive concepts. Over on the left, we've got the environment, the market itself, and on the right, the required human response. We're going to unpack that structural bridge connecting them.
Section 1. The core statement. Analyzing those 6 words.
Which brings us right to Section 2, defining market cycles. Let's really isolate that first half of our source material.
If we're going to build a solid framework for financial intelligence, we absolutely have to understand the terrain we're operating in first, market cycles. Now, when you hear the word market, your brain probably jumps straight to that chaotic trading floor of the New York Stock Exchange. Guys yelling, papers flying, the whole shebang. But when you add the word cycles to it, the whole perspective shifts. Think about the historical ebbs and flows of the U.S. economy. You've got the huge dot-com boom of the late 90s, and then the bust, or the 2008 housing crash. Using the word cycle implies a hard truth. What goes up must eventually come down, and vice versa. It's this relentless mechanical rhythm.
A cycle is definitely not a straight line. It's defined by inherent, continuous phases of repetition within a system. Look, the market absolutely does not care if you're feeling wildly optimistic about your portfolio or totally panicked. Those phases, they're going to just keep grinding forward regardless. If you're expecting a straight line of infinite growth in a cyclical reality, well, you're pretty much setting yourself up for failure.
So, what connects cycles to intelligence? This brilliantly illustrates the exact mystery we need to solve. I mean, how does the cold, unfeeling, mechanical nature of a cycle actually link up to the human element? If the market cycle operates with 0 empathy and 0 strategy, how are we supposed to successfully interact with it? And that perfectly tees up Section 3, Advanced Financial Intelligence, the cognitive response.
Let's look at the second half of our foundational text. Notice the deliberate, heavy capitalization of advanced financial intelligence here. It's screaming at us, signaling a much higher, highly strategic level of awareness. Because, let's be honest, basic financial literacy, knowing how to balance a checkbook or remembering to max out your IRA every year, that's just the price of entry these days. Navigating massive, repeating financial cycles, that requires a highly elevated, specialized state of mind. We can define this concept strictly as heightened awareness and strategic understanding applied to financial environments. Awareness basically means you aren't blind to the cycle. You can actually spot when the market is dangerously overheated, and strategic understanding, that means knowing exactly what to do about it. It's essentially the Warren Buffett approach, right? Being fearful when others are greedy and greedy when others are fearful. Advanced financial intelligence is having that strategic playbook ready to go. Let's put these 2 forces head to head for a second. On one side, you have the environment. It's mechanical, repetitive, totally external, and completely indifferent to you and your money. On the other side, you have the response, strategic, active, internal, and fully engaged. The cycle is what happens to the broader economy. The intelligence is what you actually do to navigate it. It's like this eternal, high-stakes dance between the massive system and the individual strategist. Moving on to Section 4, Synthesizing Cycles and Intelligence, the dynamic tension. Now, let's bring these isolated concepts back together. Looking at the complete phrase again, consider how advanced intelligence is literally the only way to truly interpret and anticipate the turning of a market cycle. Think about it. Without that second half of the phrase, the first half, the cycle itself, will just steamroll you. But with it,
The cycle transforms from a threat into a predictable rhythm that you can actually use to your huge advantage. Does intelligence change how we experience the cycle? Absolutely. Actually, scratch that, it changes everything. If you lack this awareness, a Wall Street cycle basically feels like riding a roller coaster in the pitch dark. You get thrown up during a massive bull run, plunge straight down in a bear market, and you're just reacting entirely out of raw fear or greed. But once you apply advanced intelligence, boom, the lights turn on. The terrifying drops and the massive climbs, they still happen, cycles are continuous, remember, but now you anticipate them. You completely transform from a reactive victim into a proactive strategist.
So, as we wrap up this explainer, look at this foundational concept one last time. We've taken just 6 words and unpacked an entire massive philosophy of systemic repetition and strategy. The text makes it absolutely crystal clear market cycles are coming and they will continually repeat. No way around it. The only thing you actually have control over is your cognitive response.
Your mind versus your wallet. We make financial choices constantly, right? From deciding whether to upgrade to the newest smartphone to locking in a 30-year mortgage on a house. But how much of that is driven by pure logic, and how much is driven by invisible psychological forces? Today, we are going to unpack exactly what goes on inside our heads when our hard-earned money is on the line. So, ask yourself, are you actually in control of your money, or is your brain playing tricks on you? You know what I mean. Why do incredibly smart people suddenly make completely illogical financial choices? Think about it. Why do we see mass panic selling during a sudden Wall Street dip, even when history tells us the market eventually recovers? Picture that visceral, gut-wrenching feeling of watching your retirement ticker drop 20% on a random Tuesday morning. Or on the flip side, why do we buy at the absolute peak when everyone else is buying, gripped by the fear of missing out, only to sell at the absolute bottom when fear takes over? The answer isn't a lack of intelligence. It's a profound quirk in human nature. Here's how we're breaking it all down today. First, the myth of rationality. Second, defining behavioral finance. Third, real-world money traps. And fourth, outsmarting your own brain. Okay, kicking things off with part 1, the myth of rationality. For decades, classical economics was built on this kind of wild assumption. It basically assumed we were all these perfectly rational actors, like literal calculating robots that only cared about maximizing wealth and had zero emotions. The perfect investor. But come on. The real you is an everyday American frantically checking your 401k on your smartphone because Wall Street is selling off and the news headlines are screaming at you. The reality, we stress, we follow the herd, and our money decisions are incredibly heavily emotional. Which brings us to Section 2, defining behavioral finance. So once we finally admit that we aren't perfectly calculating robots, we need a completely new framework to understand how we actually operate. That's where behavioral finance comes in. It's the field that formally bridges psychology and economics. For years, traditional economists literally had to realize their models were failing. Why? Because they forgot to factor in stuff like human panic, unbridled greed, and immense social peer pressure. This field formally admits that our inherent biases and our emotions fundamentally hijack our wallets. It is, quite simply, the science of why we do dumb things with our money, even when we absolutely know better. All right, let's get into the fun stuff. Section 3, real-world money traps. To really get a handle on our everyday blind spots, we have to talk about the massive emotion gap in investing. The market itself actually performs pretty consistently over time, steadily growing wealth. But the average investor's return? It's significantly lower. Why is that? Well, it's FOMO. People see their neighbor making a quick buck on a trending stock, so they dive in right at the absolute peak. Then, when the market inevitably dips, they pull all their money out in pure, unadulterated panic. That huge gap between the market's return and the investor's return, that right there is the exact literal price tag of emotional trading. And this highlights an incredibly powerful truth. Understanding your own psychology is actually way more important than understanding a complex financial spreadsheet. Seriously, Wall Street is absolutely littered with the crashed careers of literal mathematical geniuses whose incredibly complex models totally blew up. Why? Because when a recession hit, they couldn't control their own behavioral panic. You can have the greatest economic algorithms in the world, but if human fear grabs the steering wheel during a downturn, those models are completely useless. Now here is a fascinating little number that explains a ton about our behavior, 2 times. Psychological studies have actually proven that the psychological pain of losing money is twice as powerful as the joy of gaining that exact same amount. Think about it. Finding a crisp $100 bill on the sidewalk? Yeah, that makes you happy for sure. But losing a $100 bill out of your wallet? Oh man, that absolutely ruins your entire afternoon. Our emotional scales are just completely out of whack. This specific phenomenon is called loss aversion. Because losing hurts us so deeply, we will do almost anything to avoid locking in a permanent loss. It perfectly explains why you might hold on to a plummeting tech stock way too long, just crossing your fingers and hoping it bounces back so you don't have to admit defeat. Actually hitting that sell button makes the loss permanent. It heavily bruises the ego. Our brain entirely refuses to accept the failure, and as a result, our wallet just keeps on bleeding. And then, oh boy, there's the sunk cost fallacy. This is where we keep pouring money into a terrible investment simply because we've already committed resources to it. Think of that classic American scenario, the fixer-upper car. You're at the mechanic, you've already dropped $2,000 trying to fix the transmission. You drive it off the lot, and a week later, boom, the radiator completely blows. And you spend another $2,000 because in your head, you've already put so much money into it. Logically, you should just cut your losses and buy a different, reliable car. But emotionally, you are totally tethered to the money you've already sunk into that lemon. We also fall hard for mental accounting. This is a sneaky trap where our brains stubbornly categorize money differently depending on exactly where it came from. For example, millions of Americans will responsibly save their hard-earned biweekly paychecks, right? But then spring rolls around, they got a massive $3,000 tax refund from the IRS, and their brain instantly labels it as lottery winnings. Instead of using it responsibly to pay off high-interest debt, it's suddenly free money to be blown immediately on a vacation or a giant new TV. But listen, your credit card company does not care if the dollars you use to pay your bill came from a year-end bonus, a tax refund, or your regular salary. Money is completely fungible. A dollar is a dollar, regardless of how it entered your checking account. Moving on to our final section, outsmarting your own brain. So knowing that our brains are wired this way is incredibly validating, but how do we actually protect our finances from our own hardwired human nature? Well, you can actively outsmart your own brain with a highly structured 3-part plan that kills impulse decisions. Step 1. You have to loudly acknowledge your biases. You aren't magically immune to fear or greed. Step 2. Automate your savings and investments. Automation is a game changer because it entirely removes willpower from the equation. If your money is automatically deducted from your paycheck before you even see it, you literally don't give yourself the chance to spend it emotionally. And step 3, enforce a mandatory cooling-off period, say 48 hours, before acting on major market news. This works because it physically allows your amygdala, the brain's panic center, time to calm down before you go anywhere near your portfolio. By adopting these specific habits, you completely shift from being a reactive, emotional spender to a proactive, highly disciplined manager of your own financial future. You've got to set long-term goals and let them be your definitive financial anchor so you don't get swept away when everyone else is panicking. Ignore the daily sensationalized Wall Street frenzy flashing across the financial networks. Start treating every single dollar equally, whether it's a hard-earned paycheck, a surprise bonus, or a tax refund. And honestly, perhaps most importantly, do absolutely everything in your power to not log in and check your retirement balance when the market is crashing. Seriously, you are only inviting that dangerous panic response. We're diving into something, well, kind of wildly different. We are going to deeply examine what just might be one of the most incredibly minimalist, yet genuinely fascinating pieces of source material we've ever come across. I mean, think about it. We live in a world absolutely saturated with massive data sets, 100-page reports, and just this nonstop barrage of information, right? So there is something profoundly striking about stripping absolutely everything away. What actually happens when we're left with almost nothing? What happens when a source gives us the absolute bare minimum, basically forcing us to engage deeply with the literal structure of the words themselves? Well, that is exactly what we're going to do right now. We are going to analyze a 2-word artifact. All right, let's just jump right in. Take a second to simply look at the exact raw text we're examining today. This is it in its entirely unedited, unaltered form, Wealth Psychology. That's it. That is the complete entirety of our source material. There are no sneaky footnotes, no long introductory paragraphs, no complex charts to decipher. Just these letters, arranged exactly as you see them, staring right back at us. It's incredibly stark, isn't it? It demands your attention simply because it refuses to give you literally anything else to look at. Now, what's genuinely fascinating here is how we can isolate our text into 2 very distinct pillars. To really build our understanding of what this artifact represents, we have to recognize that this isn't just a random assortment of letters. It's a structural pairing. We have the first pillar on one side and the second pillar on the other. By breaking this text down into its two fundamental components, we can actually start to analyze the weight, the meaning, and the exact physical presence of each piece before we even try to understand how they interact with each other. Let's see how this builds, starting strictly with that very first word, wealth. This is our entryway into the source text. It's the very first concept the original author decided to plant in our minds. And notice how it's spelled totally conventionally. It feels solid, right? It feels completely recognizable. It's a heavy noun that carries centuries of human history, struggle, and aspiration, all packed right there into those 6 letters. So I want you to actively ponder the implications of this for a second. When you see wealth isolated like this, what does it actually evoke for you? It represents resources. It represents abundance. It's capital, security, power. But here, stripped away from any surrounding sentence or context, it just sits there. It is a massive material concept trapped in this minimalist vacuum. It has incredible gravity, but without context, it leaves us totally suspended. We're essentially just waiting for the other shoe to drop, primed for some grand revelation about money, waiting for the source to tell us what to do with this heavy concept of wealth. And well, that brings us here. We're now shifting our focus to the second, highly specific word in our text. And I really need you to look very, very closely at the exact spelling right now. We have to observe its presentation exactly as it was provided to us in the raw source material. Pyschologig. Now, to be clear, this is not a typo we are correcting. This is the definitive data we have been given. This is the exact second pillar of our text. Consider the nature of this second word. I mean, why psychology with this specific, totally unique arrangement of letters? The S and the H are literally swapped. What could this specific spelling signify about the human mind? Is it a brilliant accident or a highly intentional disruption? Think about it. When we're dealing with the massive, heavy concept of wealth, the human mind rarely functions perfectly logically, does it? Things get scrambled, letters get swapped, our internal processing gets a little disjointed. This unique spelling brilliantly captures the unpredictable, sometimes chaotic nature of the human brain when it is suddenly confronted with money, which brilliantly illustrates the stark juxtaposition of our two concepts sitting right next to one another. On one side, we have wealth, solid, traditionally spelled, representing the concrete, physical world of resources and capital. And right next to it, we have psychology, abstract, uniquely spelled, slightly scrambled, representing the totally unpredictable human condition. We are literally looking at a visual representation of the external world crashing headfirst into the internal world. So the crucial point here is to think about the friction and the connection between these two sides. What actually happens when the cold, hard material of wealth collides with the delicate, scrambled mental state of psychology? The money we hold in our hands or keep in our bank accounts is governed by absolute mathematical rules. 2 + 2 is always 4. But the mind we possess, the psychology that interprets that money, is emotional, it's biased, and it's highly prone to error. Our source text is forcing us to confront this exact intersection. I'm going to do something I don't normally do. I want us to take a remarkably long pause right here. Let's treat the source text almost like a profound mantra. I'm going to stop talking for just a few seconds. I just want you to let the sheer simplicity, the stark reality of these two words really sink into your mind. Feel the combined weight of these two distinct concepts hanging in the silence. Okay, welcome back. We are now going to look at how these two isolated pillars actually function together as a single, combined artifact of information. We've looked at the concrete nature of the first word, and we've analyzed the uniquely scrambled nature of the second. But remember, the source material doesn't present them on different pages. It presents them together. This is the synthesis. This is where the true meaning of the artifact actually lives, right in that negative space between the two words. Notice the sequential experience of reading the text. In Western languages, obviously, we read left to right. Therefore, the source material dictates a very specific timeline of experience. Step 1. First, we are hit with a material concept. We encounter wealth. We absorb its weight. Step 2. Second, we have to process it mentally. We move to psychology. The text is literally charting the human experience of acquiring a resource and then having to mentally deal with the consequences of that acquisition. It's a journey from the wallet straight to the brain. You know, in a world that is constantly trying to add spin, political context, or just endless caveats to every single piece of information we consume, there is immense value in recognizing the strict limits of our source today. By stripping absolutely everything else away, we can focus our learning strictly on the only two profound data points we actually have. Point 1, wealth.
Point 2, psychology. We don't need to add anything else to derive a deep, meaningful lesson about the intersection of resources and the human mind. The constraint itself is exactly what makes this analysis so incredibly powerful. Once again, we isolate the phrase. As we near the end of our analysis today, allow the silence of the visual to echo the exact source text in your mind. See the wealth. Acknowledge the psychology. Recognize that beautiful inherent friction between the perfect noun and the scrambled, chaotic study of the mind. Finally, I want to leave you with this provocative thought as we wrap up this explainer. How do you personally reflect on this exact minimalist phrase we've explored today? When you think about your own resources and your own mind, do you see the clear, solid lines of wealth, or do you feel the slightly scrambled, highly complex reality of psychology? The source text doesn't give us the answers. It only gives us the parameters. It is entirely up to you to figure out how they interact in your own life.
For those of you looking to really elevate your advanced financial intelligence, the American style of wealth building often gets buried under complex algorithms, endless Wall Street jargon, and let's be real, those overly complicated charts. Well, scratch all that. Today, we are meticulously deconstructing the foundation of it all, and it actually boils down to precisely two simple words. Because true financial acumen, it doesn't start with wild day trading, it absolutely starts with a crystal clear understanding of the core mechanics.
Portfolio management. It's incredibly minimalistic, yet it's literally the absolute bedrock of modern finance. Okay, let's dive into this, because when retail investors see these two words mashed together, they kind of just gloss over them as a single blurry corporate buzzword, right? But there is actually a very deliberate, step-by-step operational instruction hidden right there in plain sight when you read it for what it truly is. Honestly, this is exactly how high net worth individuals approach their wealth compared to the average retail investor.
To really wrap our heads around the whole thing, we've got to first split it apart. We're isolating these components into two completely separate, distinct entities. So on the left side, we have portfolio, which simply represents the collection. And then on the right side, we have management, which represents the action. And listen, missing this stark distinction is exactly where millions of everyday Americans lose their edge in the real world. They focus entirely on what they own, and they totally forget what those assets are supposed to be doing for them. We literally have to treat them as independent variables before we can understand how they interact together. Let's break them down one by one.
Now, what's really interesting about this slide is that a portfolio is defined simply as a complete collection or grouping of assets. Notice the implication here, guys. It inherently implies something static. It's a noun. Think about a standard 401k left over from an old employer, or maybe a collection of S&P 500 index funds just kind of sitting around in a brokerage account. You might have a vast collection of resources, sure, but right now, they're just sitting there. They are waiting to be organized. It's pure, unharnessed potential energy that, by itself, does absolutely nothing to adapt to changing market conditions.
And so that brings us to the necessary solution for that static, potentially chaotic collection: management. By definition, this is the active process of organizing, directing, or controlling. It's a verb. It's all about forward momentum. In our advanced financial frameworks, just having a collection of assets isn't going to cut it. You have to apply deliberate, calculated control over them. Management is the kinetic energy, the force that takes the raw materials of your collection and actively shapes them. In the real world, this looks like tactical asset allocation, quarterly rebalancing, or, aggressive tax loss harvesting to offset capital gains and actually protect your wealth.
Let's move to and see how this builds. When we look at the synthesis, which is action applied to assets, a completely new paradigm is generated. We're taking that static collection of index funds or real estate from the left side and actively slamming it into the kinetic strategy on the right side. Boom. It is no longer just a pile of money sitting in a stagnant account, and it's definitely no longer just an abstract concept of control. It becomes the real-world application of strategy. These two words desperately need each other to generate actual yield, outpace inflation, and create lasting, generational value for your family.
So the crucial point is understanding the timeline and the order of operations here. You simply cannot manage what you haven't formally grouped together, right? And grouping things without managing them, well, that's just hoarding capital, while inflation slowly eats away at your purchasing power, and nobody wants that. Look at the flow. Step 1, establish the portfolio. You gather your capital. Step 2, apply management. You inject your strategy. This chronological flow is exactly what the structure of the phrase itself dictates. It literally acts as a two-step instruction manual for execution. And this brilliantly illustrates our core thesis today. Portfolio plus management equals organized action. In the American financial landscape, this equation is the absolute fundamental difference between simply owning a few stocks and actually driving compounded strategic outcomes. It is a real game changer. It's an incredibly powerful philosophy distilled down to its purest form. You're taking full ownership of a collection and relentlessly driving it forward through active strategic control.
Which brings us to the ultimate lingering question that I want to leave you with today. Seriously, ask yourself, is your portfolio truly under management? Or is it just a static collection of assets? You know, maybe a forgotten IRA from 3 jobs ago, or a stagnant stock account just sitting idle. Think about the stark distinction we've deconstructed today. Look at your own resources this week and figure out if they are generating kinetic energy or just collecting dust.
I am so glad you're here with me. Look, today we're going to dive deep into a profoundly simple, yet literally massive concept derived directly from our source text. You know how it is in the world of finance, we get completely bogged down in complex data, sprawling charts, and dense economic jargon. But honestly, sometimes the absolute best insights come from stripping all of that away and just looking at the bedrock of an idea. Like, get this, in the realm of advanced American finance, there's this sobering reality. Roughly 70% of wealthy families lose their wealth by the second generation, and a staggering 90% lose it by the third. Crazy, right? But it's true. That's exactly why mastering the foundation is absolutely crucial. Today, our entire source material boils down to exactly 2 words. But the conceptual gravity packed into these 2 words, it literally defines whether a family's legacy thrives for centuries or just crashes rapidly back to zero.
Okay, let's dive into this. Generational wealth. I'm actually going to intentionally slow down our pace right here, because I really want you to just sit with the stark reality of the text provided in our source. You hear this phrase tossed around all the time, right? It gets reduced to a buzzword on social media or this kind of distant, abstract goal. But when you isolate it, when you strip away all the noise and let those 2 words stand completely alone, you start to really feel their weight, especially when you hold them up against the traditional American dream. I mean, think about it. Most Americans are hyper-focused on income. We're chasing that higher salary, a bigger bonus, or just crossing our fingers for a single good year in the stock market. But true financial intelligence? It shifts the focus completely away from just a single lifetime. This isn't just about grinding to pay off a 30-year mortgage. This phrase defines entire human trajectories. It's the ultimate distillation of long-term planning and material survival.
Now, what's really interesting about this slide is how it breaks down our source text to reveal its true architecture. We're doing a bit of a conceptual deconstruction here. On one side of the equation, we've isolated the root component, generational. Think of this side as an hourglass. It's entirely about time, massive horizons, and the actual mechanics of passing something down from one distinct era to the next. We're talking like 50 to 100 years of compound interest. And then, on the other side, we have wealth. Think of this as the treasure chest. This is the material side of the whole shebang, focusing strictly on tangible resources, assets, and sheer accumulation. By splitting the source text in half like this, we're uncovering a collision of 2 completely different dimensions, the dimension of time and the dimension of matter. Let's unpack that time dimension first.
The word generational. I mean, think about what that actually means in practice. We usually think of a generation as, 20 to 30 years? But in the realm of advanced finance, when we use the word generational, we are meditating on time horizons that go way beyond a standard American career. We're talking about the connective tissue between lifespans. Truly wealthy families don't just plan for retirement at 65. They use mechanisms like irrevocable trusts and multi-generational tax planning to make sure their financial foundation outlives the original creator. It implies an unbreakable chain. Actually, it's kind of an acknowledgement of mortality, but at the same time, it's a defiance of it through structured lineage. When a concept is truly generational, it's the unbroken thread linking the past, the present, and a future that the original architect will literally never even live to see.
All right, let's shift our focus to the second half of our phrase, wealth. When we define wealth purely in this context, we're looking at the sheer weight and implication of accumulation. And it's absolutely crucial to draw a line in the sand here between income and wealth. Income is what you earn today on your W-2, right? And as we all know, it's heavily taxed. But wealth is what you keep. It's accumulated resources. In the American financial system, wealth is basically stored energy in the form of capital assets that give you ultimate leverage. We're talking about equity in private businesses, robust commercial real estate portfolios, and heavily compounded investment accounts tied to indices like the S&P 500. This is the physical and financial fortress a person builds around themselves. It's a state of abundance that acts as an impenetrable buffer against all the crazy unpredictability of the global economy. So the crucial point is what happens when we cleanly merge these two deconstructed words back together into their original unified form. Generational wealth. It's the ultimate synthesis of time and resources. And this is where advanced financial architecture truly begins. Take, for example, the step-up in basis in the U.S. tax code. This literally allows families to pass down massively appreciated assets to their heirs entirely tax-free. Or consider the family bank model, where a family pools its resources to fund the next generation's entrepreneurial ventures instead of relying on traditional bank loans. That is what this synthesis looks like in the real world. It's stored energy successfully handed off in a relay race of family lineage. It's the transformation of temporary, individual success into a permanent, structural advantage for an entire family tree.
Which brings us to a really profound question. Why do these two words hold so much incredible power when placed side by side? I want you to reflect on this internally for a second. The power really comes from a potent combo of deep human instinct and stark financial reality. On a purely human level, it taps into our instinct to protect our kids and leave a permanent mark on the world. But financially, it's so powerful because it shifts you from playing a finite game to an infinite game. A finite game is just saving up enough for your own personal retirement. The infinite game, though, is establishing a multi-generational endowment that just self-perpetuates. When you put generational right next to wealth, you are elevating finance into the realm of permanent legacy. You're basically turning your capital into a time machine.
And this brilliantly illustrates exactly what I mean. We are back to our original source text. Just the two words. But I bet the concept feels completely different now than it did just a few minutes ago, right? After breaking these words apart, really meditating on those vast spans of time and the heavy accumulation of resources, and then fusing them back together, your understanding has fundamentally shifted. Contrast this advanced framework with the typical American reality, where millions are unfortunately trapped in a cycle of auto loans, credit card debt, and just living paycheck to paycheck. Breaking out of that cycle to truly master generational wealth, that is the ultimate outlier achievement in modern society. It's no longer just a casual phrase. It is a monumental concept in the absolute blueprint for enduring impact.
So as we wrap up this explainer, I want to turn this entire concept directly back over to you. What does generational wealth actually mean in your own life? Based on the foundation we've unpacked today, how do you define it for your family? Is it purely financial capital, or is it also human capital, like a legacy of education, of really strong values, an entrepreneurial mindset, and just raw opportunity? Because at the end of the day, the financial capital can only survive if the invisible human capital is passed down right alongside it. I genuinely want to leave you with that provocative thought, because understanding the immense, multidimensional weight of these two words, that is the very first step in actually building what they describe.
We are officially looking at the end of the American Financial Masterclass. We've chewed through a massive amount of complex material over this journey, but today is where we synthesize the whole shebang into one definitive, overarching strategy. Look, if you've been following along, you already know that gathering financial knowledge is, well, it's really only half the battle, right? The real magic happens when we pull back and look at the macro view. We're going to break down the exact language and structure of this final piece of source material to uncover the ultimate goal behind all of our financial efforts. So let's get to it.
We have officially reached the final chapter. But what does that actually mean for us? Well, in the context of everything we've covered, those two words are incredibly powerful. They are a massive green light, signaling that it's time to shift away from just passively gathering information and move into absolute integration. You know, a final chapter isn't just an ending, it's a resolution. It's that exact moment where all those loose threads finally get tied together. Recognizing this means realizing that the learning phase, the accumulation of all those isolated financial tactics, is totally complete. Now, it is time to build.
Section 1. The Ultimate Plan. Introducing the Blueprint.
Now, to really grasp this blueprint, we can't just view it as some abstract pie-in-the-sky idea. It is a unified architecture. Literally, it is the master plan we've been building toward this entire time, and it's designed to organize all of your individual financial strategies. We're talking everything from tax loss harvesting and asset allocation right over to real estate equity and estate planning into a single, cohesive engine. Because, let's be real, you don't just accumulate a bunch of disconnected accounts and cross your fingers hoping for the best. No way. You construct a deliberate, overarching strategy that actually gives all those individual pieces a distinct, powerful purpose. I want you to really notice the specific phrasing in our source text, the Financial Freedom Blueprint. It doesn't say the Financial Survival Guide. It doesn't say the Wealth Accumulation List. It explicitly specifies freedom, and it specifies a blueprint. And that implies something absolutely crucial. Financial independence isn't just some happy accident or the result of one lucky stock pick. Not at all. It is something that is deliberately designed, drafted, and constructed from the ground up. And that is exactly what you're holding in your hands right now.
Moving on to Section 2, the mechanism. Integration of all elements. Now, this perfectly illustrates the core tension that gets resolved in this final chapter. Think about it. We all start with everything, just this chaotic pile of savings accounts, aggressive investment portfolios, strict budgeting rules, maybe a handful of tax strategies. And having everything is great. Honestly, a lot of people just stop right there. But the monumental shift, that happens when all of that works together. The blueprint is the exact thing that transforms a scattershot approach into an integrated powerhouse. Your finances only become a reliable vehicle for actual freedom when every single piece is working in total harmony.
If we actually deconstruct the exact phrasing of the source text, we uncover a super clear 3-stage progression for achieving this financial synthesis. Step 1 is establishing the blueprint. You absolutely must have the master plan first. Step 2 is acknowledging everything, basically gathering all your individual financial elements and putting them squarely on the table so you can see them. And step 3 is making it work together, executing that ultimate synergy where your investments feed your savings, your tax strategies protect those investments, and your budget efficiently fuels the whole operation. You literally cannot skip a step here. You can't make things work together if you don't have the blueprint guiding the connections in the first place.
So think of it this way. The financial freedom blueprint is the objective. That is the final destination. But the required action? That is how everything works together. Because, listen, the blueprint itself is just paper. Or, in this case, pure theory, until you actually apply the action. The active mechanism to reach your objective is the relentless, deliberate integration of every single financial piece you possess.
Our source material is incredibly concise here, but we've managed to distill the very end of the American Financial Masterclass down into these 3 profound foundational takeaways. Consider these your final directives. First, acknowledge the final chapter. Recognize that the time for passive learning is totally over and the time for building has begun. Second, adopt the financial freedom blueprint. Commit to operating from a master architectural plan, rather than just making random financial guesses. And third, ensure everything works together. Take a hard audit of your financial life and make sure every dollar, every account, and every strategy is pushing in the exact same direction.